going forward. And there is a Macquarie report suggesting that there is now a big 40% chance of oil hitting $200 a barrel if the war extends by the mid of 2026 as well. Take a look at the precious metal prices, and meanwhile, we've seen a decline into that one. That clearly has been the trend. Gold is down 1% in Asia, silver is down 2%, and while gold has declined 15% from its March highs, silver is down 30% in a similar period. There also is decline that we've seen in copper. The only one that's trading in the positive is aluminum. As we see more and more facilities being damaged, apart from Alba, which we have been talking about, it is now about Aluminum Bahrain and Emirates Global Aluminum also looking at significant damage at aluminum facilities.
Manisha, thank you for all of those updates there. Of course, all of these aluminum players will also be in focus because of this in today's session. Take a short break, get you all the cues from Wall Street on the other side. Welcome back onto Action from Wall Street, where it was yet another session of steep selling on with the indices there. The Dow ended almost 800 points lower. The S&P 500 and the Nasdaq also falling anywhere between 1.5% to 2%. So with this, the Dow and the Nasdaq have both entered correction territory, which means both of them are down over 10% from their record high levels. The S&P 500 too is down around 9% from its own record levels. Now let's listen into Loretta Mester, the former Cleveland Fed president, on how the Iran war and the oil price shocks could impact the Federal Reserve's decision making.
I think the path of the war is going to determine the path of the economy, and then that's going to determine the path of monetary policy. And right now, we don't really know what's going to happen. So the Fed's going to be watching and assessing the risk. You know, when an oil price shock happens, and of course, with the closure of the Strait of Hormuz, it's also coupled with a supply constraint. What usually you see happen is there's upward pressure on prices and downward pressure on growth and employment. Right now, I think the Fed is rightly focused on the inflation risk of this shock. I mean, we've had inflation running hot and above the target for 5 years. And, you know, firms have already had to absorb higher tariffs. So that hit their margins. Now with the higher oil prices, that also is going to hurt their margins. So they may be more willing to hike at this point their own prices.
Let's now set you up for today's trading session for our own markets. Our research team is here with the trade setup, the stocks that should be on your radar, and of course the setup from the FNO side of things as well. First up, Sonal is here to tell us all the market cues that we need to watch out for today. Sonal, good morning.
Good morning, Hormuz. Well, of course, the big story remains what's happening in West Asia. On the back of it, no reprieve in global markets as well. You were pointing out how U.S. markets have seen a sharp correction. They are in the correction category with Dow and Nasdaq down 10% from the highs, S&P down 9%. On Friday as well, Dow was down almost 800 points. And this is on the back of this oil shock that is coming by. Brent crude prices above that $115 per barrel mark. Remember, the war high has been $118.5 per barrel. So that continues to be the important level. However, there has been no clarity on de-escalation. Yes, there is a 15-point plan by Iran, but there are no further talks on that yet. No clarity there. And also Strait of Hormuz, that remains unclear in terms of transit of vessels as well. For our own markets, there's no respite yet again. Last week, we saw the indices falling for the 5th straight week. Benchmark was down 1%. However, Nifty IT outperformed in a weak market like that, where it was up 1%. India's 10-year government bond yield surged to around 6.9 to 7%, which was the highest level in last 1 year. And Rupee also was at a record low of 94.81 to the dollar. So a lot of moving parts in our own markets on the negative side. But Rupee will be in focus again today because RBI has capped banks' net open position in onshore Forex market to $100 million. This is versus war-driven limit within 25% of the capital, which would lead to MTM losses for banks. But we could see some rupee recovery in trade today. However, banks have sought for leniency from the RBI, so this will be a developing story. But Rupee will be in focus. And on Friday, we did see DI's net buy, FI's net sell. On the Nifty, last week's low of 22,471 is an important support, and it is also the expiry. So important day for the markets today.
Very important day indeed, and the most important thing to watch out for, of course, will be the reaction on the currency and on the banking stocks as well. Sonal, thank you for that update there. Over to Ria now, who will list up the stocks that should be on your radar today. Ria, morning.
Well, good morning, Homer. Starting off with the defense names first, BEL, HAL, Idea Forge, as well as Garden Reach to be in focus after the DSE cleared proposals worth nearly 2.4 lakh crores on Friday. Urban Company will also be in focus as InstaHealth crosses 1 million monthly delivered bookings in the month of March. For Aarti Pharma, the US FDA has concluded an inspection at the company's facility with one observation. ONGC has started its gas output monetization from its Daman project, and Oberoi Realty has inked an redevelopment agreement with 1.4 lakh square feet of free sale area on Pedder Road. EPL has announced its merger with Indovida at a combined valuation of $2 billion to create a consumer packaging company for emerging markets. And apart from this, a whole host of stocks today in focus on the back of order wins. Coal India has won a BESS project worth nearly 1,057 crores in Telangana. Thermax has backed a 1,600 crore thermal power plant order. GR Infra, two order wins here. The first one is a 413 crore NTPC project and also an L1 status for 1,454 crores HAM project. KNR Construction as well has received an LOA for a HAM project worth nearly 1,734 crores. Dilip Bilkon as well, they have received an LOA for the Narmada flood embankment EPC project worth nearly 700 crores from the Gujarat government. And apart from this, keep an eye on JNK India, Seagull India as well as Railtel on the back of their respective auto wins.
Priya, thank you for that update there. And lastly, Sudarshan joins in with cues from the FNO space. Sudarshan, good morning. Possibly opening near Monday's lows, last Monday's lows, as in fact. But what's the FNO data indicating on expiry day?
Good morning, Harma. So our new logo's tagline is onwards and upwards, but market's move is completely contrary, backward and downward. And that's how we are going to see the recent low of 22,471 that Nifty might open around that. All the indicators have turned for worse. You talk about Nifty put call ratio, you talk about crude, everything has been very weak. And that's the indication we are getting from global cues. And because of that, GIFT Nifty is indicating a sharp downtick as far as our market is concerned. If you talk about the options data on the put side, 22,500 and 23,000 were the most active ones, while we saw major call writing above 23,000 to as high as 24,500. So support for Nifty would be around the recent low of 22,471. Resistance will be 23,300, and FIs continue to be aggressive on the writing side, or say on the selling side. So in the index futures, we saw FI selling more than 6,000 crore. In the stock futures, they have sold more than 3,400 crore. They have added short positions of more than 54,000 contracts, while the addition on the long side was just 13,000. One stock remains in the band, those are sale, and keep an eye on all the banks, whether it's private banks or PSU banks, because of major RBI ruling.
Oh yes, that remains the major focal point in today's session as well. Sudarshan, thank you for those updates from the FNO space. Take a short break, get you all the updates from the world of AI on the other side. Stay tuned. Welcome back. Now getting you the latest updates from the world of tech in our new offering, the AI Pulse. Rachna is here with the latest. Rachna.
Well, we start with Masayoshi Son, who's going all in on artificial intelligence because SoftBank has just secured a record $40 billion loan to fund its investment in OpenAI, and markets are reading it as a strong signal that an OpenAI IPO could be imminent. The loan is unsecured, matures in just 12 months, and was arranged with JP Morgan Chase, Goldman Sachs, Mizuho, SMBC, and MUFG. And that timeline closely aligns with dates cited for a potential OpenAI listing. The funds cover SoftBank's $30 billion commitment to OpenAI's record $110 billion fundraise that we've already reported, and last month bringing its total bet on Sam Altman's OpenAI to over $60 billion. Then there's Big Pharma, who's putting its money where the algorithm is. Eli Lilly has struck a deal worth up to $2.75 billion with Hong Kong listed Insilico Medicine to bring AI-discovered drugs to the global market. Eli Lilly pays $115 million upfront, with the rest tied to milestones and royalties, and gets exclusive worldwide rights to develop and commercialize the drug candidates. Then there's Elon Musk's AI chatbot Grok that has been handed a landmark legal defeat in Europe. The Amsterdam District Court has barred xAI's Grok and the X platform from generating sexual imagery without explicit consent, covering both adults and children. The fine is €100,000 per day, capped at €10 million. Parallel probes are also underway in Ireland, the UK, and the European Commission under the Digital Services Act. Then there's Hollywood Actors Union, SAG-AFTRA, who's pushing for a Tilly tax on AI-generated performance, which would require the studios to pay a fee into union pension and health funds as every time they deploy a synthetic AI performer instead of a human actor. Negotiations with studios ahead of the June 30th deadline are going on. Then back home in India, Bengaluru-based Sarvam AI has launched Chanakya, a new vertical for government and strategic sector deployments designed for air-gapped on-premises environments wherein the company's world's failure is not an option, is what the company has been saying. This was something that they had announced back in the India AI mission, and now we're seeing the deployment and the rollout happen in partnership with the government. We'll keep an eye out for more updates.
Rachna, thank you for that details there. Take a leave on this edition of Power Breakfast from me and the team. Thank you for watching. The GIFT Nifty is still almost 250 points lower. Bazaar Morning Call on the other side sets you up for today's monthly expiry.
countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of CNBC TV 18 Bazaar Morning Call. And the CNBC TV 18 logo, as you can see up on your screen, it's a new one. We bid farewell to the peacock, which of course has been, the calling card for CNBC TV 18 for the last 20 years now. And this is the new logo. Same team, same content, same analysis, but you got a different logo. As we get on to the next chapter. We are coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, Nigel and Rima with me, guys. Morning.
Hi, morning.
Hi, morning. It's a short but a very important week. There's so much to digest. A dangerous widening of the conflict, complete risk off across markets. There is Rupee action. I mean, there's been RBI regulatory intervention by the RBI. So there's lots to think about and digest this morning.
Well, not such a bad week to have a few holidays, right? And hopefully the news flow improves when we come back on next Monday. But for the time being, things didn't get a lot better over the weekend. But Rima, I thought you'll mention about Mumbai Indians. Finally, we got off to a winning start. So that was encouraging as well in terms of the IPL action. But we've got markets to look at. So let's hop across first to Prashant, who's going to be telling us all the cues that we've had over the weekend. Prashant, take it away.
Thanks very much for that. So just think about it, right? 28th of February, that Friday, it was actually Saturday morning for us when we first woke up to news that Iran and Israel and US have attacked Iran. And many said, well, this is Venezuela 2.0. This is going to be short-lived. It's going to be temporary. Well, absolutely majorly miscalculated. And that was basically the bulk of the market, if you remember the first few days. And now it's the fifth week. Basically, a month has passed and there's no end in sight. The problem is this, right? I mean, something or the other, and there are too many parties involved and everybody needs to pull back. And there are new parties which are now getting into the fight. So you've got, and this is the latest. I'm just trying to wrap up what is new in that sense, and then we'll get to the same or the old in terms of price action, etc. So Brent oil prices have jumped to actually they're now closer to $117. They're up on your screen, almost $117. The Houthi rebels, which is basically a Yemeni group, and they are large. They have been over the years supported by Iran, and they've considered one of Iran's proxies in the region, in the Arab states in the Middle East. They have now formally joined the escalating conflict. If you look at a map, Yemen is essentially adjacent to Saudi Arabia, and it is also close to important waterways. And I'll tell you why I'm saying this. Houthis, by the way, launched ballistic missiles at Israel. Some are saying, well, this is just performative. They're not really getting into the fight. They would just want to show that we are there. They don't want to. They don't want to escalate this because otherwise Saudis are going to hit them hard. U.S., Israel, everybody's going to hit them hard as well. So this is performative more than anything else. But in any case, the reason I think the markets are a little nervous is because in any case, the Strait of Hormuz was blocked. If you look at a maritime map, right, of that region, one is the Strait of Hormuz through which bulk of the oil passes. That's in the Persian Gulf. The other one is basically between Yemen and the African continent. It's a very narrow pathway, and that is important. The numbers are. We will put out the numbers later in terms of how much oil passes through that strait. But with the example of what Iran has done in the Strait of Hormuz, is it possible that Yemen perhaps is going to do something similar in that strait, right? So Africa on one side on the west and Yemen on the other, Yemen on one side. And this has got immense implication if that strait is blocked, or they try to block it, because Saudis have been saying, well, we won't take oil through the strait. We're going to take it through the east-west pipeline, and then we'll bring it down to deliver to Asia through the strait, which basically passes through the shoreline of Yemen. And if Yemen is able to block it, I mean, you are essentially looking at one more large oil shock. And I think that is largely the reason why you've got oils at about $117 or so. That's what I want to sort of put out. That's the new thing in that sense. Second, right, and this is something to do with the market here, the RBI and the rupee. The rupee, of course, hit almost $95 on Friday. Post-market hours, I think it was about 6 or 7 in the evening, the Reserve Bank of India essentially said that they're putting a $100 million cap on banks' net open positions in the rupee market. And the banks need to unwind existing positions before the 10th of April. Banks basically have an estimate, and these are estimates, about $40 billion in these short-term Forex exposures. You know, the trade was very simple. You go long the dollar rupee here in India, and you go short the dollar rupee overseas. The difference used to be 2 paisa, 3 paisa, and it was almost free money. The trade had ballooned. There were limits on a net basis, but there were no limits on the gross basis. I mean, the trade became very, very large. There would be about 8-10 banks who would be part of this. I mean, if you look at this $40 billion and who's got exposure, it would be 8 to 10 banks. There'd be mixed of public sector and private sector and foreign banks as well. So PSUs, private and foreign banks, but it's largely limited to about 8 to 10 banks. So today, this morning, because the RBI said you will have a $100 million limit, what will banks have to do? They will have to essentially come into the market, sell dollars in the onshore market because they are long dollar. They have to unwind by selling dollars. And because they are short dollar rupee overseas, they've got to buy dollars overseas. And what basically will happen is that the dollar will appreciate. We are close to 94.81. I mean, I think you could see a 1 rupee appreciation against the dollar straight up. And some are not ruling out that the rupee goes up all the way to about 93.50, even 93. Who knows? We'll see how that really plays out. So that's a big one which has come through. US markets, I'll just quickly wrap up. S&P 500, 1.7 lower. NASDAQ was down about 2%. The 10-year yield, 4.43 is where we left off. It's up 45 basis points higher since the war began on the 28th of February. And that's a big one. That's a 2 standard deviation move in that sense. Now, war timelines, and this is just commentary. Secretary of State Marco Rubio on Friday saying that US war on Iran will take weeks, not months. Washington Post reporting that US is preparing for weeks of ground operations in Iran. And of course, an additional 3,500 US troops are already in the Middle East. And by the way, you know, President Trump had given the 6th of April deadline. Guess what is on the 6th of April? 2 additional US warships are getting into the region. So some are essentially saying this is just a pause before you see another further escalation. We'll see if that is really the case. There are some, President Trump has spoken on board Air Force One, and we'll put out some quotes from President Trump, and he's again sort of, sounding the de-escalatory noises and saying, Iran has accepted bulk of the 15-point resolution, etc., etc. But, see the social media post of the Iranian Speaker of Parliament this morning essentially saying that, well, nothing has been done and this is just, trying to manipulate markets more than anything else. I'll just leave you with levels. Nifty supports at 22,624 and then 22,200. I mean, we could put a downward sloping channel and maybe explain it a little later, but these are the numbers on that channel. And the resistance is 23,186 or so. So that's the overall picture. GIFT Nifty, I think, indicating a 240 odd point lower start. Well, F&O positioning, how does it look like as we start in a new week? Nigel, take it away.
Well, today marks the end of the March series as we play out the monthly expiry. And it's been a forgettable series for the bulls, marred by geopolitical tensions. The Nifty Bank, both of them are down between 10 to around 14%. On Friday, though, the Indian markets pulled back very sharply. But that's been the trend, actually, for global equities. However, if I pull up the net institutional sell number, that number was actually only around 1,000 crores, or actually a little below that. That clearly tells you the mood of the market. It's lack of buying rather than intensified selling that's causing stocks to crack big time. The FIs, yes, there have been sellers in the cash market, but the quantum of selling was not so large to see the kind of session that we saw in Friday's trading session. Sometimes these sort of periods provide opportunities for longer-term investors, so just keep that in mind. Well, the FIs, they've been defensive on the derivative side of things as well. On Friday, they added shorts both on index as well as stock futures. And now their shorts stand at around 2.8 lakh contracts, which is approximately 85% on index futures side. The FI call writing, well, that continues with close to around 3 calls being written for every 1 put in Friday's trading session. And there was writing being seen at 23,000 call, 23,100 call. The premiums on both those two, they eroded sharply as well. But today, it's going to be more about defense. and the bulls will look to defend last week low, which comes in at around 22,471. And the hope is we don't go all the way down and breach Liberation Day low of around 21,700 in the coming sessions. I think something's got to give, and the street will be hoping for taco. This as Trump seems to have pushed himself in a difficult corner. The war getting prolonged longer than expected. The yields are up by close to around 40 basis points. Brent crude prices as well are bringing inflationary worries back on the table. And this is the combination actually Trump would not have wanted on their wish list ahead of a midterm election. So that's going to be important. The taco is something that people will be hoping that actually Trump pulls back a little bit. So, either things get a lot worse from here on, or we're getting in for a very, very ugly phase for global equities. I would lean more towards the former as of now, that maybe the downside from here on is actually limited. The Indian rupee as well will see some relief because the RBI has put that $100 million cap on banks' net open positions. But this will impact the MTM book of banks. So we can expect a start closer to the recent lows on the Nifty Bank, which is ballpark around 51,500. Defending this mark is going to be extremely important from a bullish perspective. So monthly expiry, a gap down opening, and hopefully some strength on the rupee. You got plenty of action today. Hope is that at least we end off a little bit better than where we start off. But going by the global equity market screen, it's looking like a tough session.
Well, the Nikkei, that's the Japanese index, is down 4.7%, so now approaching a near 5% fall. The Korean markets are down 4%. The Taiwanese markets and Hang Seng, both of them are down nearly 2%. It's an ugly, ugly, complete risk-off session that we can see across Asia. Taiwan has now extended the fall. It's now down over 2%. On the equities then, it's Chetan Seth of Nomura who says that they continue to retain a cautious near-term stance on Asian stocks, as the Iran war has now entered the 5th week without any signs of normalization of energy flows from the Strait of Hormuz. He says while there have been diplomatic exchanges between the US and Iran to reduce tensions, both sides appear to remain far apart to agree on any mutual de-escalation. He says in Asia-Pacific ex-Japan equities in the near term, he continues to be cautious on Indian equities, where he sees an earnings risk, elevated valuations and twin deficits. Also, he's cautious on Indonesia and Philippines, where Nomura says that both twin deficit countries. But in the case of the other two countries, Indonesia and Philippines, valuation risks are lower versus India.
Okay, well, Samira Chakrabarti of Citi says that the ongoing conflict in West Asia has again put the spotlight on important inflation and energy exchange rate pass-throughs. He says they've tried to recreate the RBI's imported inflation index with the new weights from the recently announced 2024 base year CPI. He estimates that 14% would be the adjusted effective weight of the imported inflation basket, out of which petroleum products would almost have half the weight of 7%. He adds February 2026 imported inflation was 7.5% year-on-year and contributed 34% of headline inflation, and sensitivity of headline CPI from a 5% depreciation in rupees estimated at 35 to 40 basis points, assuming sticky ingredient petrol product prices. Samir adds, as during the Ukraine conflict, WPI is likely to bear the brunt of imported inflation. He says 80 to 120 basis point upside, risks a nominal GDP growth forecast of 10.5% for the FY27, arising from the possibility of a sharp rise in WPI if the conflict endures.
Meanwhile, speaking to reporters on Air Force One, the US President Donald Trump has claimed that Iran gave the US the most of the 15 demands it issued to Tehran to end the war, even as it remains unclear whether either side is negotiating. Listen in.
They gave us most of the points. Why wouldn't they?
They make it sound like they made some concessions. Can you identify those?
Well, they're agreeing with us on no that. I mean, we asked for 15 things, and for the most part, we're going to be asking for a couple of other things. And just to prove that they're serious, they gave us all these buffs. When I talked to about 4 days ago, a presenter said they gave me a present, but I didn't think I was at liberty to say what it was. What it was A plus 2. It's 10 massive boatloads of oil. And today they gave us another present. They gave us 20 boatloads of oil that starts being shipped tomorrow. We're having very good meetings, both directly and indirectly, and we're getting a lot of very important ones.
Well, at least for now, both sides still seem to be talking past each other. There are no signs of de-escalation. 2 days back, the Iran parliament speaker also went on to say that they've spammed us with so much fake news, trying to push energy prices down, that the market is now just numb. William Lee, chief economist and managing director at Global Economic Advisors, is now joining in. Thank you very much, William, for joining in. Do you get a sense that we've seen a dangerous widening of the conflict? 3,500 U.S. troops have arrived. Yemen's Houthi militants have now joined the conflict. How are you reading the latest signals?
I know the standard scenario is that we are going to be looking out for the expansion of fighting. But I think a slightly different perspective can be put on the picture. What we are sending are troops, in fact, quick reaction forces, Marines from Asia into the Iranian theater. And my expectation is that a lot of these military actions will be very surgical, as they have been up till now. I think the United States has gone out of its way to contain the fighting from affecting the Iranian population very much. It mainly has been centered on getting rid of the command and control centers, getting rid of the governance structure, especially among the extremists and the extremists on the military side. Right now, I think much of the facilities, for example, in the regular army has been left alone because they have not shown the kind of radical impulses that the Iranian Guard has shown. So I expect that if we are going to have troops on the ground, it'll be much more of a surgical strike. It'll be to contain the ability of Iran to export oil, and that means Karg Island. I think the whatever is done is going to be one of limiting the ability of the existing government to do business as usual, to make them much more willing at the bargaining table to come to a quick conclusion. I think that's the strategy that is going to be revealed over the next several days and couple of weeks. Because as you've all said, President Trump is under a very short fuse. He has to wrap this up before the midterm elections become into view. And within the United States, we are still far enough away from November that he has some time to operate. But sometime by late spring, early summer, this stuff has got to be wrapped up, or else it's going to influence the ability of the Republicans to retain control of the government. So my expectation is that the military actions from here on is going to be are going to be very surgical and directed toward limiting the ability of the existing government to do business and to incentivize them to be much more serious in their discussions.
You know, I've been, William, hi, morning. I've been saying this since for at least 6-7 days now. But there are more, that this is the beginning of the end and this will wind down. And but point is, there are more troops in the region now and more are coming, right? 6th of April, there are two large warships reaching the region, which is the deadline. So this is just kind of sort of, you know, attempts at having a better negotiation, a handed negotiation with all this military might, or you think this actually leads to more escalation?
Well, it depends what you mean. What you mean by escalation? The Houthis have escalated. They've fired a couple of missiles off. But again, they could have done a lot more.
But if you, William, if you read it, this largely seems performative. They've hit 2 missiles and that's it, right? And they were intercepted, and that's about it. Nothing more. Yeah, go on.
Remember, the ability of the Iranian government to fund the Houthis has been cut off dramatically. And all, as President Trump was saying, he had to get a confidence building measure on the part of those he's negotiating with to make sure that they really are the ones in charge. That's why there's been some demonstration of, yes, we do control the Strait of Hormuz. We can allow ships to pass at our discretion, and we're going to demonstrate that to you. I think that is a very important demonstration that we're talking to the right people. Now, there are the wrong people still floating around, and they can do a lot of damage. And I think the military will be directed toward getting that other part of the non-government extremists under control. And I think whatever military actions you see will be much more oriented toward containing those elements.
Okay, William, we leave the conversation here for now. Thank you very much for joining in. Let's move on and tell our viewers the interactions that we've lined up on the show today. 8:35, Dinesh Khara, former chairman of State Bank of India, and Abizar Divanji of Neostrat Advisors will join in as RBI looks to curb net open positions of banks in the Forex market in a move to boost the rupee. At 9 a.m., we'll be joined by Jayesh Mehta of DSP Finance. The rupee markets will open at 9 a.m., so we'll discuss the moves and the recent RBI circular. At 9:20, we'll be joined by Gautam Chowcharya, Tanvi Gupta, Jain, and Divya Nagarajan of UBS to talk about the geopolitical tensions and the impact on the Indian economy. The entire top team of UBS will be here with us. 9:40, the management of IRFC, Indian Railway Finance Corporation, will join in to talk about the 12,800 crore of a rupee loan deal with Hindustan Urvarak Rasayan for debt refinancing. And following that, Saurabh Mukherjee of Marcellus Investment Manager will be chatting with us at 9:50 to talk about his recent book launch. End of the show, Lata will be in conversation with Neeraj Gambhir of Axis Bank and Abhishek Upadhyay of ICICI Securities Primary Dealership.
Time to slip into a quick break. We've got a lot of stocks that we'll be tracking for you. So take that break, come back. We'll get into further detail on all the top names.
Welcome back. Let's talk stocks now. This is CNBC TV 18's list of top stocks for the day. And the big story today is going to be on the rupee and banks. The RBI has capped the total positions that banks can take in the onshore currency market at $100 million. So banks will have to bring down their positions to that level by 10th of April, $100 million. What does this mean for the rupee and banks? Lata now joins in with more. Lata.
Yes, this cap on FX positions that banks can hold in this market, that is onshore market, not NDF, that has been capped. Until now, or actually the ongoing rule is banks can have net positions of 25% of their tier 1 capital, which means big banks can have more net positions and smaller banks smaller positions. But remember, it is always net. See, you can have any $1 billion, $2 billion of positions which are countered by an opposite position in the NDF market. Usually it's long on the onshore market and short on the offshore market. And then it's only the net that is capped. For the first time, what Reserve Bank is capping is the gross position itself, which can only be 100 million. I mean, that's far less than what banks would have been prepared for. And so what would the market have to do? They have time till April 10th, but everyone will rush to the door first, is the expectation. So obviously, in the morning, the expectation is that you're going to see a rise in the rupee. We don't know whether it will be 93.50, 94, but there will be a fall from that 94.80 level that the dollar was selling. Some people are even talking of 92, but okay, you know, there can be random noises like that. While they, unwind here, they will have to buy in the offshore market. And therefore, the level difference between the offshore market and the reference rate, at about 11 o'clock, 11 to 11:30, you have the reference rate. If that difference is too much, that accounts for the loss that banks have to bear. Now, the talk in the market is there are $40 billion of positions. Again, only Reserve Bank knows the exact amount. I have got this from the chatter in the market. If it's 40 billion and there is a loss of 1 rupee, it can amount to a loss of about 4,000 crores for the entire banking system. But we are talking ifs and buts. There is still a hope. There's about 35 minutes for the markets to open. Will the Reserve Bank still extend the date to, say, April 30th? Even if they give 1 month, most of the contracts are 1 month contracts. And therefore, the banks don't have to rush to the door and sell. It looks extremely unlikely that the Reserve Bank ever walks back on what it has announced. But there it is. Otherwise, potential losses, whether the losses will have to be taken in the 31st March quarter or next quarter, even that is a bit of a grey area. But if the rule continues, losses are there.
All right, thanks a lot for that, Lata. Well, I'm looking at the metal stocks and aluminum stocks in particular. This as over the weekend following an Iranian missile and drone attack, Emirates Global Aluminum's Al Tawaleh site was damaged and an assessment is ongoing. Now, why is this facility important? Because Emirates Global Aluminum's Al Tawaleh produced close to 1.6 million tons in the last calendar year, that's 2025. Now, part of this facility will be impacted. That in turn will support aluminum prices. And this already adds to the recent supply cuts that we've seen in the Middle East. Remember, Qatalum, they pulled back close to 250,000 tons of production. Aluminium, Bahrain as well curtailed close to 300,000 odd. So between them, there is already 500,000 tons that was out of the system. So this fresh hit actually will further pull back some supply. The ongoing war in the Middle East, well, it risks a lot of aluminium capacity. Remember, the Middle East accounts for roughly around 9 to around 10% of global output. But more importantly, they export a large part of this production. So in short, the supply crunch gets a little bit more, and that in turn could support aluminium prices. So we'll keep an eye out on all these aluminium stocks today. But let's, we'll also keep an eye out on Coal India because they won an LOA for 750 megawatt of BESS project in Telangana Genco. And the total project cost is roughly around 1,000 crores or thereabouts. They've been talking about diversifying a little bit away from the core coal business. So this as well, a bit of a positive is the way I look at it, though the core business actually will get a significant leg up in terms of the pricing that we've seen in the international markets. Keep an eye out on Coal India as well. But let's go to Ria. She's here to tell us about the defense stocks. Morning, Ria.
Well, good morning, Nigel. Defense stocks today will be in focus as on Friday, the DSE cleared proposals worth nearly 2.4 lakh crores. Now, in terms of the key projects for the Indian Army, they've cleared the air defense tracked system as well as high capacity radio relays, both of which Bharat Electronics will be the key beneficiary. They've also cleared proposals for the runway independent aerial surveillance systems, and for this, Idea Force stands to benefit in addition to some other private companies as well. For the Indian Air Force, we have have the remotely piloted strike aircraft as well as the Sukhoi 30 engine overhaul. And out here, HAL will be the key beneficiary along with some other private players as well. And for the Indian Coast Guard, heavy-duty air cushion vehicles have been cleared. And for this one, Garden Reach Shipbuilders as well as Goa Shipyard will stand to benefit. So overall, 4 key stocks will be in focus: HAL, Bharat Electronics, Garden Reach as well as Idea Forge.
Okay. All right, thanks very much for that, Ria. Well, urban companies, the next one we're going to focus on. Mangalam has got details on this one. Mangalam, morning.
Good morning. So it's been a big correction from the highs at lows. There was fund buying, etc. The big story for the company is how Insta Help for them actually scales up. And there's an update which has come on that. The company has crossed a monthly run rate of over 1 million orders on Insta Help. And we still have a few days left for March. And this is a big positive because, you know, they hit the milestone of 50,000 plus orders per day in February. And they're scaling up on that as well. For a business that started just a couple of quarters ago, has swiftly become a big total addressable market and attracted competition as well. The only couple of parameters that we watch from here on: one, the company had earlier promised that losses per order in InstaHelp will reduce. So will that happen or not? And secondly, you have players like Pronto, Snabbit, all of them raising money from the private equity world as well. How the competitive intensity will play out. So not very different from what quick commerce was earlier, now that these quick services are coming in for platform companies. But by and large, given the weakness of the market, the stock could see some red, but news is fairly positive.
Thank you very much for that. Sonal now joins in with the latest on ONGC and Oberoi Realty.
Well, let me start with ONGC because their Daman Upside Development Project has started commencement in terms of monetization of gas. Remember, they say this was a capex of $1 billion that the company had made. They say it will be the production from all the wells will be ramped up in a phased manner. We don't know the quantity of gas that will be produced from there, but it is a step in the right direction. Oberoi Realty, it's another redevelopment project that the company has entered into in South Bombay at Pedder Road. It is a total free sale area of 4,800 square meters, and the company has been looking at redevelopment in South Mumbai. It's another addition here. The stock will be on our radar.
Okay, all right. Thanks a lot for that, Sonal. Well, let's go back to Ria. She's here to tell us about another stock that she's tracking, that's EPL. Ria?
Well, Nigel, EPL will be in focus today as they have announced their merger with Indovida. Now, they will be creating a consumer packaging company for emerging markets post this merger, and this will form a $1 billion revenue entity as per the company, and the combined valuation for them will be $2 billion. Now, if you go deeper into the valuation, the transaction has valued EPL at rupees 339 per share, which is 70% higher than Friday's closing price. And if you look at Indovida, that is valued at a 35% discount to the multiple that was ascribed to EPL. Now, in terms of the shareholding post the merger, Indorama Ventures will become a co-promoter of the company, holding roughly 51.8% stake, and Blackstone will continue to hold 16.6% stake in the merged entity. Now, this merger is also expected to be EBIT margin accretive by roughly 120 basis points and also ROCE accretive for EPL by around 220 basis points, and this transaction will be completed within the next 12 months.
Thank you very much for that. More news on Thermax. GR Infra, Upasana joins in.
Good morning. First up, let me start with Thermax. Now, the company has secured a boiler packet supply order worth 1,600 crores from Thermal Power Project Company in the central India for an ultra supercritical thermal power plant. Now, mind you, this is the second order that the company has received in this month, and with this, the company's order inflow for the current quarter reaches around 3,000 crores versus 3,080 crores seen in the last quarter. Now, order book of the company as of Q3 FY26 stands at 12,641 crore with an uptick of nearly about 11% on a YoY basis. Next up is GR Infra. It emerges as a L1 bidder for NHAI project worth 1,454 in Gujarat, and companies also received another order over this weekend worth nearly about 413 crore from NTPC. This is mainly for implementation of battery energy storage systems at its thermal power station. So all in all these two stocks will be on our radar today and expecting green.
All right. Thanks very much, Upasana, for that quick recap of things and stocks that we've put out. So aluminum stocks in focus. Aluminum prices are jumping. Coal India is in focus. Defense, which we highlighted earlier. Urban Company, ONGC, Oberoi Realty, EPL, Thermax, and GR Infra. Stocks on the other side, which are likely to open. There's, of course, banks. And I mean, a lot of pressure. I think it'll show up everywhere in more ways than one. GIFT Nifty still indicating a sharply lower start.
Okay, all right. Well, let's turn our attention away from equity markets then. Let's go across to Manisha. She's here to tell us what's going on in the commodity markets. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, where we've seen 3% of gains in the Asian markets right now. We are trading above $115 a barrel. Iran war entering its fifth week, and no swift resolution in sight is keeping the prices on the higher side. Houthis also have joined into the war, and then there is Ukraine using long-range strikes on energy infrastructure. So whichever way you see, there is attack on energy infrastructure, and that premium is getting into the prices there. The precious metal prices, though, have continued to decline. Gold is down a percentage point, silver down 2%, and silver actually has gone in for a negative for 2026 till time right now. The copper prices also have continued to decline in the Asian markets right now. Last week was a good one, but metals have continued to underperform since the conflict, barring aluminum, of course, which is trading at around multi-year highs right now. After Alba, it is Aluminum Bahrain and Emirates Global Aluminum as well, reporting significant damage at their facilities, supporting aluminum prices. So when you look at it on your screens, in the metal space, it's only aluminum which is trading positive, and then you have energy. Everything else slightly under pressure.
All right, Manisha, thank you very much for that. We take a break. We are back, and we'll be joined by Dinesh Khara, former chairman of State Bank of India, and Abhizar Devanji of Neostrat Advisors on what the RBI has done. Basically, limiting the amount of positions that banks can take in rupee markets, dollar rupee. A lot of covering expected, strength in the rupee expected on the back of it. So coming up in just a bit. Welcome back. Markets, of course, very, very focused on what's happening with the rupee. The rupee hit almost 95. 94.80, I think, was the low on Friday. After market hours on Friday, after the rupee markets had closed, the RBI came out with a circular capping the total positions that banks can take in the onshore currency market to $100 million. Banks have to implement this by the 10th of April. Sources tell CNBC TV 18. The banks have sought some extension, but I mean, we're already here. It's 8:40, 20 minutes market will open. So unlikely. And RBI is not known to pull back in circulars that it kind of puts out. So this morning, banks will have to sell dollars here and buy dollars overseas. So rupee is expected to strengthen. The gross positions in this arbitrage trade, which banks were indulging in, is estimated to be some $40 billion. And bulk of this exposure, we are told, we understand from conversations, are concentrated in about 8 to 10 banks, largely, I mean, public, private, but of course also foreign banks were involved in this. We have Dinesh Khara, former chairman of State Bank of India, and Abhijit Devanji, founder of Neostrat Advisors, who are with us. Gentlemen, good morning. Great to have both of you here. Mr. Khara, Prashant Desai, sir, and thank you for joining us. I mean, sir, this was a very profitable sort of venture for banks. I mean, this arb trade. But could you tell us, do the numbers seem very large to you? I mean, $40 billion, I mean, it's a huge number, right? I was told SBI perhaps has got the largest exposure, just by, obviously, the sheer size of it.
Well, when it comes to this kind of a guidelines which has come from RBI, I would say that perhaps it is intended with the intention to ensure that the risk remains contained and it should not go beyond the limits. And with that in mind, the kind of volatility which you are seeing in the currency market essentially attributed to some banks having huge open positions, and they were actually playing on the speculative trends in the market. So I think it is essentially to curb that, because speculative trends generate profits in the short term, but in the long term, it can actually impact the stability of the institution also. So with that in mind, perhaps RBI has come out with these guidelines. And actually, when I looked into this, it was reminded me of the year 2011, when also we had seen similar kind of currency movements. And at that point of time, RBI had put condition that it should not exceed 15% of the capital. So, in fact, then onwards, the boards were given the discretion by RBI to lay down the limits for this kind of a currency trade. But yes, of course, there are certain large banks. There are certain large banks who actually operate on the proprietary book. The intention of the net open position is essentially to ensure that the bank should be in a position to serve their customers well and without really impacting their balance sheet. This is what the intention has always been. So I think when it was being leveraged for the short.
So, Mr. Khara, in a way, in a nutshell for our viewers, right, RBI is saying that we don't want to supply dollars to for the purpose of giving it to hedge funds, right? I mean, we want to use dollars for the real things, which is trade and
absolutely
FPI,
that is the intention,
outflows, etc. Right?
Yeah.
So not the speculative side of it, and perfectly, absolutely understandable. Typically, Mr. Khara, in your experience, this would happen, and I was told this, that the RBI would give some time. I mean, they'd basically call up banks and say, well, wind this down. And it won't be, without any warning, not a circular. So that's one thing I heard. Any thoughts?
Well, I think the kind of rupee volatility which we are seeing for last couple of days, almost a month now, was essentially perhaps the reason why maybe the moral suasion was something which should not have worked. That is the reason why RBI has come out with such kind of a step. And they've done it in the past also. Sometime in 2011 also, as I mentioned, this kind of a step was taken. And but yes, of course, we very closely monitor the orderly movement in the markets. And I think it's moral suasion and then followed by that seems to be the...
Yeah. But this time looks like moral suasion. Maybe events overtook them, right? I mean, the fall was so sharp.
Actually,
we're all wiser in hindsight, but no one really saw all of this coming together and happening together in that sense.
Absolutely.
Mr. Khara, now, how will banks book this? There will be a loss which will have to be booked. There are some estimates, $500 million.
Yeah, they will have to go for the MTM because $500 million the limit, if at all, some banks are holding that kind of a limit, they'll have to pare it down to 100 million. And 100 million has to be done by 10th of April, as per the guidelines. So I think what will happen is that slowly and gradually they will unwind their position. And my expectation is that almost about 18 billion odd would be the amount which should be available for unwinding. And I think perhaps it will lead to almost about 100 paisa strengthening of the rupee. This is what my expectation is.
Sorry, it's not. You're saying it's not 40. Your estimate is it is about $18 billion, 1/8.
Yeah, my estimation is about 18 billion.
Okay, that's important. We should put it out. So not 40, but 18. That is your estimation. You're saying about a 1 rupee strength in the rupee, Mr. Khara.
Yeah, this is what my expectation is.
Mr. Khara, so when you were the MD of State Bank of India, was the net open position by the bank, do you think similar or the industry similar to $18 billion? Or do you think it's gone up now in the recent past?
No, it would have gone up. It would have gone up. Actually, many of the foreign banks are very active in this particular space. And so I think my sense is that, in fact, when we were approving the limits within at the board level, we were very mindful that we were never having intention of the speculative gains. Intention was more in terms of ensuring that we should be in a position to meet the customers' requirements. So that was the kind of, and also those were the days when the volatility was not at swell. I think now it has gone up significantly. I would say that in about a month's time, rupee has depreciated almost about 4%. It's a very significant number. Normally, we had seen about 4% depreciation in a year. But now it has gone up almost, we have seen rupee depreciation of 4% in a month. So that is, I think that needs to be curbed. And with that in mind, this kind of a section has been issued by RBI.
Okay, all right. Let's get in Abhisar Divanchi as well into the conversation. Hi, Abhisar. Good morning. Thanks a lot for joining in on the call. What do you make of RBI's move? As Mr. Khara says, that the depreciation has been very, very sharp. And if I look at it in this fiscal itself, the currency depreciation has been close to 10%, which is the highest we've seen in more than 10 years. What do you make of the move that the RBI has done? And have you done any rough math in terms of the open positions?
Yeah, so yes, a little bit. I'd agree with Mr. Khara that it's around 18-20 billion of open positions, most of it large Indian or foreign banks, because none of the other boards would have approved limits which are significantly large. But, just dissect the situation. First of all, this circular says this is only for net open positions onshore. Now, that's very important to understand, because banks may not have necessarily taken net open positions overall, because what they would do is they would short in the domestic market speculatively, but cover in the NDF market, which is the non-deliverable forward, which is a market that exists for Indian rupee dollar overseas to be settled in dollars. So ideally, the bank's net open positions overall may have been under control, but onshore would have been exceeded. Now, why onshore would have been exceeded? Because of the systemic dollar flows, outflows that are happening in India, be it stock market, be it importers, be it whatever, because of the rising oil bill or the falling stock markets, or all those things. There is pressure on what the bank speculated domestically because of the actual flows. Yeah.
So, sorry. We lost you there in between. Yeah, go on, Abhisar.
Sorry. So because of the actual flows, what you would do is would withdraw, you would try and do short positions domestically and try and cover them in the NDF market. So banks, NDMs are not impacted because these are kind of ready forward transactions. But what really happens is now, when you have to regulatorily bring the position down to $100 billion, there will be a contraction of the gap in the NDF market and the rupee market.
Yeah.
Plus, domestically, because you'll have to cover positions, the domestic rupee, as Mr. Khara also said, will improve significantly. So as a result of this movement, because of regulatory intervention, banks will have to book a loss.
Yeah, no, absolutely. Well explained, Abhisar. We're having a slightly scratchy line. Mr. Khara, after today's 1 rupee appreciation, you think it'll hold? So, say it goes to about 93.50 dollar rupee this morning. You think it'll hold for some time there?
My sense is that if the speculative players are not all that active, and also the the trend as far as inflows of dollar continues, then I mean it has to be essentially a balance between the inflow and the outflow. So I think in the current scenario, my sense is that it should actually it should help in holding it around the same levels.
Got that. Mr. Khara, thank you for joining us. I know you're outside and there's activity behind you, but appreciate you taking all the time and being with us. Abizar, thank you very much. Appreciate your time here on CNBC TV 18 as well. We'll take a break. We're back and we'll come back with Dharmesh Kant of Chola with some stock-specific questions. And just leaving you with the GIFT Nifty to see if there is any change. Dow futures, I think, have recovered a little bit from the lows. Stay tuned.
Welcome back. Hope you're having a good morning and a good start to the week. For markets, though, we're going to be a little bit jittery to kickstart trade. That said, a good time to welcome Dharmesh Kant, Head of Research at Chola Securities, who joins us on the show. Hi, Dharmesh. Good morning. Good to see you, Ben. Looks like you're part of the good news because the GIFT Nifty was suggesting 280, 290 point downtake. I think that's cut its losses. And the US futures have moved into the green. It's going to be a tricky trading session. But a sector that could do well is the aluminium players. We know the Middle East capacities have been getting shut down. We saw what happened in Bahrain. We saw what happened in Qatar as well. And over the weekend, we had another facility that did get hit. How would you approach these players? Stocks like Vedanta, Nalco as well as Hindalco. They had a good run and then they pulled back considerably. Your view?
Yeah, good morning, Nigel. Thanks for having me for the show. Hope so that today is a good day. It's been a monthly expiry and a lot of pain has been there in the market. So some short covering rally can stabilize the market. To my mind, I mean, 22,500 valuation wise also looks pretty attractive, and more of the damage has already been done. Even if you take a flat Nifty EPS of say 1200 for FY27, then also you are 18, 19 times over your forward PE multiple, which is -1 standard deviation to the long-term average. So I think that provides you the cushion and comfort that downsides may be restricted. In that space, as you have rightly pointed out, aluminum looks attractive. This is the only metal along with tin for the year, which has gained around 9% year till date, and volume traction has also been. Only the caveat is China is sitting on inventory surplus of aluminum. So if that supply comes into the market, whichever route it comes through, may have some liquidating impact. As of now, it's not been the case. Vedanta as well as Hindalco has corrected, sharply from their highs, and we have been bullish on the metal space for quite some time. And any corrections out there, we have been recommending our clients to get a hold of it and to invest incrementally, though not all in, but in a staggered space. To that extent, both looks pretty good for us from an investment basis. We have been avoiding Nalco though. So Hindalco, as it offers a diversified play, along with Vedanta, where again a diversified play is being offered at. Both valuations have now near the mean multiple, so 10-15% upside rally on a good day is expected from there. So a good investment bet, definitely.
Good investment bet. Dharmesh, we'll start with the earnings preview soon. So at Chola, you all must have prepared that. So can you tell us in Q4 which companies are likely to see the highest earnings downgrades on the back of the war, the increase in the inflationary pressures, etc.?
Yeah, good morning, Rima. I mean, the biggest suspect in Q4, having regard to how the things are going to roll out in Q1 FY27, will be the NBFC and banking space all put together. I mean, private sector banks, public sector banks, and the NBFCs are the suspect out there. Other than that, I think everything will deliver the numbers in line with what the expectation has been. And Q4, we have been going with around 4 to 5% kind of a growth, because last year Q4 was far higher. I mean, Nifty EPS was itself 327 to 328 rupees. So you are already approaching this Q4 on a high base. So IT will be a flattish kind of scenario. Pharma, again, in line with around 15-20% in that range kind of a growth should be there. Chemicals should also do well. Metals, again, would be delivering good set of numbers. Automobiles, the best of the lot will come from the automobile space. As far as the numbers are concerned, we are building in 17% kind of a aggregate sector growth for automobiles. But since financials control 38% of the entire, Nifty earnings aggregate, so that is where we are suspecting some damage. One is because of higher bond yields will have a corresponding impact on held for trading treasury. So there will be some impact out there. Other incomes would be lower. And maybe because of some minor, provisioning being advanced for your MSME and small scale and retail side trade. So because of the situations which we are seeing on the ground level, and trade growth is likely to be tapered going forward. So this is a space which looks vulnerable to us.
Okay, all right, Dharmesh, thanks a lot for joining in. A short but effective chat. Appreciate you joining in and giving us your views. We'll catch up during the course of this week. Well, for the time being, I'll tell you what, we'll slip into a short break, I think. We'll come back. We'll get you our technical experts. We'll also get the initial rates of the rupee. Jayesh Mehta, DSP Finance, will be joining in to help us out with a quick analysis on that one.
All right. I think there's a minute to go for the, not minute, a few. Let's just quickly have the rupee up first, please. Rupee is open. There you go. That's what I'm talking about. Dollar rupee, 1.25% higher on the dollar rupee. You know, 93.58. Basically, the rupee is stronger and the dollar is weaker, as was expected. It's a full 120 paise appreciation on the Indian currency. So this is what we're talking about. We should actually have this up at the bottom of this. Yeah, have this up at the bottom of the screen. I think this would be one of the largest appreciation moves in the recent past. And this is coming in a very, very sharp way. So we'll just stick with the dollar rupee rates here. I think 1 month forward rupee in the NDF market, we're getting rates as well. Expect a large difference between the onshore rate and the NDF rate as well. And I think we are, yeah, so that is 94.45 in the NDF market. And this is 666 or so at this point in time. So banks would basically sell dollars here and cover their short positions in the NDF market by buying dollars. So forced reversal of trades because of what the Reserve Bank of India put out as a circular on Friday evening. We'll have Jayesh Mehta joining us on this in just a bit, but maybe just quickly, if we can run through the trading ideas, maybe hitting all things a little later because of the volume of news flow. Sudarshan Sukhani is with us and Shrikant Chauhan is joining us today. Gentlemen, good morning. Good to have both of you here. Sudarshan, so on the Nifty, I think from the time we started at 8 o'clock, there's already a 100-point lift in the GIFT Nifty because of US futures jumping up a little bit. But what's the setup and how would you trade it?
Yeah, good morning. The setup is, let's look at the GIFT Nifty. It went down to touch and then test the lows that we have made earlier in the Nifty. That was 22,450 approximately. So while the GIFT Nifty is not really representative, there is a sense that the lows were touched, tested, and then there was a bounce. So as far as today is concerned, we are looking at to buy the Nifty with a stop at 22,450. Now, the exact entry point will have to be different depending on how the market opens. But the buying theme persists. Then we have year-end expiry, then monthly expiry. So today should be a day to buy with a very clear stop loss.
Okay, buy today with the Nifty headed towards 23,450. Is that the target, Sudarshan?
No, the stop loss is 22,450. I don't.
All right, okay. But buy is the call right now. Shrikant, what would you go with?
Good morning, Rima. Good morning, Prashant and everyone. So for Nifty, it is showing a lot of weakness. It closed below the mark of 23,000. It is forming lower top, lower bottom series. So all these things indicates that market is going to remain under pressure. And it is better to stay away from taking any specific view on Nifty. It is better to be more on the stock specific side because it's a quarter end and yearly closing, also financial year closing. So we may see some stock specific action in the market. But for the Nifty, we are of the view that now it is heading maybe below the levels of 22,500 in the near term. So at higher levels, we need to be very, very careful in case if there is any bounce back because of this particular news flow, we should look for reducing some long positions.
Trades, Shrikant? Stock trades?
Yeah, so I think, because of this particular developments, we can expect, and the news flow which are there in the market, we can expect some activity in sugar stocks. So in that, we like Dhampur Sugar, Balrampur Chini. From the defense space, we like Bharat Electronics because there is specific news flow on the defense side. Bharat Electronics was around 470. From there, all the way it is at 400. So from here, entry looks quite, the current prices looks quite reasonable to enter into long positions. With a stop loss close to 390 on the downside. We like Balrampur Chini on that already. I said that it is maybe heading for the levels of 550, 560 for sustainable run-up. And we can keep stop loss around 480 for creating any trading long positions. But for shorting, I think bank stocks looks weak. There we can expect further more weakness. And in that, IndusInd Bank looks weak. Currently around it is 790, 800 sort of levels. But the stock can fall to 750 sort of levels.
Yeah. Sudarshan, what about your trades?
Well, Federal Bank is a buy with a stop under 265. Lupin is a buying opportunity with a stop under 2290. Ashok Leyland is a short with a stop above 165. And Bharat Dynamics, BDL, is a short above with a stop above 1155. All these levels will have to be adjusted depending on how the markets open. But broadly, they should hold.
Okay, thanks very much, and we'll chat again. Thank you for joining us, Sudarshan and Srikanth. Jayesh Mehta, Vice Chairman and CEO at DSP Finance, is with us. Jayesh bhai, good morning. So there's a 1% appreciation in the rupee, as I think was expected. Now the question is, will this hold? Will rupee at whatever 93.60 or so? Is that the new normal, or what's your sense?
We still have other outflows, but at least what this will do is make RBI intervention quite effective, because what was happening because of this arbitrage allowed between onshore offshore, a lot of intervention apart from the normal trade, normal FPI outflows and all of that, it was also going to the offshore traders, right? So from that perspective, that bridge would be broken, which is required in this kind of situation because we are still not a convertible currency.
And it is, as we are flashing, the difference between the onshore rate and the offshore rate is quite large now. That is to be expected, right?
Yeah, it went up to 1 rupee difference. It came down, I think, now around maybe 80 or so. But yeah, it will pan out over the next few days. But yeah, that would remain wider. Maybe eventually, just like before this was allowed, it was like 40, 50 paisa or something like that. That kind of difference would remain going forward. But at least this unwinding, we don't know how it pans out. But the fear market had like it would go to 1.5% or 2 rupees or something like that. That's not happened, which is good actually for people to unwind if they have.
Okay. What would be the overall unwind which is required right now, Mr. Mehta?
They have been given time till 10th of April. Of course, there is a lot of representation to let it expire and all that. We don't know what RBI does, but at the same time, from today to 10th, whatever long they are onshore, they will have to sell it, and whatever short they are offshore, they will have to cover it, or let if there is an expiry coming in between or something.
Mr. Mehta, that's on the timing bit, which is a little unclear because the RBI has asked for some relief. But in terms of the net open positions right now, how much needs to be unwound?
Everybody's guess. The market is guessing from 20 to 40 billion dollars, and then the safer way is to take 30 billion, because I don't think these are all confidential data. So people really don't know, but this is just estimate of the people. Okay. So that's what people are taking soft at 30 billion or so.
Okay, and do you think the reprieve that we're seeing today is temporary?
No, the relief. Again, I think that unwinding will happen, then onshore will dealing 2 by 50 paisa. And then, of course, whatever happens to oil, war, we are not out of woods, right? But at least the intervention by RBI will be more effective.
Jayesh bhai, on this circular came Friday evening, right? Offshore was still trading. So the people would have covered that leg, no? On Friday, somewhat, depending on how much liquidity is available.
Yeah, because it's late 8 and again only US open and stuff like that. Some people did cover, but I think it was not dramatically much, and it was not even known. So it was like 40-50 paisa, it widened to 40-50 paisa. So that kind of thing, some people were able to cover to 40 to 60. It went up, and then of course today morning it went to 1 rupee 20 paisa or so. Now down to below 1 rupee onshore offshore. I don't know what it is exactly right now, but yeah, it is moving continuously by the situation.
So the cost of hedging also goes up now on account of this volatility. What are the implications of that?
Sorry?
The cost of hedging would also go up, right? Now because of the volatility?
I can't hear you.
All right.
Sorry.
Okay, we'll...
I think we'll come back. Jayesh bhai, thank you very much. Appreciate it. You, of course, ran operations at BOFA for a long time, and you've seen much of this over the last 30 years or so. So good to get this perspective. I think, what we can do is we can move on to our next set of guests. And 4 minutes out, by the way, for market open. The pre-open is settled. Let's just look at the rates quickly. The Nifty, it's down about 260 odd points, 270 points right now. 550. 22,550 on the index at this point in time. The dollar rupee is also settling down. I think it had a bit of an overshoot right at open at 9, but now 93.94 is where we are at. Well, we have the top team at UBS right here with us in the studios. Gautam Chachoria is head of global markets at UBS. Tanvi Gupta Jain is chief India economist. And Divya Nagarajan is head of India research at UBS India. Gentlemen and ladies, thank you very much for joining us. Really appreciate your time here. And good that you guys could make it here in the studios. Tanvi, the rupee thing, what's your view, Tanvi? I mean, lots of reactions. We had Mr. Khara, formerly with SBI, and we had Jayesh Bhai and Abhizar, etc. So the point that he made is, Jayesh Bhai made towards the end, is that this makes RBI intervention in Forex markets because it'll be required, much more effective. The money, the dollars are not going to the hedge funds anymore, but to finance trade and real stuff. So just your thoughts.
Absolutely. I think the INR remains the biggest focus right now. I mean, we did see on Friday the measures being announced by the RBI, but we think it is a very temporary respite to INR. We still have for the June quarter, INR view is still 95, so we are not expecting any sharp appreciation from here. Whatever you are seeing today, some currency appreciation or some support to currency, it's very, very temporary. What we realize is the biggest challenge from an INR perspective is not only the level of current account deficit, but the funding concerns. And I don't see any quick respite on that. I mean, we are seeing FII outflows has been quite significant. FII debt has been muted, and overall FDI flows are not enough, especially the net number is definitely not enough. So we might be staring at one and a more year of a balance of payment deficit. I think what we realize is that when we compare, and a lot of investors I'm talking to are comparing it with the 2013 taper tantrum, but the difference this time around is that RBI has still a lot of policy steps that they can do to ensure that a free fall in INR could be contained. For example, if I look at past, I mean, we can announce a bilateral swap window for the oil importers. That could be one step. Maybe some curve on gold, maybe some view about raising NRI deposits. So I think there are ways to manage the currency weakness. But near term, I think the entire focus is on de-escalation, if at all. That can even be hoped for. But otherwise, we think that the depreciation pressure on INR is likely to stay.
Let me just get a quick read-through from all of you. Divya, if I can ask you, across companies that you speak with, right, how severe is the disruption on a scale of 1 to 10?
It's right now still a question of where supply of natural gas is being impacted. So you would have seen where there's a cluster which is dependent on that, that's gone down, or utilization has dropped in things like fertilizers. But across sectors, I think it's still very early. I think there are fears being priced in, but are we seeing anything on the ground yet? I think it's a little too early to see that.
Okay, all right. Just taking note of market open, and then we'll get Gautam into the discussion as well. First rates are coming through. And it is 22,590 on the Nifty, 51,474 on the Nifty Bank, and more rates will come up on your screen. What do we have? The mid-cap index is down 1 1/4, about 700 points lower. The small-cap index will come up. That's also should be down on similar lines, about 1.5% down. 1.8 actually on the small-cap index. So 340 odd lower on the Nifty, 22,490. Let's look at the Nifty heat map, how things opening right to the word go, and then we will look at individual names as always. I think bulk of everything should be in the red, and the heat map will give us a quick sense of that. Many Nifty names are at the bottom of the screen: Shriram Finance, Interglobe, L&T, etc. If you can have there you go. Hindalco is up, so there's a bit of a lift on aluminum prices because of the disruption in the Middle East and one of the facilities. ONGC is up a little bit, but otherwise 48 out of the 50 names are starting in the red in varying degrees. Rima.
Well, the low today in the morning was 22,472, which exactly coincides with a recent low of 22,471. But we're still hovering precariously close to that level. It's now 22,500, straight away down more than 1% at opening levels. Today is also the March monthly expiry, and it's also the year end, so you could have some amount of NAV propping that comes into play. Well, now some more gainers have been added in, so it's Hindalco right on top. Let me start with the gainers list, fewer. Hindalco is up 2%, but buying is visible in NTPC, Coal India and ONGC. So 4 PSU stocks in the green. On the way down, Banks are getting hit very hard. The Nifty Banking Index is opened with a downtick of 1,300 points, 2.5% lower. Axis Bank, Kotak Mahindra Bank lower by 3.5%. HDFC Bank is down 2%. There was an upgrade on HDFC Bank by JP Morgan. They upgraded it to an overweight with a target price of 1,010. They're saying the bank's valuation is at 1.5 times price to book. If you look at the parent company for FY28, following the correction, and it's underperformed the peers. So the discount versus ICICI Bank is also at the highest ever level, but that's still under pressure. So banks are getting hit. Yeah.
One thing, HDFC Bank, from what I remember, right? I mean, their activity or participation in this kind of thing is very low. I mean, out of the private sector banks, it'll be very, very low. ICICI would be higher, others would be Indices, etc., were higher at one point. So I don't know if this is HDFC Bank is under pressure because of this, but just in terms of sheer exposure, should not be that much.
Okay, so that's about banks. So banks are getting hit hard. Autos, that's the other sector under pressure. You've got Tata Motors as the top loser, 4.5% down. NBFCs like Shriram and Bajaj Finance are weak in trade. Trend consumption has not been spared. So Tata Consumer, Eternal, Trent, weak in trade. And pull up some of these IT names. IT is opened up in the red, but the gashes are not as deep. So we've got about 1.5% downtick for TCS.
Well, Rima, today's low and last week's low is actually pat on, 22,470. That's the low that we made last Monday, and we saw a bit of recovery from there. Today, the cues are very different, but the hope is at least we hold on to that level. The India VIX, that's the one that's perked up. Remember, last week it cooled down all the way to around 20. That's on the verge of actually moving to around 29 odd, and that's not a great sign from an equity market perspective. You want the India VIX to cool off. Very few winners, but let's highlight a few. KNR Constructions, they have won 1,700 crore. NHAI road project in Telangana. So that's one stock, in fact, that's bucking the trend today. Nalco, that one's well placed because aluminium seems to be in a bit of a short supply globally. The Middle East accounts for around 9% of the total global supply, and they're bulk exporters. So because of that, supply in the global markets could go down. And for Nalco, they don't get hit by higher power costs because they get most of their coal from captive sources. So that's why that's outperforming Hindalco as well as Vedanta. The core aluminium play, stock up close to around 4%. EPL is another stock that's up close to around 3%. They've announced a merger with Indorama-backed Indovidia. So that's why that stock as well is higher in today's trading session. Very, very few winners, but those are a few of them that I could get on the list. Tata Motors CV, there was a rebalance that took place in Friday's trading session, the final 30 minutes. So that's giving back what it put on. Grow is coming for some profit taking, falling on rather large volumes. That's down close to around 4%. And you have Axis as well as South Indian Bank, both of them under some pressure. Only 400 stocks are advancing. Hopefully, by the time we end up, that number will be higher than where we start off with.
Okay, all right. So that's the market open for you. And this is lower as expected. So Tanvi, of course, is with us, and Divya is with us, and Gautam is with us. This is the top UBS India team. So Tanvi, Divya was just telling us that the impact right now is being priced in, but actually in terms of industries being disrupted because of shortages, it's not. I mean, it's not widespread, Divya. That's what you're saying, right?
Yes, it's too early to assess the extent of damage. And I think, as Tanvi mentioned earlier, it's a question of how long we take to de-escalate. Because the longer we do that, I think the longer
the perceived, I mean, all that becomes real in that sense. Gautam, your thoughts? Just top of the mind, top-down kind of thoughts on what's happening, and how is this likely to play out from a impact perspective?
So again, duration of disruption is the critical missing piece, which none of us are experts to make a call on at this stage. But the only hope which many of us and in the markets derive is that one of the common consistent comments coming from the US administration has been that we will not repeat earlier situations of a prolonged presence of war. Now, whether they stick to that or not, we don't know. The second point on that is the definition of prolonged. The kind of situation we are in, even a 3-month to 6-month issue could be quite damaging, both for global growth inflation as well as for India. So the timelines are very different. We're not talking about years, even months is going to be bad. Okay? So you have to keep these things in mind, and therefore the way we'll put it is talking to investors, the tail risks of this being prolonged for months is still not priced in. And there are asset classes, or even in the Indian context, rupee is one which we mentioned, where this could show up much more clearly. So even though the rupee has moved, the tail risks are still there around the currency. Okay. The Indian markets, look, to some extent, the local flows are helping very clearly. But look, the retail is also kind of at the stage where their books are not necessarily looking attractive, and they start seeing red. and how they behave is still early. They have been quite mature. So the answer is duration, like how long this lasts. At levels wise, this is a level where India bounced back from last year. On a headline valuation basis, this is where in the last 10 years, Indian markets have largely bottomed out on a forward valuation basis. But again, just to put things in context, before 10 years, if you go back to the taper tantrum era or even before that, these are the levels where market used to peak at. So the paradigm also changed because of the local retail flows. But this is an interesting level. And we are seeing some investors, a very small minority of investors, willing to take contrarian bets also. Contrarian bets, not just defensive bets, but contrarian bets, but very small. So again, it will be news flow driven, if I have to just let it out like that. The way every overnight situation develops, that's how markets will react. For long-term investors, some would start dipping in here, absolutely.
But Divya, on the E of PE, right? Gautam was just talking about the valuations. Interesting. But the E of PE is also going to get compressed on account of the inflationary shock, etc. Or Gautam, if you want to come in on this, are valuations really cheap, according to you?
So again, if I just add in, like E will get hit. And depending on the duration, the E hit can be meaningful. But the question is the base case earnings capability of the Indian economy and corporates. Does that get hit longer term or does it a one-time hit? So if it's just supply chain driven hits, it'll come back fairly fast. If it leads to oil remaining higher, so the key debate is oil, where does it settle after this disruption? If oil remains at 100, 120 for a prolonged period, then E will also get damaged for a longer period. So that's a simple way to put it.
But Divya, what's the extent of the earnings cut that you see in the base case and perhaps a bear case?
So I think, again, it's going to be very sector-specific, very company-specific. The way I would characterize the situation is that pre this conflict, we were at a position where it looked like growth had bottomed, and inflation had bottomed as well. And we were therefore looking at a possible early cycle recovery for the country and for the markets. Now, the real question here is that, as Gautam said, there is going to be an earnings hit. But at this point, I think we have three scenarios, right? The first scenario is that it de-escalates this week.
Hopefully.
The first scenario, yeah. The second scenario is that it takes a couple of months. The third scenario is that it goes on longer. In each scenario, the oil price impact gets asymmetrically higher. The impact on global GDP and inflation gets asymmetrically upfront. So the base case scenario, we're probably looking at a 50 basis points or 60 basis points global inflation risk. But at 150 to the oil, it becomes 190 bips. So the longer, and I think to go back to Gautam's point, we could put out a number now, but the number would essentially be dependent on how quickly this de-escalation happens, because the risk is asymmetric on the downside.
Okay, all right. I hope if Mr. Trump has to say something, he does it during the course of the day itself rather than wait till post 3:30 p.m. like we saw last Monday. That said, Tanvi, let me come to you then. What are you penciling in? You told us that the rupee you're penciling around 95 odd. How much have you scaled back your growth estimates because what has taken place? What about the deficit number? Sure. How much has it widened in comparison to what you were working with earlier? And the RBI, do you think that rate cut hope is now out of the way? Do you think at some point of time we see a rate hike?
Okay, so very valid. So we have still not revised our GDP growth assumptions downwards because we're still working on scenarios. As Divya mentioned, 5-week, 2-month, or an extended oil disruption scenario. But I can give you the numbers. We are right now at 7% real GDP growth forecast based on oil at $75 a barrel. Oil at $100 a barrel, which basically means a 2-month disruption. My GDP growth is 6.3%.
So 70 basis points.
Yes, okay. And oil remaining at more than $120 a barrel for an extended period, GDP can go even as low as 5.5%. Okay. So that is the asymmetric impact we are going to see on the growth. On inflation versus our 4.3% in our base case, we are seeing inflation can clearly cross 5% depending upon the extent of pass-through. I mean, we have been seeing that the government has cut the excise duty on gasoline and diesel, so basically have shielded the consumers so far. But if the disruptions are going to last longer, I'm definitely expecting some partial pass-through to retail prices post-elections. 9th of April, when the 2 state elections get over, in between, I would expect some partial pass-through to retail prices for households. And the third is what it means from an overall macro perspective and the current account deficit perspective. So far, we have not really seen demand destruction directly. Yes, there is outside of direct price pass-through where we are seeing that even in the informal global market. The prices have gone up. The cost of production is going up. Gas shortages is very acute. Companies are facing, limited supply. The supply chain capacity is getting affected. But if that situation is going to last longer, I think we really need to see what RBI can do. And I think the biggest challenge what we started during this conversation is current account deficit and external financing from an RBI perspective. Even if inflation goes up, and the starting point of inflation this time is very low. We are staring at a number, maybe 3% inflation, and the current monthly number goes back to 5.5, which is okay. I mean, we are somewhere between 4 plus 2% as the inflation band on the upper hand. But I think the biggest concern is the funding of your current account deficit. And just to give you some numbers, when 2013 taper tantrum happened, we were a much smaller economy. You raise NRI deposit, you do some import curbs, you were fine. You were able to stabilize your currency. Right now, even before the oil shock happened, we were staring at a current account deficit of $60 billion. And with this oil remaining at $100 or more, it can clearly double. At least more than $100 million could be your current account deficit. So either I'm able to do some demand destruction so that my non-oil, non-gold import can get curbed, or I need to figure out ways to fund this current account deficit if the situation is going to last longer. So in terms of numbers, current account deficit in my base case is 1.5. That can clearly go well above 3% of GDP depending upon the extent of duration of this overall oil disruption.
And the point is that the rupee, when we talk about the rupee hit, etc., right? I mean, I think a lot of Asian countries have surpluses, right? I think at one point, two months back, I think everybody had a surplus. Some of these countries, because of whatever, chip exports and things like that, North Asia. So in that context, I mean, the rupee gets hit. I mean, it all kind of sort of ties in. It's all relative, and maybe that's the reason why we've had a bit of a hit
here.
So
let me add to this. It's always relative, and we have seen INA underperforming even last year, right? Because we have a forward book which is already at $100 billion. So when you see the headline FX reserves number of more than 700 billion, and we say we have 11 months of import coverage, ideally you should adjust it with the forward book and even adjust it with gold. And then you will say that we are staring at a FX import coverage ratio of maybe 8.5 months.
We do typically adjust it for gold, ex-gold also, but why should we do it?
I mean, ideally we should not, because we can always use gold to fund our, current capital account. But I'm just saying, on a foreign currency asset basis, adjusting for a forward book, you're still at 8.5, 9 months of import coverage. Market seems to be pricing in, at least OI's curve is pricing in 4 rate hikes by the RBI in the next 2 years. It is not next 12 months. I think I would say the bar of a rate hike at this point is pretty high, because we still have a lot of tools available by the policymakers in trying to prevent, and try to support growth and try to prevent a very sharp weakness in the currency. I mean, RBI policy is now overdue. So let's see what and how the RBI is going to look at things.
Okay, all right. Gautam, let me get you back into the conversation. That you mentioned a small portion of the investors you interact with, they want to do the contrary thing. That is, go ahead and, dip into the Indian markets. We didn't party big time on the upside. Indian markets underperformed. Do you think, going by the valuations that have come down a little bit, we went through a period of underperformance. FIs are underweight the Indian markets as well, relatively. Do you think Indian markets at least could outperform from here on, or you believe that, we continue to underperform?
Look, firstly, our EM strategist has been underweight, still remains underweight.
Okay.
So that's our official published view from a research perspective. Talking to investors, I don't see any early signs from global investors that they will look at India as a contrarian trade. Still very early days. So when I say contrarian stock picking, it's more from the domestic investors, less from the global investors. For India to outperform, I think one of the key ingredients beyond the situation or war in Middle East would be currency. Okay. And currency, look, the worst possible things which can hit Indian currency happen all together. Not just last 1 year, but even last 3 months. And even if 1 or 2 things change, currency could change very fast. Like, it's a very consensus view right now, rupee will keep on depreciating. But if any of these things change, that will get possibly the FPIs to come in as a tactical trade. From a more fundamental perspective, the things which were constraining India, which were relatively slower growth and rich valuations, absolute and relative, they still hold true. I don't think that's changed enough for them to come back in a hurry and be overweight India. Still early days.
Okay.
Just to add on to that perspective, I think the reason we've been underweight from an emerging market perspective on India is that what's been driving in emerging markets is essentially the US AI trades, which India has lacked. So at this point, I think our current view is that we don't see at this point this situation still risking the US AI trade. So as long as that view holds, I think that's the reason that the emerging market view is underweight.
9:50, we've got a discussion, guys, coming up with Saurabh Mukherjee, who's written a book. It's called The Crisis of the Middle Class and the Future of Work. And it kind of sort of ties in with that lack of AI or whatever you want to call it, right? I mean, but in India, I think it's been debated quite a bit. But Saurabh's looking at it from a different point of view, which is, I mean, what's going to do to jobs, purchasing power, spending, consumption, etc., etc. So those are kind of longer-term issues, right? Which you
Yes,
got to...
indeed. And I think for IT services, which is a large part of the index in the market, I think that's a very pertinent question. Or IT services analyst Aditya Chandrasekhar, he just put out a very interesting, what we believe will be a lead indicator kind of a framework, which he calls vector. So this basically looks at multiple parameters. Key outcome would be the revenue per employee, so to speak. And hopefully this gives us a lead indication of how companies are preparing for this onslaught. There are two scenarios here, right? On both extremes. One extreme, you could go to a scenario where, like the cloud, companies adjust and then come back to good growth. The other scenario is that everything goes south. It's true, again, the technology itself is in infancy, too early to tell, but we believe that our vector framework, as Aditya puts it out, could be a good leading indicator to track how this plays out.
You looked at IT very closely before Aditya took over. You want to tell us which side you're leaning?
It's too early to tell. All I can say is that this technology is advancing by leaps and bounds. I like to say that Salesforce was incubated in 1998, right? It took us till 2015 for us to start seeing impact on a real world basis from a B2B perspective. Today, I think the pace at which AI and generative AI has been adopted is much, much faster. But beyond that, like I would say, every technology goes through a hype cycle, and we are in early stages of that hype cycle for some parts of generative AI. But I think the technology does hold a lot of promise.
But do you think that the Indian markets have reacted too much to being, missing out on AI? They pulled back too much. Do you think it got a little bit excessive?
Well, I think the pullback, and I think Gautam and Tanvi can add to it, is more a function of the fact that it was a PE versus earnings story that really didn't match us, right? I think it's more in the last 6 to 8 months when the AI trade came back. And I think, again, when I talked about the early cycle, Bhanu Bhaveja, our global strategist, was here, I think, last week. And he spoke about how the entire US market was also in an early cycle play, right? So we were seeing money flow into emerging markets. And a lot of that went into AI trades. So I think we did miss out from that perspective. But I would say a lot of what's happened with India in the last 18 months has been the fact that earnings and PE have been a little bit out of sync with each other.
So Gautam, since UBS downgraded India to a neutral very recently, and this came after 18 months of a time correction and 15% correction from the top in terms of pricing. What should Indian investors expect from the Indian market, say, till the end of 2026 or 2 years down the line?
So look, from the downgrade possibly is a different part of UBS than what we represent.
Correct.
But having said that, from investors' perspective, the key as this Middle East thing, the expectation was that things were bottoming out. Growth was picking up, inflation was under control, valuations are gradually getting more reasonable, at least in terms of time correction and versus relative recent history. So those things were in place. But look, this whatever has happened in the last 3 months has changed that discourse. So it's tough to make a 3-year view right now. The tail risk of this being a prolonged war thing, I think that scenario will come back in a year again from now. I don't know if it'll come back in 6 months or not, but in a year from now, all the building blocks for things to bottom out should be back. Okay? But if this prolongs, then all bets are off.
But even based on a 5-week impact so far, do you think the lingering impact on the economy will last for 1 year till the end of this year, which means basically it's hard to see any kind of return for this year?
It's just 5 weeks. Unlikely. They'll get normalized very, very fast. So again, the question is, in this scenario, we're talking in terms of weeks and months, not years. Okay? Even a few months is going to be damaging. Till now, whatever has happened can be course corrected fairly. Because look, 5 weeks or even say 2, 3, 4 weeks for the global economy, for India also, there's been enough, we're still living off enough inventory in this system, okay, which we're preventing enough damage in the immediate term. But at some stage, the inventories run off, and then the real damage starts. And then how much of an impact is, then we have to analyze how much capacity is off the system because of damage to the capacities in the Middle East. There's no real authentic analysis done till now.
We've all become closet geopolitical analysts, right?
Absolutely.
So let me ask you, let me do a straw poll. Gautam, 5 weeks, 10 weeks, longer? What's your...
No,
5 to galat ho gaya. 10, 15 longer.
I would draw my hope from the consistent statement coming from the administration that they will not be here for long. But again, tough to predict.
Keep the faith, yeah. Tanvi?
I would hope April end, we start seeing some good news.
Divya?
Like I said, I'm not a geopolitical strategist and I can't claim to understand the powers that be and how they think, but I would also hope for an early resolution. I think at least hopefully the second scenario that we have rather than the worst case.
Yeah.
So April, was what I'd hope for.
In terms of published stocks across your coverage universe, Divya, are there stocks already at, irrespective of how long this goes on, actually not irrespective, maybe that's the wrong way to put it, but are there things to do, enough things to do?
So I would say tech is the obvious place where valuations have corrected to pre-COVID levels. One would be very optimistic on the near-term earnings because of currency. However, I think investors are very, very worried about what AI does to the sector. So I think the real question will be that even if earnings in the near-term surprise, which they have in the last 2 quarters, will it be enough? But it's on a valuation basis cheap. The other place is banks, as we discussed, but banks, I think, have some near-term challenges to overcome. But again, valuations, especially the large private sector banks, are cheap relative to their past averages. But I think there are pockets, I would argue that if we had not seen this conflict play out, we were in an early cycle kind of a scenario where some of the mid-caps could have looked very interesting. But I think at this point, we'll have to wait and see how that plays out. So if we are in an optimistic scenario where this quickly goes away, then the cyclicals could come back. I think our industrials team was talking about short cycle plays, actually, where the cycle ordering cycle was starting to show some revival. That could come back. But I think at this point, everybody's waiting before they jump in with both feet.
Well, I think we'll leave it there. Thank you very much for dropping by, all three of you, Divya, Tanvi and Gautam. Appreciate it very much here on CNBC TV 18. Well, I think that is the view coming in from the top team at UBS with perspective across a range of subjects, and we'll get you more of this as we go along. Thanks, guys, for joining us. We'll take a break. We are back with the management of IRFC, and we'll discuss their 12,800 crore rupee loan deal with Hindustan Urvarkar and Rasayan for debt refinancing. Stay tuned. A conversation with Manoj Kumar Dubey coming up next.
Welcome back. It's a pretty smart recovery underway, nearly 200 points from the day's low. We're still down about 140 points, but significantly off from the lows. Stocks which are leading it on the way up: defense, BEL has moved up nearly 2%. Reliance Industries has climbed higher by 1.5%. And consumption names like Titan, HUL are also now back in the green, erasing the early morning losses. But let's talk about IRFC. That has signed a signed a refinancing agreement for up to 12,800 crores with HURL, Hindustan Urvarak Rasayan Limited. Manoj Kumar Dubey, Chairman and MD of the company, is now joining in. Thank you very much, sir, for joining in. Tell us a little bit about this joint venture with HURL. What exactly is HURL? And what are the terms of this agreement with you all? And why is it significant for a company like IRFC?
So, good morning, Rima. Thank you for tracking us. So, before closing the FY, this deal happened just last week. HURL is already working fertilizer company, which is promoted by three of the giants of CPSCs, that is Coal India Limited, NTPC and IOCL. So that all three Maharatnas are promoting it. They are already doing business. Cash flow is already positive. So we did the whole, we took over the whole loan portfolio of theirs, and we disbursed around 12,000 crore on last Friday. So this deal is in line of what we started right in the beginning of the FY, where we promised of funding anything which is having a linkage with Indian Railways. All these three factories, that is at Gorakhpur, Sindri and Barauni, are linked to the railways, and all movement of fertilizers are taken by the railways. So we did this deal. It is a very good deal, and the asset quality is top class, being promoted by three of the Maharatnas. And we are making a very decent profit also out of it.
What are the NIMs, sir? The net interest margins on this particular transaction?
As I always mention you that we are working now in a margin of 100 bips to 125 bips. So this particular deal also will land up in between that, which is again nearly 3 times of what we used to get from the railways.
All right. Hi, sir. Morning. Good to see you in. What about the cost of borrowing? You know, you're saying that the NIMs is similar. How does it change?
That's a very interesting question, Nigel. So, you know, we raised back-to-back 2 ECBs also for 5-year tenure in yen. And I'm very happy to share with you that with its very conservative hedging, the rates have come down to 5.80%, which is very good for us. And when we started the financial year, we set ourselves a target that our cost of borrowing should be near about or below G-SIC rates. So I'm very happy to share with you that we have achieved that, and we have got an excellent deal in ECB market. IRFC always garnered the best of the rates, and the trend continues. During the very turbulent times, we entered into yen market, and I'm very happy to share that with the hedging cost also, we have landed somewhere around 5.8 to 5.9, which is very good rate. 54 EC bond and deep discount zero coupon bond also, we got very good rates and very good market share. All taken together, our cost of borrowing for the whole year, which is we have raised more than 45,000 crores. It is all hovering around 6.5, which is something which you always aspired for.
Okay, all right. How do you see things scale up from here on, sir? In terms of the book increasing, what are the targets, disbursements? How do you see things going ahead? Given that we have a pretty challenging economic scenario that could play out for the coming few months. So in FY27, what are the targets you're laying out?
So, Nigel, for us at IRFC, we believe that the challenges before the geopolitical upheavals that took place were a galore when we started the FY. Because, the traditional single client business was not coming for the last 2-3 years. So we embarked on diversification, and now, as you know, we are ending on a very high, crossing our targets of sanctioning of assets, which was 60,000. Now we have done more than 75,000. And in fact, another 15,000 crore, we are already L1. So it is a complete comfortable situation so far as pipeline is concerned. We set ourselves a target of disbursement of 30,000 crore, which we have exceeded by margins. We have done more than 35,000 crore. Now the pipeline is there, and next year we will be heavily going into the metro business also. We believe that despite the geopolitical situations and the things going around, our business model and India's infra growth story remains intact. And this is not for a year or two. I mean, FY27 also, we are already completely grooved into what we need to do in Q1, Q2, Q3. So there is a lot of clarity in the businesses that we are going to get. And I can only assure you that last FY, our disbursements picked up only in H2 because there was no pipeline. This year, rather, we are in a very comfortable situation, as we know that what disbursement we are going to do in Q1, Q2 also out of our pipeline. And we are also aware that the businesses that we are only negotiating where disbursements will be taking place in Q1, Q2. So overall, I believe that IRFC is going to have a better scenario and a comfortable scenario going forward in FY27.
Okay, all right. And what about the segmental mix? You all were looking at, moving a little bit away from railways. How do you see that pan out?
So in fact, the whole mix will be going to in fact expand. As I mentioned to you, this year we focus on SPVs of the railways, siblings of the railways. We did DFCCIL, we did Angul Sukinda. Then we focus on power value chain who are serving to the railways in Gencos mainly. We did one Transco and many Gencos. Then we did businesses with the JVs of Maharatnas like NTPC, IOCL and GAIL and Coal India. So these were our cherry-picked Maharatnas was JVs we funded. Next year, disbursements will be seen in the arena of ports promoted by government and metro railways and rapid railway in a big way. Apart from that, Nigel, you see, Railways has already announced one more dedicated rail freight corridor between Dankuni to Surat from east to west and 7 high-speed rail corridors. So these together require around 2.5 lakh to 3 lakh crores of investment in next 5 to 7 years. This is primarily our business. Things have started moving in a faster manner. This will be our long-term 5 to 7 year businesses on the platter. But the areas where we have already started funding and the areas I mentioned to you, port and metros, taking all together, multi-model logistic parks also, 27 will be having more broader kind of sectors where we'll be funding, all having linkages with the Indian Railways. So that is how things are going to unfold in next FY for us.
Okay, so thank you very much for joining in. For the markets, as we highlighted, it's been a 200-point recovery on the Nifty from the lows. For the mid-cap index, it's been a 500-point recovery, still down 1%, but significantly off the low. Sugars stocks are racing away to the top. Dwarkesh Sugar 12% up. Sri Renuka is up nearly 7%. Bajaj Hindustan moving up on large volumes, 4.25% higher. Chennai Petro, MRPL, two other names which deserve mention for the kind of up move and pretty good volumes. An urban company, which Manglam was telling us, InstaHealth is scaling up pretty well. Stock has moved up 3%, large volumes relative to what it normally does in the first 1 hour. But let's talk about IT, because it's been now nearly 2 months since Anthropic's Claude update sparked fresh doubts about the the industry's long-term relevance. Now, earnings season will kick off with TCS on 9th of April. And the big question now is, has the pessimism gone too far? Here is a compelling perspective that we got from Christian Klein, who has been the SAP CEO. He's led SAP for over 5 years. And his message is very simple. Long live software. He believes that software is not reaching the end of the line. It's only getting started. And the winners will not be the ones who own marginally better LLMs, foundation models. He's saying AI is making software faster and cheaper to build. Large language models, according to him, will be commoditized. Building an AI agent is now the easy part. The hard part is actually making it work inside an actual business and scaling it up with full control and compliance. So according to him, the winners are not going to be the foundational models which are marginally better, but winners will be those who deliver value at the application level. So he says we speak to so many customers, and every customer wants AI that deeply understands their own business, brings in that contextual knowledge, and can do it securely and reliably. So this requires integrated applications, harmonized business data, clear controls. And without this, AI, he says, operates in a vacuum, disconnected from business reality. And even if there is the smallest mistake, perhaps on the fact that the data is not clean, if you use outdated, incomplete or incorrect data, it can actually result in big wrong decisions. And therefore, he says that if AI has to deliver real results, it needs 3 things: deep business knowledge, clean, reliable data, and strong governance. And this is where software comes in. He's like, software is now becoming the operating system for trusted autonomy. He ends the letter by saying that companies that recognize this will embed AI into the systems that run the world's economy. The rest will run more experiments, generate more prototypes, and they will wonder why the outcomes lag hype. So he's making a compelling case that software companies like SAP and the others, the SaaS companies, which have gotten hit very hard, will be the winners in this entire AI race.
Okay, all right. It's pretty apt that our next discussion, right, kind of sort of picks up on this entire AI story, but not just AI, and looks at the impact all of these new technologies and new trends will have on the Indian middle class. How much they earn and what they're able to spend. So this has got some deep implications for the economy and, of course, consequently, the markets as well. Saurabh Mukherjee is co-founder and CIO at Marcellus Investment Managers. Saurabh, in his new book, which is called Breakpoint, The Crisis of the Middle Class and the Future of Work, writes that Indian middle class has been thinning out. I mean, that's the book up on your screen. He says that, and it's a quote, India's middle class today faces its most vulnerable position since economic liberalization in 1991. And as I said, it's not just AI, but gaps in education, skilling systems, etc., which put this middle class out of touch with what the industry really needs. There's a fair bit of data in there. I mean, the idea, of course, I think has been spoken about for a while. And this kind of sort of, nagging feeling that maybe, just maybe, as we're all being used to, that, the lives of the next generation are always going to be better than the prior generation. Are we at a point where we need to question that? I don't know, but maybe Saurabh has the answer. Saurabh, welcome to the program. Thanks very much for joining us.
Thank you.
It's just that the book has come out at a time when everything is already down and out, Saurabh. So tell us, why did you write the book, and what was the aim and objective?
Yeah. So let me put it in a positive context, Prashant. What happened was, and in a way, it happened partly live on CNBC over the many years that I discussed with you our portfolio in India. Because ours was a consumption-centric portfolio, we could see at very close quarters the consumption slow down, right? There was a COVID, in a way, muddied the waters. COVID muddied the waters because post-COVID there was a bit of a bounce. But if you take a 10, 15-year view, whether it's of consumer durables growth or FMCG volume growth, the picture is pretty clear. When the Indian middle class was in its heyday, say 10 years ago, volume growth on most items that we used to buy and we used to discuss on your channel would be, say, 11, 12%. Those same products, the same companies' volume growth is now barely 2-3%. And behind that is the story you're narrating, that what we've discovered whilst writing Breakpoint is there's been a secular slowdown, a structural slowdown in white-collar job creation, which in turn is correlated to real wages for people like me, people like the people watching this program. Real wage growth has slowed down. What it presents for India, we think, is a very interesting opportunity, one that we are loading up on actively as we speak. We think the Indian economy will have to tilt from IT services and consumption-centric to manufactured goods-centric. The currency going towards 100 to the dollar, the free trade agreements, the West's suspicion of China, the Western economy's suspicion of China will, over the next decade, make India a manufacturing powerhouse. And our job in that regard has become pretty simple, right? Go to places like Coimbatore, like Surat, like Baroda, like Chennai, and buy good manufacturing companies at 15p or 20p. And as you said, everything's already keeling over. So valuations are no longer the challenge that they were 3-4 months ago. And I think this Sagar Manthan, the reposition of India from being a consumption-led economy to a manufacturing-led economy, that Sagar Manthan is upon us. India's economic model will pivot over the next decade, and we as investors are seeking to position ourselves for that.
Does the data bear that out? Manufacturing as a share of GDP, Saurabh, has remained, these are stats which we usually talk about around the time of the budget or, one of those things, right? It's kind of been remarkably steady. It's not really grown, although there's effort to make in India manufacturing, the PLI schemes, etc., are more than a few years old.
Absolutely, Prashant. Then manufacturing won't take off until the rupee depreciates meaningfully. The reason for that is simple. If you're exporting $250 billion worth of IT services, and you're getting another $150 billion of remittances from smart Indians living abroad, that $500 billion of foreign exchange inflow makes your currency stronger than it should be. And that in turn makes the life of a manufactured goods exporter very hard. But as IT services gives way for the AI discussion that we were having, right? As IT services growth takes off, as the remittances from our friends and relatives abroad tail off, the currency will have to give way. The currency will adjust pretty quickly. And as the currency depreciates, we are becoming competitive with countries like Vietnam, like Bangladesh. I think vis-a-vis China, we have still some way to go. But Vietnam and Bangladesh seem to be in our radar. And I think if the free trade agreements work out in our favor, China too could be on our radar 4-5 years out. So it is one or the other. We can't say we will have strong IT services growth and have strong manufactured services growth. The currency dynamics won't allow that. I think the more likely sequence is IT services growth slows down, perhaps starts degrowing, and that's when manufactured services growth takes off, with the currency acting as the necessary tailwind, along with the FTAs that the government is negotiating, plus the West's hostility vis-a-vis China.
Saurabh, two questions. One, why can't both, so IT doesn't go off the radar, but I mean, it's already been slow growth for a few years now, right? And it continues in that middling fashion. And export of manufactured goods really picks up. I mean, both can coexist, right? You said, well, it's that or this.
It's tough because, see, remember, our land prices, India's industrial land prices, Prashant, are a good 40%, 30% higher than Vietnam. In fact, our land prices in developed states like Maharashtra, Gujarat, our industrial land prices almost rival Europe now, right? So we've got expensive land, courtesy minimum wage laws. Our labor is also pretty expensive relative to its modest productivity. And finally, our working capital costs. Our working capital costs are 3-4x that of many other Asian countries. So given that our capital is so much more expensive, our land is so much more expensive, the only way our manufactured goods sector will take off is if the currency depreciates appreciably to give our exporters an advantage, right? So that's the piece which was missing for many years. That's the piece that the free market will deliver. It doesn't have to, whether breakpoint sells or not, right? The currency will give way, and a depreciated currency, like it did for China, like it did for Taiwan, a depreciated rupee will give the Indian manufacturing sector a leg up. And that's the Sagar Manthan, right? New centers of prosperity in Coimbatore, Surat, Baroda, Chennai will emerge. And the old IT hubs, say Hyderabad, Bangalore, Pune, they are bound to see some degree of economic dislocation as we go through this Sagar Manthan in our country.
So, in terms of talk about investment implications, Saurabh, you said we are moving and you're already finding attractive opportunities in these manufactured exports area. And I'll ask you which ones, but just one moment more on, because you do point out in the book consumption, which perhaps is at a risk. What does that mean for lots of things, which, I mean, the entire consumption basket, which is what the India equity story has historically been based on, Saurabh? And which are the parts which are most vulnerable if your thesis proves to be correct?
Sure. So I think, look, the entire construct around FMCG, building materials, which people like me itself built, right? People, investors like me with our books and our investments through the 2010 to 2020 period, where jobs were growing strongly, consumption was growing strongly. That piece did remarkably well. That piece is obviously now going to slow down as the white-collar jobs piece comes off, and therefore the valuation derating that we are seeing, both at the market level and at the consumer-centric level, I think the valuation derating continues. The reverse applies to the manufactured export sector. You're getting plenty of good companies at 15, 20 PE, which I think will re-rate over the next decade.
Yeah. So this includes financials, etc., as well, which is a large part. I mean,
Yes, I think the answer there is true. I think there is plenty of middle class lending which goes through the balance sheets of India's financial services providers. I think banks and NBFCs across the piece, I think we will see pressure on retail NPAs as the story plays out. As the dislocation of the white collar job sector plays out, I think we will see pressure on retail NPAs across banks and NBFCs.
Sorry, one quick question. The counter to the collapse of consumption, as seen with the numbers of, say, FMCG companies, staples, etc., is that the form of spending has changed. People are spending far more on travel, dining, experiences, subscription. So what are your thoughts on that? Isn't that also where India is spending now, which is not getting captured in, say, the numbers of the listed companies?
So again, if you see the numbers there, right? So let's take, say, airline ticket growth. We had a good 3 years post-COVID. We had a good 3 years, but even that piece has now slowed down as we get deeper and deeper into the white collar jobs slowdown, and the effects of AI on generalized employment play out. You're seeing even sectors like airline ticket growth, even that is coming off, right? So you're right to say there was some degree of experiential consumption which had kicked in. But as the debt burden, we have now the world's most indebted middle class. As the debt burden proves too much, and as we pull away from the post-COVID euphoria, by and large, across the piece, you're seeing a secular slowdown in consumption. There is nothing surprising in that, right? If you can't create white-collar jobs, and we can't as a country, we can't create white-collar jobs, you can't ad infinitum fuel consumption through people borrowing more and more. At some stage, the party comes to an end. And the beauty of free market economics is the free market does the adjustment for you. The currency conks off, the government steps in, negotiates good FTAs, and a new slice of the economy takes off around manufactured exports.
Yeah, yeah. So just you want to leave us with a few names, Saurabh? Which are these stocks?
Yeah, sure. So the companies that we've historically invested in for a fair while, and we're thinking of buying more if these share prices come off. So Divi's Lab in APIs would be a traditional name that we've been long-standing holders. The entire piece around pharmaceuticals, the ancillary supplying into pharmaceuticals, organic chemical companies, that ecosystem, I think will do very well. Divi's has a supplier called Acuitas. We've been long-standing shareholders there as well. These two are expensive names, but look for similar plays around CDMO, around APIs, and I think you'll find plenty of sources of promise there. Then the second area is auto OEMs and auto ancillaries. I think the EU FTA is a wonderful FTA, and I'm hoping that our investments in companies like Escorts, Kubota, like their suppliers should do well. And the third area is engineering products. We've become shareholders in LG Equipment and Triveni Turbines. We're hoping that LG, Triveni, and other engineering companies do well in the post EU and UK FTA format. There's plenty there for us to play for as the EU and UK FTAs kick in next year.
We could go on. It's an interesting chat, Saurabh, and we'll probably have you back to pick on some of the specifics as far as this book is concerned. Thank you very much for joining us. That's Saurabh's new book, Breakpoint: The Crisis for the Middle Class and the Future of Work. And Saurabh, of course, highlighting the pitfalls, if I can put it like that, the weak points, but also how to kind of sort of pivot away to benefit from some of the opportunities which he thinks will come up, and manufactured exports is the big one that he's pointing to. Well, I think Nagaraj Sethi is with us of HDFC Securities with a quick perspective on things on technicals. I think markets are down 160 points, 170 points, 22,650. Nagaraj, what would you do?
Hi, good morning, Prashant. Market is just echoing the Middle East conflict. No respite for bulls, even though after declining so much on the lower levels. Market is finding small support around 22,500 odd level, which is the previous swing low, as well as the opening upside gap of 11th April 2025. Just a bounce back. We have seen strong supports are offering a smaller bounce back, and eventually market is forming, Nifty is forming lower tops and eventually coming down the lower bottom. I'm not expecting a bigger upside from here onwards, just a minor upside recovery towards 22,800, 900 levels, and eventually we could see Nifty sliding below 22,500, 450 supports in the near term.
Stocks, Nagaraj?
Yeah, I have two stocks from my side. One is from pharma side, Natco Pharma. Chartically, Natco Pharma has been in a strong uptrend, a larger degree, higher tops and bottoms. We have seen some consolidation has happened, and the stock has bounced back in today's session very well from the lower levels. Currently trading around 1,003. One can look to buy at this point of time. 1,060 is going to be the immediate target. One can place a stop loss at 970. And second one is from a sell side, Sona BLW. Has been in a consolidation phase recently with a larger move, broken below the consolidation around 480, looking good for a shorting opportunity. One can look to sell at this point of time. Currently trading around 475, 475.50, 476. One can look to sell at this point of time. Immediate target would be around 450, and one can place a stop loss at 490.
All right, Nagaraj, we'll leave the conversation here for now. Thank you for joining in. On the other side, Manish Gupta will join in to focus on commodities. Stay tuned. Welcome back. Let's talk commodities now. Manisha is now joining in, and we're seeing big price moves across many commodities, the entire complex today, Manisha.
Well, yeah, absolutely. Since it's a financial year ending, I'm just bringing to you all those commodities that have actually done well. And if you look at the last 12 months or last 1 year, almost everything in commodity pack actually has done very, very well. That is the energies in front of you, and we're looking at 43 to 55% of gains for both the crude varieties. But the major gains clearly have come in for the crude derivatives. So whether it is about gasoline, heating oil, it's gained more than 80 to 100% in the last 1 year. Coal also has been surging. The last couple of years were not so great for coal, but with the kind of energy concerns that we are living with, coal prices also are up by nearly 39% in the last 1 year. Let me break it down and look at what the month of March and the current quarter has done in sense of energy prices. So there you have it. More of the gains have come in for the last 1 month itself. So 40 to 50% of a jump in the month of March is what we've seen in the crude prices and heating oil. If you look at this current quarter or 2026 as a calendar year till time, you're looking at 70 and 90 and 100% of gains for many of the crude and varieties. And there you have coal, 12% up for the month of March, and that also has gained up by 34% in this year till time. Let's take a look at the precious metal prices then, or rather the crude impact prices first of all. With the crude prices surging, we've seen many of these commodity prices also continue to gain. So you have sugar prices, which actually has given you 2 years of decline. In the last financial year, we've seen sugar prices also gain up. For the month of March, 13% of gains coming in for this one. Synthetic rubber prices, where you use crude, also is gained up by 40%. That is polythene prices, 32% of gains there. And sulfur, one of the major fertilizers, also is looking at multi-year highs in sense of futures in the international markets therein. The World Container Index is 16% up, and the containerized freight is gained up by 37%, all in the matter of just 1 month in the month of March therein. And now you should be looking at precious metal prices. So last 12 months have been amazing. We've seen record highs come in for gold and silver and platinum and multi-highs in palladium as well. So 43% up for gold, 100% up for silver. And you're looking at very strong gains coming in for PGMs like platinum and palladium. But when you look at the month of March and this current quarter, that hasn't been so well. Actually, the kind of profits that you saw in gold and silver got sold into one. There may be no rate cut from the US Fed and various other central banks. And then it also is about paying off your losses elsewhere. And that got a decline in the precious metal prices for the month of March. So much so that barring gold, silver, platinum, palladium are now negative for 2026. And finally, the base metal prices should come in on your screens as well. So when you look at the last 12 months, well, yes, it has been good. 8% of gains in copper, 28% of gains in aluminum. Aluminum actually is performing in the short term and the longer term as well. And you should actually see the prices for this month and for 2026 as well when it comes to the base metal prices therein. So for the month of March, we are negative in copper, in zinc, in nickel, lead, tin, all of those. Aluminum is the only one performer. 9 to 10% of aluminum comes in from Middle East, and we do understand that 3 major companies and smelters have shut their facilities because of damages there, and that has led to aluminum outperforming for the year as well till time. So while copper has turned negative for 2026 with the kind of gains that we're looking at in the month of March, aluminum is the positive. Zinc just about trading in positive there, but aluminum clearly outperforming within the metal space, and then it is about the Brent crude prices trading very, very firm.
All right, Manisha, thank you very much for that. That's, the commodities picture as things stand right now. We'll take a quick commercial break here. We'll come back. Lata in conversation with Neeraj Gambhir of Axis Bank and Abhishek Upadhyay of ICICI Securities. PD as RBI's move has pushed the rupee higher this morning. So many angles to it. What next after today's bump up? Is it here to stay? And more coming up in that discussion after a quick break.
Welcome to It's the Economy. It's a big day for the non-stock markets, also the Forex and bond markets. The Forex market were hit with a shock on Friday evening when the Reserve Bank said total open currency positions of banks cannot exceed $100 million. Banks have till April 10th to bring down their excess positions. This morning, the rupee has opened sharply higher at 93.58. That's the opening rate. Now, of course, it's closer to 94, but still much higher than previous close of 94.8. Now, that's the Forex story. The bond market, the government on Friday announced it will complete 51% of its borrowing in the first half. Now, this is less than the market expectation that the government will borrow 53 to 54% of its total needs in the first half. Yet, the yields are still higher. To understand both these markets, I have with me Neeraj Gambhir of Axis Bank and Abhishek Upadhyay, the economist from ISEC PD. Gentlemen, good morning and thank you for joining us in what must have been a very bad morning for you all. Neeraj, to you first. What is the expectation that the way the rupee will go? The Reserve Bank is now going to control the onshore market. So can we expect that it will remain strong for some time now, the rupee?
Yeah, Lata, just trying to explain a little bit of what this move does, right? Yes. What they basically said is that the onshore INR open positions in deliverable terms cannot exceed $100 million. There was always a limit on how much you can run in terms of the currency risk on the banks, but that was on a net basis. What this has done is it's moved it to gross basis. Banks were actually arbitraging between onshore and offshore markets, and that's a fairly big market. Offshore market's a big market, so there was a large amount of arbitrage that was sitting in the bank's books. Once they put a cap on the gross position onshore, it basically means that the arbitrage has to cut. Arbitrage positions have to be cut. And that has basically resulted in the spread between onshore and offshore to widen out in a big way. Typically, in the 1 month period, the spread between onshore and offshore used to be about 3 to 5 paisa. Now, currently, it is trading at it started at about 75 paisa. Currently, it's down to about 30 to 35 paisa. The most important thing that this will do is it will break the link between the offshore market and the onshore market. Banks will no longer be able to arbitrage between onshore and offshore, and hence any activity that takes place in the offshore market will not necessarily transmit into the onshore market. Obviously, this has been done to curb some level of speculation that was going around probably in the offshore market. So I think that's the broad impact of this move. What Rupee does, obviously, in the short run, over the next few days, as the banks are required to square off their positions, that is what will happen. So banks will be selling dollar rupee onshore and buying dollar rupee offshore, which basically means that the onshore market, the dollar rupee will actually will come down some bit more, most likely. It depends upon where Reserve Bank intervenes. But once this move is over, then I think the rupee will default to fundamentals, which basically means that what happens to, for example, oil prices, what happens to FPI flows and all of that. So this is, I think, in the short run, positive for rupee. But in the long run, I think fundamentals will prevail.
Okay. That point is taken. So you would expect that this could happen till April 10th, the rupee would remain strong?
Yeah, I mean, the current timeline is April 10th. So certainly till April 10th, there will be pressure to sell, the positions onshore.
Okay. Now, what does this mean in terms of losses for banks per dollar? Now, I got a number of 40 billion in terms of long positions, though many people said it is difficult to guess everyone's long positions. Yeah. But would you say the 40 billion is a ballpark? And if it is that, does it mean that most of it is about a 1 rupee loss? Because if you average out, I just got the 1 month difference in paise between Friday and today, and the 6 month difference and the 3 month difference. Would you say the average is a loss of a rupee per dollar position?
No. First of all, there isn't any good public estimate available of what the overall position market is. There are various estimates floating around. $35 to $40 billion is one estimate. I don't know how accurate that is. But yes, I mean, if you look at $35 to $40 billion arbitrage position and everything is lying in 1 month, then if the 1 month, spreads widen by 1 rupee, the number of 4,000 crore is roughly what it will come to. But the reality is that today, the spread is about 30 to 35 paisa as we speak. I expect this spread to be quite volatile over the next 6-10 days, depending upon what Reserve Bank does, what all of the market participants do, what the offshore players who have shorted do, right? So the spread can be fairly volatile. That's just an estimate. I think eventually there is time and the markets can be volatile. So we'll see what happens. That's one point. Second point is that not all positions are in 1 month, right? So there are likely to be positions down the curve as well. There are other products, for example, non-deliverable options, non-deliverable currency swaps, or where also banks arbitrage. So there can be a very different effect on these products depending upon how the market moves. I think most of this will actually be clear towards the end of the day, maybe in a day or two, right, where things are settling down.
But even there, it would be a loss, no? Even in the other product.
I mean, to the extent there is a widening of the spread between onshore and offshore, it is, I mean, given that these are arbitrage positions, which is basically mostly the banks would have sold forward offshore and, bought forward onshore, it is P&L negative.
Okay. Abhishek, thank you for your patience and let me get you in on the conversation. What is your understanding of how the currency might move? Are we seeing a jump back towards 95 levels in a week, 2 weeks? Given, I mean, the limited knowledge we all have about how long the Hormuz Strait is going to remain closed.
Well, clearly RBI has started to take administrative measures to control rupee depreciation. We have seen this in the past stress episodes also. In 2011 and 2013, RBI had curbed NOP limits. I would think this is a start of basically a process where RBI is deploying the toolkit to control speculation. RBI is clearly in a difficult spot here in terms of rupee. Even if we optimistically assume prices settles down quickly and commodity prices correct, still you are talking about a situation where crude prices will take time to revert back to old levels. So if you're very conservatively assuming not $115 crude, which is the current level, but $85 crude average also for the next fiscal year, you're talking about a 1.5% to 2% CAD. Now that looks good prima facie. That doesn't look very bad, but in absolute terms, you will need to fund 60 to 80 billion deficit, which is quite a high number. So I mean, for reference again, in 2013 we had a close to 5% CAD, but absolute terms it was 88 billion, right? So absolute CAD going up is going to, in an environment where we have found it difficult to attract capital flows, is going to keep pressure on rupee. Also, there are other headwinds in the near term, especially if you are seeing RBI needs to roll over or manage its forward book, which has grown quite large. So if you're talking about net FX reserves, including the adjustment for forward book, you're already talking about less than 600 billion firepower there, which is roughly 8.5 months of import cover. Again, in 2013, we went to 6 handle, but RBI wouldn't want to go below 7.5 months, perhaps, right? So in that case, that's why maybe RBI is starting to deploy administrative measures because they want to manage the FX reserves. They want to ensure they remain ample and deal with this crisis
Fair enough.
But still they would want to control speculation.
Yeah, so we shouldn't be surprised if there are more administrative measures, though it's difficult to imagine what now. Abhishek, very quickly, why are the yields higher? I was under the impression that the government borrowing program at 51% is less than what all of you gave me. 54% was what you all were expecting. But despite that, yields are higher. Is this all accrued doing?
But RBI taking administrative steps is a sign that monetary policy reaction function is also changing. You would expect RBI in the upcoming monetary policy meeting in this context to sound more balanced, clearly, not dovish, which was the case earlier. So that is clearly that this change in narrative and how RBI basically manages the communication is going to be important. Also from other aspects, including liquidity standpoint. In this environment, when they are trying to defend rupee, they would not want to take liquidity easing measures to support bond yields. Anyways, more recently, RBI has let yields go higher. It appeared earlier they were intervening very strongly on the screen. in a sort of a yield signal, and they have rightly let bond yields basically adjust higher because there is so much uncertainty about the outcome.
Fair enough.
And that is what you're seeing play out in the bond markets.
Neeraj, how are you reading not just the borrowing program, but Abhishek's point that if RBI has taken such an important administrative step in the currency markets, then chances are that they are definitely going to be cautious and definitely not dovish, not lower for longer when the policy is announced on 8th.
Yeah, so I will agree that the policy needs to remain flexible at this point in time and not commit itself to any particular path. In terms of liquidity, I think this $35-40 billion, if that number is correct, is what comes into the RBI's books back. It basically means that the amount of intervention that they had to do in the money markets in terms of open market operations and repos, etc., will probably be much lower than what was thought about earlier, right? So this effectively gives Reserve Bank $30 to $35 billion of additional ammunition to intervene in the FX market without getting worried about what happens to the liquidity and the domestic bond market, which is obviously not positive for the bonds, because it means that a significant amount of demand for the bonds, which was RBI itself, is no longer going to be there in the system, right? And that's at the start of a fresh borrowing program. So I do expect some impact on the bond market for that. Right now, I think the market has reacted a little bit more to the fact that even though the borrowing calendar is lower in terms of percentages, there is more weightage towards short-term bonds in terms of issuance, right? Which is why you've seen the yields of the short-term bonds going higher as compared to 10-year, which is kind of flattish.
Okay. So you expect what, 7% very soon on 10-year?
I mean, we are close to 7% right now, so that's no big shift.
Okay, what's your range, say, for the quarter? For the next quarter?
I think it's highly uncertain, Rata. There's so much dependency on how this war plays out, what happens to oil prices, what is the level of intervention required, and its impact on this thing. So I think, yeah, we'll probably be 7 to 7.25 for now, but significantly dependent, and this is all subject to what happens in many other parts of the markets.
Okay. Abhishek, I just have 10 seconds. What's your yield range for next year? I mean, for the first quarter of next year?
Agree with Neeraj here. Some upside likely, even if RBI is not thinking about rate hikes. But if rate hikes come into the picture, then the extent of upside will be higher, and you could see higher levels.
Okay. Well, thank you very much, gentlemen. Already we are seeing the rupee edge over 94 and 94.10 as we speak. So clearly there is real demand when crude is at 115 and 113. So the RBI steps, we'll have to see how long it will be able to keep the rupee a little more appreciated. Thank you very much, Neeraj and Abhishek, for joining me. We have to wrap up on Bazaar. Chartbusters after a break.
The Indian market opens with a gap down in line with Asian peers led by higher crude prices, which spike following comments from the US President Donald Trump and no sign of de-escalation in the war on Iran. An early recovery gets sold into the Nifty, now back below that 22,600 mark.
The RBI caps banks' onshore forex positions at $100 million from an earlier cap of around 25% of Tier 1 capital as it aims to curb speculative activity. The rupee opened stronger but has given up early gains.
Sharp fall in banking stocks as the RBI caps onshore forex positions. Banks have till the 10th of April to bring open positions down to the new $100 million limit set by the RBI. Analysts tell CNBC TV 18 that positions worth nearly $30 billion may have been unwound and that banks will be required to book losses.
Iran hits Emirates Global aluminium site in the UAE, deepening the supply disruption from the war. The attack follows supply cuts announced by companies in Qatar and Bahrain following strikes by Iran earlier this month. The stocks of aluminium companies surge in trade.
A couple of these defense stocks, they're outperforming today. BEL, and we have Apollo Microsystems as well, mildly higher, while the others aren't falling as much because the Defense Acquisition Council has cleared acquisition proposals worth nearly 2.38 lakh crore rupees for equipment including hovercrafts, air defense and communication systems.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. It's a difficult start to the week for global equities with Asian markets under pressure. The Indian markets as well did open up with a cut. We did see a bit of a dip getting bought into in early morning trade. But in the last few minutes, again, we've given away that advantage. And the Indian rupee that opened up with some strength, that as well has slipped a little bit. It's given up closer around half the gains that we saw at the start of today, Mangalam.
Take that point, Nigel. You know, fear has spiked once again. So if you look at the India VIX, it's past that 28.5 mark. So that's a level that we will be tracking very, very closely. And even as we speak, 300 points lower on the Nifty, we recovered. If you pull up both the Nifty and the Rupee chart together, you would see that there is congruence out there. As the Rupee was strengthening, the Nifty was recovering from the lows. And thereafter, the Rupee started to weaken. Rupees at the low point of trade. Nifty is moving towards the lower end of today's trading range once again. And the other line that tells you the story of the day are the crisscross lines. They did not criss or cross. At one point, they came close with nearly 800 stocks advancing and 2,000 stocks declining. Now they've gone far again. Nearly 520 stocks which are advancing against 2,500 stocks which are declining. So it looks like a weak market, looks like a wobbly market. And as a result of which, it is also likely to end this financial year, which is the last trading day of FY26, to be the worst year for the market in a decade, excluding, obviously, the COVID hit year. History, however, offers a silver lining. Let's see whether there is that silver lining that comes by in FY27 or not. For this analysis, we do have with us Sudarshan. Sud.
So it's the last trading day of FY26 and market is set to give negative returns after 2 financial years and set to erase the gains that we had seen in FY25. Nifty is set to end FY26 with a downtick of more than 5%. Nevertheless, still we have more than 50% Nifty stocks which have been in the green if you take a look of the returns of FY26, and 15 Nifty stocks are going to give returns of more than 10%, while 16 Nifty stocks are down more than 10%. So which are the biggest laggards amongst all the indices? Realty Index down 21%, IT down 20%, and FMCG too has seen a fall of more than 13%. Talking about the biggest gainers amongst indices, PSU Bank has seen a gain of more than 30%. For metal, it's more than 20%. Even auto index, all the auto stocks had seen huge gains in FY26. And on the back of that, it has risen almost 14%. Take a look at all the Nifty stocks, and amongst those, Shriram Finance, BEL, SBI, Titan, and Eicher Motors are the top Nifty gainers as far as FY26 is concerned. And if we talk about the losers, trend has been falling continuously, and as a result, in FY26, that stock has fallen as much as 36%, TCS 34%, ITC 28%, Wipro 27%, even Indigo has seen a fall of 20%. But the bigger fall was seen in the broader markets amongst mid-cap names. If you first talk about all the gainers, Delivery up 70%, AB Capital up 65%, AU Small Finance Bank 65%, L&T Finance 64%, and Indian Bank too has seen a gain of as much as 60%. Now coming to the top losers amongst all the mid-cap names, AB Fashion almost 80%, KPIT Tech almost 50%, ACC, Jubilant Food, Tata Chem were also among the top mid-cap losers. But what about going forward in FY27? Now, since 2003, I would say after 2003, it has never been a single fiscal. If we have given negative returns in one fiscal, we have not given negative returns in the following fiscal. So in 2003, we had fallen 13%, and following the next year, in 2004, we had gained as much as 81%. The similar trend was seen in 2009, 2010, 2012, 2013, 2016 and 17. 2020 also we had seen a fall of 26%, and 2021 we had gained as much as 71%. So in this financial year, we are down 5%. We'll have to see how the FY27 pans out. If we go by the history, we might see a gain, but that's a big hope.
Okay, all right. Thanks a lot for that, Sudarshan, for joining in and giving us that neat piece. It's been a difficult fiscal year for the bulls. Well, let's welcome Shivangi Sarda for a technical check. Hi, Shivangi. Good morning. Good to see you in. What's your take? The last week we went to around 22,400 and we bounced up. Do you think that level will hold out, or do you think we're going to see far deeper gashes?
Very good morning, Mangalam and Nigel. So we are actually in the last trading day of the financial year, but it's also a truncated week. So of course, we will see that there has been some sort of volatile cues within a range. Now, of course, after the gap down opening today, the index has sustained below, and we are seeing pressure on every bounce. So this will likely to continue for the monthly expiry day POV as well. But India VIX at higher zones is clearly not providing any comfort to the market, and until it sustains and it breaks below, we would not see any fresh signs of buying. In fact, the India VIX has given a breakout of the last 4 trading sessions. So overall, this weakness should continue, and we are looking at 22,000 as the next break for Nifty, with an upside cap at around 22,850 and then 23,000 odd levels. Talking about Bank Nifty, we've seen that weakness has persisted here as well, and we are looking at some of the PSU names which have given up strength as well, which has led the index to fall. And even though it is near the support levels, but we would recommend a sell-on bounce here as well. And we're looking at 50,000 next for Bank Nifty. Now, the upside still remains capped, but we are looking at somewhere near about 51,450 as the next immediate resistance for Bank Nifty.
All right, take that point. Shivangi, thanks a lot for that. That's about the Nifty and the Nifty Bank. A lot of stocks which are buzzing around. IRB Infra is one up around 10% today. Marico's moved to the high point of trade. We are seeing some traction on Avenue Supermarts as well. But then those are just far and few in between, because we do have about 5 stocks declining for every stock which is advancing. So your trades would be what? On the long side or the short side?
So definitely in this kind of a market also, we are recognizing some of the stocks which are holding up. One of the stock is ONGC, which is on my radar. We've seen that this one has, of course, gotten a lot of aid from the government, and with the recent crude oil price movements as well, this has gained a lot of attention. This stock has, come out of its consolidative band on the daily basis, bounced back exactly from its 50 DEMA, and from the last 2 trading sessions, we've seen volumes adding up quite significantly. So this one's on radar. Now, the kind of action that we're seeing towards the monthly expiry, we would see that this momentum should continue in the next series as well. We're looking at 296 as the next targets for ONGC, with a support of 279. And the second pick on my radar is Nalco. We've seen that Metal Pack has been one of the strongest names in this kind of a market, and Nalco has seen a good amount of positive rollovers. And we've seen that this stock has resiliently held on to the monthly time frame. From the last 10 months, it has consistently made higher top, higher bottom formation. And with that, strength should continue over here for the next series as well. So we're recommending a buy on Nalco with the next targets of around about 405 and a support of 380 level.
All right, take that point. Thanks a lot, Shivangi, for that. We'll take a short break, come back, get you more on the markets and a lot of stock-specific action on the other side. Stay with us. Welcome back. Even as the Nifty is on the verge of breaking that 22,500 once again today. Today's low on the Nifty is closer to 22,470, which is pretty much in line with the last week low. A bunch of these stocks which are doing well today belong to the sugar pack. So pull up Dwarikesh Sugar up 13%, Renuka Sugar up 7%, Dhampur Sugar up 6%. Typically all these sugar stocks move in tandem, and one of those is also Triveni Engineering. Remember, the government has gone ahead and announced OMCs have been directed to supply E20 fuel across all states and union territories from April 1. The centre begins its stocks on E25 and government looks at E30 by 2030. Basically, that's 30% ethanol blending for the fuel. Tarun Sone, who is the Vice Chairman and Managing Director of Triveni Engineering, joins us now. We'll obviously discuss the surge in sugar prices, the outlook for the company, given the government's ethanol fuel blending program and business for them. Let's keep it very basic, Tarun, for starters. At current prices, what's more profitable for you, sugar or ethanol? And where do you see this settling over the next 1 year?
Right. I think ethanol and sugar can't really be compared as different sides of the same coin. I think they have their own economics, and frankly speaking, there's a lot of connectivity between them in terms of transfer pricing. I think at this point in time, it's fair to say that both industries are doing well for a variety of different reasons. Plain economic supply and demand, and also the impact of rising energy costs and the future outlook, especially when we look at ethanol, and as you mentioned in your opening remarks.
All right. Hi, Tarun. Good morning. And good to see you win. As a nation, we've done pretty well, right? To get blending till around 20%. And now some part of the industry believes we could do even more. What is your estimate? Do you think it'll be viable to move up from this 20% odd? What kind of a role could a company like yours have to play? And would you shun aside any kind of fears of potential oversupply of ethanol capacity in India? Because if blending is going to go up, then it'll all be consumed. Please go ahead.
I think that's a great question. We do have a substantial ethanol manufacturing capacity in the country. So if we look at the blending program for this year, approximately 1,150 crore liters is going to be blended, securing E20 across the nation. However, we have substantially higher. We have about 60 to 70% additional capacity in India today. Now, not all of it is operable, but large quantities, of course, is. And we can divert all of that to meet our country's energy requirements, not only in terms of higher ethanol blending. You spoke about levels in excess of 20%. I think if we go back to this conversation 6 or 7 months ago, there was talk of graduating up to E27 through 22, 25, and then 27. I think the fact that we are re-engaging that discussion and potentially looking at the Brazilian levels of E30 is very encouraging. It will take a little bit of time because there are other players in this entire value chain, and the genesis towards that higher level of blending, while very, very important, needs to carry everybody along and look at the look at the existing fleet of automobiles across the nation. All of this is, of course, possible. There have been ample notes that lie with the government, and the hope is that we will look towards this very favorably. There is, of course, an additional thought. And when we look at LPG and the LPG crisis across the country, the industry and the bodies various bodies have written to the government to explore the possibility of ethanol cooktops. Now, that as an alternative to LPG across the country could open up another fantastic market. Yes, ethanol cooktops are a little more expensive. However, of course, that is dependent on what the price of LPG is. But if we're looking at national security and energy security of our nation, the strategic part of it will require us to rethink looking at ethanol cooktops as well. So it's exciting from both fronts.
That's an interesting one, ethanol cooktops. But obviously, that's a medium to long-term sort of prospect and very exploratory stages out there. But good to have your suggestion in out here, Tarun. But, ISMA has cut their ethanol diversion estimates from, 5 MMT to about 3.5 MMT. How does this impact the sugar balances and pricing?
So I think the diversion from of sugarcane actually towards the ethanol sector came down a few months ago. And frankly speaking, it was in line with the E20 tender as it came out in November of last year. So that I think is that was expected. The other important point is that the season has come to a more abrupt end. Meaning that the total quantum of sugarcane across the country was lower. Now, this will impact not only the quantum of ethanol produced from sugarcane, but also the quantum of sugar in the country. However, by no means does that mean that E20 is at risk at all, because we have huge amounts of grain processing capabilities, and many people actually have the ability to move between raw materials in order to make ethanol.
Tarun, in terms of your capacity, could you update us? What is the current capacity, and do you have plans to scale it up?
Well, our capacity is 880 KLPD, and we have no plans as of now to enhance this capacity because, as I mentioned, the nation has excess manufacturing capacity. However, if there is talk of E100, which we've not spoken about in this conversation, then the quantum of ethanol required will be much larger. And then the work that will be required by the industry, and looking right from agriculture all the way through manufacturing and distribution, will be of a different scale. And that actually poses a very important and exciting opportunity in the short to medium term.
All right, so let's wrap it up then, Tarun. Finally, for your own company, and that's something that matters to investors most. How has the fourth quarter been? What's your prognosis for FY27 when it comes to revenues, margins for both sugar and ethanol?
Well, I think the fourth quarter has been an interesting quarter. I'll talk in more general terms. Sugar prices have performed better than I thought they would. They've certainly stabilized at a good level and increased ever so slightly, about 1.5% through the course of this quarter. Ethanol, of course, has been the dispatches have remained consistent, which is exciting. On the engineering front, I think that's been impacted by the war in the Middle East, and we're going to see how that will play out going forward. The largest part of our business, our commodities business, remains unfazed as far as the next fiscal year is concerned. So I think there are talks of the monsoon being less than perfect. If that is the case, then that has a favorable impact as far as sugar prices are concerned. In addition, if we're seeing oil at which has breached, Brent has breached $115, and then we will see more sugarcane being processed towards ethanol in countries like Brazil, etc., leading to lower sugar availability globally. And that has somewhat of an impact. At least it has a sympathetic impact on sugar prices in India, which have needed to go up. So, I think things are pointing well for both the ethanol and sugar sector. And engineering, of course, will continue on its own steam. However, the war does in the Middle East does impact at least demand in that region.
Okay, all right, Tarun, always a pleasure to hear your thoughts. Looking forward to actually chatting up with you when your results to come out. But today we have a good industry-wide discussion, and we thank you for joining in. Well, for the time being, we slip into a short break, come back, continue to focus on markets as well as on stock-specific action. Stay with us. Welcome back. Well, the markets have the day's low now. Initially we did see a bit of a bounce from around 22,470. But now we're almost back at those levels. And the problem is the Indian rupee as well. That opened up with a gain of around 1 rupee 30 paise odd. It's given away more than 50% of those gains. Currently, we're up only around 50 paise from the close that we saw on Friday. Stocks that are falling off, well, from the headline index, Hindalco's in the green, but that's come off a little bit. So that's coming for some mild profit taking from the top, though it's still up close to 3%. The other few names, Adani Enterprises, that's another stock that's actually coming for some profit taking. Mahindra & Mahindra, another stock that's been doing well, but I think that's pulled back more than 15% from the recent peak. One of those big outperformers the last few years, some money getting taken off the table. And SBI Life as well, another stock that's now down close to around 3% or thereabouts. So a skittish looking screen. You'll have to thank God for small mercies, and at least the number of stocks that are advancing are close to around 500 stocks. But we'll wrap up on this edition of Chartbusters. You stay with us. The team of Trading Hour will come up next.
morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. We kickstart a new week with a new logo, but same old narrative. I'm Manglam Malu, with me Hormaz Fatakia and Ritu Singh. We start the week with uncertainty into, going into this week, fifth week of, war-related problems that we're seeing for the market. We opened lower. Thereafter, there was a sharp recovery that has been sold into, back close to the day's low right now, with sub 500 stocks advancing, 2,500 stocks declining, and we have the India VIX, which has crossed past 28.5. So across the board, there is fear. The only silver lining that today is, the monthly expiry for March series and end of this financial year as well. And no two financial years have seen consecutive declines. So let's see how that goes. Ritu.
That's right. Good morning, Manglam. Let's go with that positive note that maybe FY26 has been bad and FY27 will therefore be better if history is anything to go by. But that said, the last trading day of the financial year, significant sell-off pressure. You're seeing that pressure across the board. Bank Nifty leading the fall on the back of what we've heard from the Reserve Bank of India on Forex positions. That's weighing on sentiments, and the macro is not looking very good, with crude prices also jumping and the rupee being a bit of a recovery in early trade, but again settling down to lower levels. The benchmark indices are down by more than 1.4% each, led by Bank Nifty. But let's go across to Hormaz, who will give us a fuller picture of what's happening with the markets this morning. Hormaz.
The Bank Nifty is now just around 1,500 points away from entering bear market territory, and 1,500 points is what exactly it is down currently, but does not look good for the index as of now. All it has done so far is managed to defend last Monday's low, which was 22,471. It's just 20 points away from those levels. The Nifty Bank is now around 17.5% down from its peak, so around 61,000 odd levels. And look at the currency as well. The currency has been the bigger pain point. The recovery that was seen earlier in the day has been very swiftly sold into, just as the market as well. 94.35 now on the currency. Has been very choppy moves on the currency. There was at one point it reached 94.50 as well. It's now gone back to 94.35, but significantly off the opening highs. And this move for the currency from the Reserve Bank has had an impact on the banks, both private banks and PSU banks. Look at the private banks first. Kotak, Axis, IndusInd, all of them down 3 to 4%. HDFC Bank continues to grind lower as well from its 52-week lows. And same is the story for the PSU banks, be it Bank of Maharashtra, Bank of Baroda, Union Bank, Canara Bank. Of course, they have been hit also because of the surging bond yields. But these two are now trading anywhere between 3 to 4% lower. The one segment that has bucked the trend, some metal names, particularly those linked to aluminum, Hindalco, Nalco, Vedanta, all of them doing well for themselves, 2 to 4% higher. Nalco being the outperformer in this pack. There are a lot of newsmakers as well. IRB Infra is one name trading X bonus from today's session. The stock is up 9% as we speak. Urban Company, with the Insta Help update that it shared over the weekend, is up 4%, still languishing around its IPO price. And Coal India doing well for itself today, around about 1.5% higher. The recent listings have taken a bit of a beating in today's session. LG Electronics is down 6% as we speak. Grow as well, not doing well for itself today. And WeWork too, significantly lower from its issue price, now 6.5% knocked off in this one as well. And stocks at 52-week lows today. Bajaj Housing, the second most bid IPO in history, is now perilously close to its IPO price after making highs of close to 190. It's back at $70. Bharat Dynamics had a 52-week low. Blue Jet Healthcare too, down 4%. These are just three among the 90-odd stocks on the Nifty 500 that are trading at 52-week lows today.
All right. Hormaz, thanks a lot for putting the spotlight on all these buzzing stocks. But time to get you the macro signal. Markets. Rupee saw a significant rebound today. Ritu, take it away.
Well, yes, Manglam, markets, of course, deeply in the red, and that's a reflection of what's happening on the macros. The rupee, yes, there was a big rebound today. In fact, the sharpest such rebound we've seen since probably last month, from the week's historic low close that we saw on Friday, 94.81. And the primary reason for that, of course, as we've been telling you, is the RBI directive that ordered banks to cap their net open rupee positions in the onshore market at $100 million by the end of each day. This is going to be effective on the 10th of April, and that's ended up forcing banks to unwind some of the short bets. And you're seeing a bit of a recovery, although rupee is now back above 94.3 to the dollar. Meanwhile, the 10-year bond yield, that remains near a 19-month high, and that's the largest such weekly increase that we've seen since May of 2022 during COVID times. You know, there are lingering concerns in the bond market and perhaps higher fertilizer subsidy, lower government earnings because of the excise cut, etc., and therefore a potentially higher fiscal deficit as well. You know, the lower than expected government borrowing for the first half that we saw on Friday, there was little comfort from that in the current market condition, and add to that the concerns of imported inflation from the higher oil prices, which have now remained above those, you know, high odd marks for a month or so. Now, compared to Friday, the 10-year yield is flattish, yes, but the short-term rates have moved up significantly. Now, speaking of oil prices, those are surging today as well. The Brent at 115.2 as we speak, and the WTI is also above 100, you know, dollars a barrel. And this is on the back of the escalation of tensions in West Asia, Houthis' entry into the war, etc. All of that not playing so well on the market's mind. So not a good macro setup. Let's hope we, you know, buck up the trend later in the day.
Indeed, let's hope we do that. In the meanwhile, as we speak, you know, a lot of these index heavies are back in the red. We have Reliance, which was actually bucking the trend, supporting one end of the index. Now that's moved off highs, just about in the green, in fact, just hovering around the flat line. And we do have, you know, Adani Ports, HDB Financial, L&T, Asian Paints, all of them sharply lower. But let's also get in a corporate conversation now. Quality Power's arm, Endox Energy, has won an order worth nearly 152 crores for the supply and integration of a battery energy storage system, BESS as we know it. We do have Bharandiran Pandyan, who is the joint managing director of the company, who joins us on this business update. Thanks a lot, sir, for joining in. We'll obviously be discussing this order, the inflow, the outlook, West Asia exposure, and disruption as well. So with this order, I just wanted to understand, it's an international order. Can you give us the name of the awarding entity, execution timeline, what proportion of your business currently comes in from global, and what your current West Asia exposure is? Are you impacted by the current crisis?
Morning. Thanks for having me here. So 50%, slightly higher than 50% of our business is global. Not necessarily West Asia. We are quite spread out in Australia, Europe, and the US. In West Asia, we do have a lot of customers, and we have already seen purchase orders coming in for the equipment's damage during the war. So I believe we will have some chance in the rebuilding in the region. Having said it, this project comes from Turkey, where we have already been in the business of battery energy storage on the power converter side for the past 3-4 years. We have had a couple of projects already in the ground, based on which we got the first phase of the project, and we believe the total order value would be slightly north of 290 crores at this moment.
So what would be the margin profile for this project and the execution timeline as well? And if I could club in one more question, since you mentioned you have customers in West Asia, how much of it is part of your total business? And because of this disruption that you're seeing, has there been any operational impact there?
So our current order book at this moment is slightly north of 1,300 crores. The guidance we have given for the quarter is about 22% as a floor. Having said it, I believe about less than 10% is in West Asia, but these are not orders that are short term. These are with deliveries of about 12 months and slightly ahead of it. So we do not see disruption or the customers having any problems with the takeaway of these orders. We are comfortable at this position with almost 15 months plus of order book before the start of the year. So I do not see any change in guidance at this moment because of the war. The impact directly on us is basically the shipping routes. The shipping routes means more congestion at the port and more time for the customers to pick up goods and delivery. And there has been change in input prices drastically over the last week. But these, we presume, should not last more than a couple of weeks more.
Okay, Mr. Pandyan, so about 10% of the revenue exposure you're saying is from West Asia, but you don't expect any change in your guidance on account of any sort of disruption that you've seen there. So your 9th-month revenue is about 660 odd crores. You'll do about 230 odd crores in the fourth quarter to get to that 900 mark. And or do you think if the war prolongs, if there's disruption, you may have to relook at that number? And what's the FY27 inflow order inflow target?
So I think the FY27, we are guiding at least 1,000 crore plus of order book on top of the 1,300 plus what we are already sitting on. We see Q1 to be soft on the entire segment, primarily because of the supply chain constraints. But that would be missing a quarter rather than missing the year. We do not have any bad news per se on the revenue or the margins front at this moment.
Let's say that your input costs have increased. You don't expect them to last. You don't expect this disruption to last beyond a couple of weeks. I mean, that's what one expected at the start of this skirmish as well. But it's now gone on to about 5 weeks. Just wanted to understand what proportion of your input prices have been elevated because of this, and what could the impact on margins be if you do not pass on to the clients?
So whatever the current prices are, all the new orders come at the current prices, which means that these prices cannot sustain too long. As soon as the war gets over, a couple of months later, once the prices start coming down, the prices order booked at this quarter would be already at elevated prices. So as I said, at the end of the year, we do not see any major changes, but maybe at the quarterly numbers, there can be a couple of percentages here and up and down, but that's at this moment because we have factored in and the prices have been in the race for the past quarter. So most of the orders coming in the last quarter have been at high prices.
And what is the kind of structural growth opportunity that you see from this HVDC and this battery as a storage system segment as a whole? Are you bidding for orders in this segment as well?
We are at this moment working on multiple FACTS, HVDC and battery storage projects across the world. We have been traditionally involved in over 100 countries. These are some of the larger order chains that we have qualified and have bagged over the past qualification that we have bagged over the past few years. At this moment, because of the crisis, most of the governments across the world would again renew their focus into renewable energy. I believe a lot more focus would be given to renewable energy storage and transmission, primarily because of how the gas has behaved. I believe this would also be the focus of most of the Middle Eastern countries, where you would see these guys focusing a lot more on renewable systems, which means HVDC, STATCOMs, SVC, battery energy storage would be the talk of the day in the next 3 to 6 months. And we believe that the capacity for us is coming in the right time. With the kind of order book we have, I believe we should have a fair share of the upward trend.
But could you put a number to that? I mean, from HVDC and the battery energy storage solutions, what would be the contribution to revenue? You have visibility on, I think, HVDC from December 2026. What about BESS? Say, in the next 2 to 3 years, what could the share of the revenue from these two be?
At this moment, we are focused on completing the entire 292 crores, which is quite a significant order for us by the end of next year. That is what the project timelines are. But because now we've already entered, we would like to get a couple of more projects this year. Right now, the share of HVDC FACTS and BESS on our total order book is slightly north of 50%. But also the AC transmission, especially the 765 kV and 400 kV, has sustained demand. We are seeing more traction in the US and the European markets at this moment, as there are much heavier supply chain constraints in those regions. The shipping lanes only increase the timeline for delivery and nothing more at this moment, because most of the logistic costs are passed on to the customers.
All right, take that point. Thanks a lot. Good luck for this execution of this order and the structural opportunity that you see in BESS. The important part, however, is that the market is in no mood for any sort of recovery right now. You won an order, the stock's down about 7.5%, but the Nifty too tested the day's low once again. 22,454 is where we are, where we our levels that we tested after coming back to 22,475. Remember, the earlier low prior to this was 22,470, which also coincided with the low of the previous week. So 22,450 to 22,500 is an extremely crucial support zone for the market. Let's see where it goes. Now it's tested the lower end of that zone. 22,450 is what today's low has been. The Nifty still hovering lower. Across indices, there is broad-based selling. We'll take a short break, come back, focus on the markets and a lot of individual stocks. But beyond all of that, the big story which we're tracking, banks and the rupee.
Welcome back. Our big story on trading hour, the rupee opening sharply higher at 93.58 after the RBI capped the total positions that banks can take in the onshore currency market to $100 million, and they have to bring down their positions to this level by the 10th of April. However, the rupee has climbed back to about 94.45 levels. Lata is here with more. Lata, what explains the rupee move? 93.56 now back at 94.45, and bond yields also adding the pressure for banks.
Well, people are still guessing what would have accounted for the recovery. One must remember that there is a lot of hunger for dollars. So as the dollar becomes as cheap as 93.58 or 93.80, 1 rupee cheaper than where it was on Friday at close, there would be a lot of companies which would come and start booking fresh dollars. It's possible that the Reserve Bank also is buying, because the idea is not to create losses as much as to remove one spillover effect of the NDF market on the local market. So just to get back to the rules itself, the net position of bankers was the only thing that was controlled in the old regime. That is, the net FX position, which is netting out the onshore and offshore, should not be more than 25% of their tier 1. But now what the Reserve Bank has said is that the gross position on the onshore market should not be more than 100 million. Now, the gross position can be, 1 billion, 2 billion, 3 billion, because it's only the net which matters. Most of it would be netted out in the NDF market. Banks have to bring down that gross position, which is what they're doing. There's huge selling of their positions. What is the total gross position is a matter of guesswork. We hear noises of 35 to 40 billion, but the exact number will be known only to Reserve Bank. The selling should resulted in the rupee strengthening, but there would be an equal number of buyers, which perhaps explains the recovery. Now, what exactly will be the loss? That will depend on the NDF and the onshore rate difference. Early morning for a 1-month contract, the difference was 70 paise. And for a 3-month contract, it was 1 rupee 20 paise. But as the day wears on, now the difference in the 1-month contract between the onshore market and the NDF market has whittled down to 30 paise. And most of the contracts, about 50-60% of the contracts are 1-month contracts. So it's possible that the loss will not be very high, that the average loss will go down. And remember, if it is a loss of about 2,000 crores for the entire banking system, what is it per, foreign banks take away some of the losses. For the remaining, it would be distributed, perhaps bank size-wise. The impression I got from bankers is that the way things are, we don't think it's going to be a very huge loss, but the whole thing has to be booked in the current quarter.
Has to be booked in the current quarter. We'll keep an eye out on the currency, of course, back at those levels of 94.50 after the earlier appreciation that we saw. Lata, thank you for summarizing that for us. Earlier, Neeraj Gambhir of Axis Bank said that the move will break the link between onshore and offshore markets, while former SBI chairman Dinesh Khara also shared his views on this.
It will break the link between the offshore market and the onshore market. Banks will no longer be able to arbitrage between onshore and offshore, and hence any activity that takes place in the offshore market will not necessarily transmit into the onshore market. Obviously, this has been done to curb some level of speculation that was going around probably in the offshore market. So I think that's the broad impact of this move. What Rupee does, obviously, in the short run, over the next few days, as the banks are required to square off their positions, that is what will happen. I think in the short run, positive for Rupee, but in the long run, I think fundamentals will prevail.
When it comes to this kind of a guidelines which has come from RBI, I would say that perhaps it is intended with the intention to ensure that the risk remained contained and it should not go beyond the limits. And with that in mind, the kind of volatility which you are seeing in the currency market essentially attributed to some banks having huge open positions, and they were actually playing on the speculative trends in the market. So I think it is essentially to curb that. So I think what will happen is that slowly and gradually they will unwind their position. And my expectation is that almost about 18 billion odd would be the amount which should be available for unwinding. And I think perhaps it will lead to almost about 100 paisa strengthening of the rupee. This is what my expectation is.
All right, with that, let's continue our conversation on the rupee itself. It's a near 90.90 paise weakness that we've seen from the day's low. The intraday chart comes up for you. We closed on Friday at around 94.8 thereabouts. So we're still about 40 paise stronger than Friday's close. But from today's low, it is a near 90 paise weakness that we've seen, closer to 94.5 on the rupee right now. The impact it's had on the market, 350-point downtick on the Nifty and counting. The Nifty Bank has broken below the 51,000 mark, so has obviously gone below last week's low as well. Now, all important levels on the Nifty Bank would hover around that 50,000 mark. Take a short break, come back. Market technicals with Saumil Mehta of Mirae Asset Sharekhan. The market's lower, the last trading day of this financial year, March series expiry today. So perfect time to get you an update from the FNO desk. The Nifty Bank, the mid-cap index, all of them lower. The Nifty, hovering around previous week's lows. Today's low was around 22,454. So that's an important mark to track because 22,450 to 22,500 is an important support zone for the frontline index. If you look at the advanced decline as well, at some part during the day, we did see those lines come closer where there at one point there were around 800 stocks which were advancing for 2,000 stocks which are declining. But as the market fell from the day's high, which was a little upwards of 22,600 and now back closer to day's low, the advanced decline lines also have moved further apart. The rupees weakened once again, about 40 paise stronger from Friday's close, but 90 paise weaker from today's strength level as well. And all of that is also reflected in the India VIX, which has risen past that 28.5 mark, currently 6.5% higher. All of this put together, what does this do to option writers who are playing for today's expiry? 22,500 and 22,600 calls very active in today's trading session. 22,500 call has a premium of 70 rupees. 22,600 call has a lower premium, currently close to around 36 rupees. And 22,500 put and 22,600 put are equally active as well. 22,500 for a premium of 100 rupees and 22,600 put coming up for you for a premium of 150 rupees. Tells you that the option writers are positioned for Nifty expiry between 22,450 to 22,700. Obviously, the 22,700 mark has come a lot lower as the markets retraced from day's high today. So around 22,450 to 22,650 would be the range that the option writers are playing for today, given the current premiums.
Watch out for that very important range, but no respite whatsoever on the index as of now. Mangalam, thank you for that update there from the FNO desk. Saumil Mehta from Mirae Asset Share Khan is now joining in for a quick chart check. Saumil, good morning. Thank you for joining in. Well, 22,500 is now taken out. We are hovering around last Monday's lows. Do you see further downside because of this, or will the index find some support at these levels? That and your stock calls for the morning.
Good morning to everyone. The trend still remains negative. We've been forming low top, low bottom formations. We've seen a good bounce last week, and I was expecting the bounce to go till at least 23,750, 24,000. However, it was short-lived. Now, what I'm expecting here is that to trend to continue on the downside. My targets would be 22,200. If it does not sustain around 22,200, then I think the next level to watch out would be 21,700. These are the levels where we saw the downside trend bottom out in 2025 April, May, but that would be a very, very crucial level to watch out for. So the trend remains negative. Sell on rise should be the strategy. On the upside, 23,000 and 23,250 would be a very crucial hurdle. I don't see that taking off in the near term. So near term remains negative. The two stocks which I've chosen is on the sell side. The first one is a PNB Housing. A consolidation on the daily chart has broken on the downside, already in the downtrend, taking resistance at 20 and 40 daily moving average and resuming the downtrend. Negative in the short term, medium term both. Stop loss would be 790 and target would be 730. The next stock is Paytm. Very similar, already in the downtrend, trading below 200 daily moving average, taking resistance at 20 and 40 daily moving average. A gap down opening today. I'll be expecting the downtrend to continue for a target of 910 and stop loss would be 1030.
All right, Saumil, we'll leave it at that. Thanks very much for joining in with your views. We have to slip into a short break on that note, but up next, we're going to discuss market fundamentals with Jyoti Vardhan Jaipuria of Valentis Advisors. So stay tuned.
Welcome back. Still around about that 22,500 mark for the index, continuing to grind lower. And after breaking below last Monday's low, the index is looking to see some recovery from lower levels. So still a 300-point cut on the index today, of course, being the monthly expiry as well of the Nifty contracts. So just pull up NSDL. Recent listing had it has a decent enough listing, went up to levels of over 1,400 rupees and is now back to its IPO price of 800 rupees is NSDL. That's another 3.5% cut in today's trading session as well. And National Securities Depositories, there you go, 3.5% lower, back at 800 is NSDL. Jyotivardhan Jaipuria, the founder and MD of Valentis Advisors, is now joining in. Jyoti, good morning. Thank you for joining in. All of these, since we are on the subject of NSDL, a lot of these capital market names, what do you do in a scenario like this with these stocks, considering the markets are as volatile as they are, risk aversion being paramount, stocks correcting significantly as well? If you do intend to play this theme, how do you? Do you play it via the asset managers, the depositories like the CDSLs and NSDLs, or do you just play the index?
Yeah, so some of these asset the capital market plays, essentially, the thing you have to remember is we had 2-3 very good years on the stock market. And because of that, earnings were very, very strong with them. So what you'll probably face this year is a situation where earnings will probably be sober for them. So when you look at valuations, you have to build in probably a drop in earnings and then start looking at it. Some of these are starting to get into the zone, but we still don't find them attractive enough at this stage.
Jyotivardhan, broadly on banks as well, we've been having this PSU versus private banking space debate, whether we'll see some re-rating there, whether the PSU space, whether buying there will continue. How are you looking at the situation in light of volatility, at least for the short term, with what RBI is saying, say on the Forex positions? On one hand, in the private banking space, there's been a spate of bad news after bad news with one or the other bank. So where are you seeing genuine opportunity in this current market cycle?
Yeah, so Ritu, you're right. Like for RBI now, every time before the policy, we were thinking whether it's going to be a pause or a cut in rate. But I think now the focus has shifted from probably monetary to the currency. So to that extent, now when the RBI meets, I guess for them, the paramount is defending the currency or stabilizing the currency rather than thinking of whether they'll cut rate at all. So rate cut is probably like not on the cards at all. So when you look at the banks, like for us, we like the banks per se because of two reasons. One is it's one area where valuations are not very expensive. And second is, there'll be a cyclical rebound in NIMs for most of the banks in this fiscal 27. So to that extent, we are inclined to buy a lot of these things. There will be some impact coming from the Forex and, the RBI has made some changes. So probably there'll be some hit on earnings coming to them for this quarter because of the Forex changes they announced over the weekend. But otherwise, we like banks which are relatively cheaper on a price to book. And that's the way we've been playing it, both private and public sector for us. We tend not to distinguish just like that, but we tend to look for banks which are relatively cheaper on a price to book and where we think that the NIM margin rebound is coming and asset quality is under control. So I would say we have a mix of private and public, both banks, but on relatively on a lower price to book rather than a higher price to book.
Right. Jyoti, the last time you joined us, you did say that metals are a hold for you given the run-up that we've already seen and you won't rush to buy them. But since then, because of the geopolitical crisis, we've seen some correction in the metal prices, and as a result of which the stocks have come lower. And as of now, as we speak, commodity spikes are taking place. Do you think that correction is an opportunity to buy the metal space now?
Yeah, so Mangalam, the correction is an opportunity to buy because what we've had is disruption in some of these metal prices. As you know, aluminum plant got hit, and because of that, aluminum prices are starting to go up. So I think metals is a space where, we'll probably be positive. We are at the moment neutralish. We're not really rushing to buy more, but on steeper correction, we'll probably look to buy some more metal stocks.
So is it going to be ferrous or non-ferrous?
So mix of both, actually, I would say.
Okay.
A mix of both, ferrous and non-ferrous, of course. But Jyoti, we are about to begin yet another earnings season, and we'll start off again with these IT names. It's been a forgettable quarter at best in terms of share price returns, at least. But a lot of these brokerages who have come out with previews are harping on the fact that the guidance for FY27 will still be stable/better than FY26, if not more. What are you watching out for these IT companies? And if at all they do end up surprising positively, would you be a buyer in IT?
Almost for us, like we've been negative on them more on a structural issue than really, what the current guidance would be. For us, it is, over the next 3 years, 5 years, these guys are going to go slower than what they've gone in the past. And I would say, quite a bit slower. Just now, just given the way the share prices have behaved, and now it's become very consensus, right, that AI is a threat for these guys. So we've actually started nibbling in some of these. What we prefer is not like the larger IT names, but some of the smaller IT names where, there's niche. So somebody's supplying to, let's say, auto company. So in some sense, it's a play on the auto market. The autos will now get more and more computerized rather than, just a mechanical thing. So those are some of the names where we have seen 40-50% share price drops and where we think valuations are getting attractive enough. So we are looking at some of them. We're not yet bought them, but yeah, it's on our horizon now. We are coming close to probably making a decision on one of those.
Jyotivardhan, very quickly, speaking of thesis, that's become a consensus now. What about the pharma space? That's been a alpha generator for you. The thesis becoming more crowded now, but do you still see an upside in any specific pockets?
So, pharma Ritu we like, and it's always been like great for us. So what we like there is there are lots of names there. So unlike, a lot of other sectors which move as a sector, so the whole sector does well or badly, in pharma, there's a lot more opportunity to hunt for bottom-up plays and create alpha. So it's something which we continue to like, and from my point of view, one is the US generics has done very badly for the last 18 months in terms of share price performance. So I think US generics is also good. The CDMO space is like, it's a huge, multi-year story. The valuations there are not great. So, some of them have corrected and they come in our valuation zone. And even the domestic pharma plays are good. So in pharma, we find a lot more bottom-up opportunities, which are relatively more insulated from what's happening to the war and what's happening to the global politics.
All right, Jyoti, thanks a lot for joining in and, stepping in with some ideas right now. You do like pharma, individual names, the banking space and metals, which you believe should be bought, both ferrous and non-ferrous at the current decline. But, as we wind down on this financial year, FY26 is set to be the worst year for the market in terms of returns in a decade, if you obviously exclude the COVID hit year as well. But history does offer a silver lining. In the last over 2 decades, markets have never declined for 2 consecutive financial years, which means that FY27, could there be gains? Sudarshan.
It's the last trading day of financial year, or say FY26, and market is set to fall for second financial year, so second fiscal, and this year Nifty is down 5%, erasing almost the entire gain that we had seen in FY25. Now, almost 15 Nifty stocks this fiscal have given returns of more than 10%, while 16 are down 10% each, or say more than 10%. So which were the major indices that have seen the negative returns? Nifty Realty down more than 20%. Nifty IT down 20%, and similar move was seen even for FMCG, which has fallen more than 10%. But some of the indices have seen healthy gains. First one is PSU Bank, that has seen gain of more than 30%. Metal up more than 20%. Even Auto Index, all the auto stocks in the second half of this fiscal have been moving higher, and on the back of that, Nifty Auto has moved as much as 14%. Now, amongst all the Nifty stocks, some of the stocks that have seen huge gains: Shriram Finance up 38%, BL 34%, SBI, Titan, Eicher, all these stocks have gained in the range of 27 to 32%. On the losing side, Trent was down almost 36%, followed by TCS 34%. Wipro, Interglobe Aviation and Adani Enterprises too have seen a fall in the range of 20 to 27%. Now coming to the mid-cap names and talking first about those gainers that have seen huge gains. Delivery was on top of the list, up almost 68%, followed by AB Cap up 65%. AO Small Finance Bank too saw a gain of 65%. L&T Fin and Indian Bank have seen a gain in the range, or say 64% each. On the losing side, KPIT Tech, amongst all the IT names, this stock has seen a huge fall, down 50%. ACC too saw a fall of 32%, Jubilant Food 32%, and Tata Chem and Coforge too have seen a fall of 30% each. So what about the next financial year? If you go by the history, after 2003, we have not seen a single financial year, basically for consecutively 2 financial years, where market has seen a fall. So starting with 2003, when Nifty had fallen 13%, next fiscal was up 81%. 2009 down 21, followed by gain of 74%. Similar pattern was seen in FY12 and FY13. FY16 down 9%, next financial year up 19%, and FY20, which was a COVID year, down 26%, and we followed with a gain of 71%. This financial year, FY26, we have fallen 5%. What about FY27? Hope is that we will have a better year, like our tagline suggests. We have to think onwards and upwards.
Oh, well, onwards and upwards indeed. And we would hope that history does repeat itself this time around, with no 2 financial years having ended with losses for the index. So, Darshan, thank you for trying to invoke some optimism in what has otherwise been a very pessimistic quarter, at least a very pessimistic month of March for the markets. Take a short break, focus on the bond markets on the other side with Manisha Gupta.
and India Bonds presents Bond Street.
Welcome back. Let's get you, as promised, the latest from the bond markets. And Manisha Gupta is standing by to give us that update. Manisha.
Well, it continues to be a choppy and a very fluid bond market as well, where the markets are right now reacting to the government's surprise number in sense of borrowing for the first half of this year from April to the month of September therein. It also has to do with the cut in fuel excise duty that seems to be clouding the fiscal outlook within the markets therein. And then you have high state bond supply that we've seen in the previous week. The crude oil prices, which have gained up by 45% in the month of March and are holding above that $115 a barrel, even in the markets today for the Brent prices therein. This is as the West Asia conflict enters its fifth week with no sign of resolution therein. It's keeping all asset classes quite jittery therein. Take a look at the rupee as well, which is not too far away from its all-time low of 94.81 that we saw in the previous week. So there are various factors working at the same time. Add to that the fact that you have seen the FPI-related outflows from the domestic equity markets and the strengthening US dollar holding around that 100 mark. If you look at the FPIs, well, they actually have been net sellers at rupees 14,400 crores in the month of March, which has been the highest ever from the government securities. Now, when you look at the overall numbers here in government securities by the route of FAR, by the way. So when you look at the securities purchases in the Feb, it was at 7,000 crores, much lower than what you saw in the month of January at around 14,600 crores therein. Now, when you look at the FPI's holdings in the government securities, well, on 27th of March, it was at around 3.16 lakh crores. This is versus 3.3 lakh crores that you saw in the month of Feb. So everywhere that you see in sense of numbers, it shows you an outflows, not just from equities, but from the debt market as well. So when you look at the FPI government debt buying overall for the FY26, that is at around just about 10,300 crores. This is the lowest number that you have seen in last 5 years. It was a record number of 1.32 lakh crores in the previous year. So a very sharp decline is what we are witnessing in the current financial year therein. Having said that, there are various reports and suggestions coming in from banks, brokerages, regulator as well, suggesting that retail participation in the bond market is something that is going to grow. 8 to 10% of growth in the country is not possible until you see a better portfolio diversification and money being raised by the debt market as well. Interesting statements also coming in. The bond market was seen at 2% in FY22, and we are looking at that at almost near 3 billion annual coming purely from this market therein. There also is a statement that came in from Deloitte suggesting that while SEBI has made the bond market quite accessible, cutting the investment money from 1 lakh rupees to around 10,000, the bond market is looking to raise almost 2.3 trillion by FY29 is the statement coming in from Deloitte, suggesting that we're looking at growth continuing going forward, especially from retail.
All right, Manisha, thanks a lot for that. We'll take a short break, come back on the markets on the other side. Stay with us.
TV18 and India Bonds presents Bond Street.
Welcome back. On to some updates from the court corner then. Vedanta has moved to the National Company Law Appellate Tribunal challenging the approval of Adani Enterprises resolution plan for the debt-ridden Jayaprakash Associates. Ashmit is joining in with more details on this. Ashmit.
Well, just to clarify, the Vedanta importantly has moved the Supreme Court of the country. What they're doing is essentially challenging the NCLAT interim ruling. What is the interim ruling? Well, bear in mind that Vedanta, while they had challenged the Adani's resolution plan, had sought for an interim stay. The relief that they had been asking for is that while this challenge is underway, while this challenge is being decided, Adani should not be permitted to proceed with its resolution plan. That was a prayer, that was a plea that wasn't granted by the NCLAT. And now we find Vedanta knocking on the doors of the highest court of the country, the Supreme Court. What they're essentially likely to argue is that on merits, they're likely to argue that their bid was substantially higher than Adani's bid. What they're likely to argue is that IBC, the basic fulcrum of the IBC is to ensure maximization of assets, that the COC has not made the right decision, that their bid, Vedanta's bid, in terms of net present value, is over 1,000 crores higher than Adani's bid, and therefore it does not make any sense for COC to side with the Adani bid, and that is the argument basis which they will be moving. They will be asking the Supreme Court to grant some form of interim injunction that will restrain Adani from proceeding with its resolution plan. That is the relief. But bear in mind that between today and tomorrow, these are non-working days for the Apex Court. So the earliest hearing that Vedanta can hope for will be on Wednesday. But clearly that will be a pressing concern on Vedanta's mind, seeking an injunction on Adani from proceeding with its resolution plan for JP Associates.
Ashmit, thanks a lot for that. That's about the Adani, Vedanta and JP Associates saga. With that, we'll wrap up on this edition of Trading Hour. Thank you for watching. The markets continue to stay low. From Ritu, me and Hormaz, we take your leave. Come back on the other side. The team of Halftime Report takes the market action forward. Thank you for watching once again.
Stock slide as the street turns iffy on Trump's peace talk as strikes across the Gulf continue and the likelihood of ground operations rise. Financials and realty are the big drags, while metals and energy see some green.
RBI's directive on Friday asking banks to limit their open Forex positions to 100 million by April 10 sparks a sharp recovery in the Rupee. Banks move RBI to relax the deadline, even as analysts see the cap denting earnings. Banking stock slide.
Continuing tit-for-tat strikes by Israel and Iran dim hopes on early end to the conflict, fueling a jump in oil prices, while direct strikes on aluminium facilities in the Gulf push up aluminium prices in stocks of Indian producers.
Stocks are set to end FY26 on a dismal note, with the Nifty expected to deliver negative returns. The silver lining is that a down year usually precedes a positive return on the fiscal. On the flip side, commodities from oil to base metals to gold and silver see a heady run in FY26. Hello and welcome to Halftime Report, live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra. With me is Sonal Bhutra. Well, it is an all-new logo for CNBC TV 18, but we really need to concentrate on the markets this afternoon because it's not looking good at this point in time. We have the markets off the day's high, so the day's high was around 22,714, and the rupee has failed to sustain its gains either. So the rupee appreciated to levels of around 93.41 on an intraday basis, but as you can see, the rupee is back down to around 94.6 at this point in time. So looking weak both for the equities as well as for the Forex market at this point. So let's see what the second half holds. But as of now, things remain tentative. Hi, Suna.
Hi, good afternoon, Ekta. It is a truncated week. We have the monthly expiry today, and we have broken last week's low of 22,471. So the low today was 22,453. Very important level. It's been quite volatile from the word go. We did see some recovery that got sold into. Again, the markets are attempting a recovery as we speak above the 22,500 mark. But of course, what happens over this holiday that we have tomorrow continues to be in focus. We did see a lot of updates coming by over the weekend as well. But let's take you through what we have on the show today. We put the spotlight on commodities, specifically aluminium and crude, which see an uptick in prices. Following that, we'll also be speaking to Equirus Capital's Vijay Agrawal on the impact of rising crude and rupee on the aviation sector. We'll also be talking to the management of Jupiter Lifeline on the company's Mumbai foray. And in our Commodity Corner segment, Manisha speaks to Samit Guha and focuses on precious metals.
All right, well, let's focus on our big story in terms of what's trending. Commodities are on the boil as the West Asia war enters into uncharted territory, even as Donald Trump halts on planned strikes on Iran's energy infra had failed to calm the markets. Aluminium prices have risen after some aluminium plants were hit by Iranian missiles. Meanwhile, Brent crude prices have hit the highest level since 2022 and have risen 55% so far in 2026 as the US is reportedly ordering thousands of troops to the region. Nigel and Manisha are here with the key developments in the commodity space. First up, Nigel, over to you on aluminium.
Well, that's right. Over the weekend, following an Iranian missile and drone attack on the Emirates Global Aluminium's Al Tawela site, it was damaged, and there is some assessment that's going on that. But you'll be asking, why is this particular facility important? Remember, Emirates Global Aluminium's Al Tawela produced close to 1.6 million tons in 2025. And part of this will be impacted, which in turn will support prices. We already know that the recent supply cuts have already been announced in the Middle East post the breakout of this particular conflict. Qatalum, they pulled back close to 250,000 tons of capacity, and aluminium Bahrain, they curtailed close to 310,000 tons. The ongoing war risks Middle East aluminium capacity on the whole. And to give you a number, the Middle East accounts for close to 9 to 10% of the global output, and they export a large proportion of this, roughly around 6.5 to 7 million tons or thereabouts, of which around 75% is exported. So in short, some of these facilities are getting hit. For the time being, the street is focusing on the supply side shock, and that's why aluminium prices will be supported which in turn will be good news for companies like Vedanta, Nalco and Hindalco. Back to you guys.
Okay, take that point. Thank you so much, Nigel, for explaining this to us. But let's talk about crude prices. What a level, highest since July 2022. Manisha, take it away.
Oh, well, absolutely. I mean, the month of March and this year has been very, very strong when you look at the crude oil prices. And the latest, of course, is that we are heading with quite some strong gains, as you can see on your screens there. The prices have been on the higher side at around $115 a barrel. It has been about Iran suggesting that they could be looking at delayed in sense of negotiations there. US, of course, is talking about negotiations, but landing in more ground troops into the market there. There is a 6th April deadline as well. But within that as well, we are looking at Iran war entering the 5th week here. There is no swift resolution that is inside there. And it's not just about that. Houthi rebels also seem to be getting into this. We also are looking at a statement from Ukraine saying that they have attacked various energy facilities of Russia. And from what we understand in sense of data is that nearly 40% of Russian oil export is out of the market, whether it is in the way of energy facilities or tanker seizures, or even for that matter, in sense of sanctions that have come in from US for that country. There also is a report from Macquarie suggesting that there is a high 40% probability now of the crude oil prices going up to $200 a barrel if this war extends to the month of June. If you look at the overall prices, well, for FY26, we're looking at very strong crude prices therein. There you have it, 45 to 55% of gains coming in for both the crude varieties. You have heating oil, which is more than 100% up, and coal as well has gained up by nearly 40%. Now, when you look at the month of March and the YTD numbers, that tell you a complete picture because most of these gains really have come in during this time as well. So 45% of gains for the month of March itself. You have heating oil, which is up 58% in the month of March, and coal, which is gained up by 12%. And that takes you to a very strong numbers when you look at the current quarter, the first quarter of 2026, where you have nearly 70 to 90% of gains coming in for the crude prices. Heating oil is up more than 115%, and coal is also running in with the energy markets gains. So 35% of a jump up coming in here with nobody telling you to short these levels. Markets do believe that higher highs is what you could be looking at. 120, 125, the high that we've seen in case of war for crude oil is a level markets believe you could be looking at sooner than later.
Okay, all right. Well, it's definitely a commodity push. And as you can see, the Nifty Metals Index is up around 0.7% at this point in time in terms of the markets, as well as the PSE Oil and Gas Index, which is up around 0.5% in what is a very weak market. Thanks, Manisha, for joining in and bringing us all of those details. We need to take a short break, but up next, we'll be connecting with the management of Jupiter Lifeline as it forays into the Mumbai BKC market. Stay tuned. Welcome back. Well, the first management on the show is basically Jupiter Lifeline. The company will set up a 400-bed hospital in BKC and secured land worth around 354 crores on an 80-year lease. To discuss this, we have Ankit Thakkar, CEO at Jupiter Lifeline, joining in. And we will be talking about 3 talking points. First is the plans to set up a hospital in BKC, Mumbai expansion plans and the impact on the war in West Asia. Ankit, thank you very much for joining in and taking us through this conversation. If you could just detail your plans in terms of setting up a hospital in BKC, considering that, you've always been in what would be the micro markets of Mumbai and now you're getting into really the heart of the city. So tell us what exactly is the plan behind it? What are the number of beds that you're planning? By when does it scale up?
Hi, good afternoon, Ekta. So yes, BKC is a new development. We have secured a land parcel of 10,000 square meters. We plan to build around 400 beds on that location. BKC, as I said, is amongst the most important locations in the country. So whatever we do here will definitely be catering to micro markets, but it will also, I think, be a fitting addition to the healthcare landscape of the country.
So Ankit, do you have any estimates? What kind of ARPOB will this area have, estimated occupancies, and will you be able to do better than that? Of course, it won't have initially, but what are the longer term projections that you have here?
So as I've said in the past, ARPOBs are essentially a reflection of 2 things. A, the geography or the markets that you operate in, and 2, the quality and the complexity of the services that you offer. So BKC, in terms of pricing, will benefit from the pricing of Mumbai city. And in terms of complexity or completeness of offering, it will have anything and everything pretty much that healthcare has to offer.
Okay. When you say anything and everything, just give us a sense in terms of what would you focus on? Is it going to be a multi-speciality hospital? What are the prices, considering that, you're currently in micro markets and the ARPOBs would possibly be lower as compared to what you might see in BKC? And what is the competition that you're expecting, considering that it is quite a busy space that you're now entering into?
To take your second question first, I think, I think exactly the opposite. I honestly think it really needs to get much more busy than what it is. If we look at organized large health providers in Mumbai city, you will be able to count them maybe on your fingertips. For a city of the size and scale of Mumbai with 20 million plus of population, you really don't have enough supply of high quality. So I think that Mumbai as a whole is really suffering from a quality supply constraint, and it is really waiting in vacuum for high quality supply to come in.
Ankit, 350 crore rupees, how will you be funding it?
We have enough cash on the books currently. We will also, because this project, we have just been handed over the land, the regulatory clearances, the possession, etc., is likely to take some time. So it's a couple of years of greenfield construction. So the internal accruals that we'll generate over time, along with the cash on the books, should be able to fund part of it. And eventually, towards the end, we may also consider taking some debt.
How much would that be, the debt amount?
Sorry?
How much debt will you be taking?
Remains to be seen how fast it goes on track, how our performance tracks over the next few years. But we should be fairly comfortable taking moderate amounts of debt in the range of 2 to 3 times of EBITDA is what we think is fairly comfortable.
Are you looking beyond BKC and other parts of Mumbai?
Well, so this is a fresh development now. Let us get this project up and running on track. But as I've said in the past, if good opportunities do present themselves, we are awake and listening. We continue to remain focused on Western India. There is no change on that front. for now, I think this is the newest one that I had to announce. Going forward, we remain awake and listening to any new opportunities that may present themselves.
Sure. Well, Ankit just had 2 to 3 more questions which I just wanted to run by you. There's this Rajya Sabha Petitions Committee report which was released just a couple of days ago. So they flagged concerns around pricing of diagnostics, scanning and imaging services. So they've said that, maybe the ministries need to work together to formulate a uniform policy on pricing of diagnostic services. Separately, they've said that the committee has noted that the total procedure cost for hospitals currently remains high, with 60 to 70% costs coming from unregulated hospital charges, and has called for tighter regulation there as well. It's a recommendation, but have you heard anything on the same and anything in terms of an opinion that you might be able to share with us?
I probably missed this report, so I'm not fully aware of the fine print in it. However, I think, if you just zoom out a little and look at the macro global picture, for the quality of care that we provide in India, on a global context, the healthcare pricing in India is lower than amongst the poorest countries in the world. Sub-Saharan Africa offers healthcare at a higher cost than what we do in India, and of course at a much better quality as well. So the realistic aspiration for all countries cannot be that healthcare becomes fully affordable out of pocket. No country in the world, encourages out of pocket healthcare expenditure. We will, as a nation, have to learn towards moving more towards payer-managed, insurance-managed healthcare. And I think that is the way to go.
Just quickly, before we let you go, Ankit, just wanted your thoughts with regards to, anything that has changed maybe on the ground for hospitals post our last conversation when it comes to the Iran war or the war in West Asia. Any sort of disruptions in terms of medical supplies, any higher prices that you all are sharing out at this point?
Well, yeah, last time you asked me about LPG, so that little bit of supply constraint does remain. It is not fully normalized, but it is not in a crisis situation as far as healthcare providers are concerned. Similarly, the supply chain side, I think those consumables which are dependent on petroleum, plastic, rubber, etc., are seeing a little bit of indication of price hikes, though they have not fully come into fruition yet. And we are also hearing of some shipping-related logistics delays. But most people remain cautious.
Got it. Ankit, thank you so much for sparing time and speaking with us about this new opportunity in BKC and the other aspects of the business as well. We'll slip into a short break now. When we come back, we'll connect with Equirus Capital's Vijay Agrawal on the impact of rising crude and rupee on the aviation sector. Welcome back. You're still tuned into Halftime Report. Well, as West Asia war enters fifth week, we are now joined by Vijay Agrawal of Equirus Capital. We'll understand and decode the impact of high crude oil prices on the aviation sector. And of course, we did see some recovery in Rupee today, but again, it has depreciated fast and in the last few weeks. Mr. Agrawal, good afternoon. Thank you so much for joining in. If you can give us some numbers in terms of how big of an impact it would be on EPS of, say, something like an Interglobe Aviation, how big of a hit are they taking with every $1 per barrel increase in crude prices and every rupee depreciation that's coming by?
So, thanks. See, if you see aviation fuel prices have doubled after start of the crisis. And it has, generally airlines have a 30 to 40% as their fuel cost. Now it has become like 70 to 80%, and they can't sustain. So they have started charging a fuel surcharge. So it will have an impact on the passenger traffic. It will have an impact on the cargo traffic. Both airline traffic will be impacted by this cost impact. In India, we are not seeing that impact of a fuel price rise because it is regulated. And probably in the 1st April revision, we will see that impact. And government has also asked OMC to absorb certain cost pressure. So we may not have a same range of impact in India as compared to other countries. In India, the government is trying to, they had reduced the excise duty on petroleum products to maintain the pricing. We have to see the states. See, if you see Delhi versus Mumbai, Mumbai ATF prices are 10% cheaper than Delhi. So we also have an anomaly of this VAT on the ATF prices. And if it can be reduced by the state government, then the burden will be lesser on the general public.
Okay.
And generally, in my sense, every 1 rupee will impact like a % type of price rise on the fuel prices.
Okay. So, Mr. Agrawal, do you think that the majority of the price hikes are already taken in, or do you think that there is more to go when it comes to sort of maybe increasing the surcharges, maybe increasing fare hikes at this point in time in order to accommodate the volatile situation?
No, the price rise has not happened in India. If you see March prices and February prices, there is not big this thing. I think in April we have to see whether it will be doubled or it will be 50%. Globally, like so it was $1 ATF prices, I'm just giving, it has become $2. So that's a price rise which has happened globally. So you will see more surcharges coming post 1st April price revision in India for the domestic flights. International flights already you are seeing a surcharges. Even the carriers have reduced their flights. See, what they are now focusing on occupancy. So wherever sectors there you had 2 flights in the same sector, probably you had reduced to 1. So that 1 flight you are operating at 90-95% occupancy level.
Okay, so that would impact seat revenue per kilometer, or at least would impact the volumes overall. Mr. Agrawal, there is amidst all the issues that we are talking about, there's a new UDAN scheme that came by. It has more viability gap funding. It has more funding for the sector overall. Do you think it will make one, regional flying viable for some airlines? And second, do you think it's the right time? Because at a time like this, not many players would come to the sector overall.
So I think airlines per se globally has been a challenging sector. I think government was more focusing on connectivity in the distance areas and tourism, where the tourism can be attracted. And this scheme is focusing on creating the infrastructure. Like they had allocated the funds for construction of airport or conversion of airstrip, like defense airstrips into airports, and running the flights to those locations. So I'll just give you an example. We are working with one company in Northeast, and they have like 7+ hotels there. And my experience with them was that after this UDAN scheme, they had seen a more increase in footfalls at their hotels. So see, once you have a connectivity, then the tourism increases, which grow the local economy. So it supports. The government is also now focusing. So see, now this scheme is more on the VGF funding, and they will be focusing on a VGF so that there are certain routes which can become a commercially viable routes basis VGF. So I think it's a mix. You have to see more, not only from the airlines perspective, it's an infrastructure development also. So if you look at the overall, this scheme is a very good scheme. And here also you have a helicopter and water planes also covered in this scheme. So that will also increase the tourism in the distant part of the countries.
Okay, all right, Mr. Agarwal, we're going to let you go on that note. Thanks very much for joining in and speaking with us and giving us your view on the aviation space. As you can see, stocks such as Interglobe Aviation under pressure today and have been for the entire month and year, down around 15% for Interglobe on a month-to-date basis and lost around close to 20% of its market cap on a year-to-date basis. We'll take a short break, but up next, we will be speaking with Sudeep Shah of SBI Securities. Stay tuned.
Welcome back. You're still tuned into Halftime Report on CNBC TV 18. Well, Nifty is back below the 22,550 mark, so it continues to be quite volatile. So it's a good time to get an F&O check on the markets. What's the setup looking like? Mangalam is joining us now. Mangalam.
Well, ahead of expiry, if you look at the Nifty's intraday chart, it mimics quite well the way the rupee has moved as well. From the lows of trade, when we saw a recovery upwards of 22,600 for the frontline index, that coincided with the rupee actually having strengthened past that 94 mark as well. But as the day progressed, we saw the rupee move towards the lower end of today's trading range, and you have the Nifty as well, which has moved lower once again. Any intermittent recovery in either was sold into, and that's what explains why ahead of expiry, the Nifty, led lower by the Nifty Bank, is virtually around the 22,500 mark, and the mid-cap index has it worse. At one point, we had 800 stocks advancing for 2,000 stocks declining, and now that those lines have moved further apart as well. But amidst all of this, we do have a bunch of stocks which are shining today, and they are the metals pack. So whether it's ferrous or non-ferrous, SAIL is higher. We have NALCO, which is higher. A metal exposure, Vedanta, multi-commodity exposure, Vedanta is also higher by over 2%. But the active Nifty options tell you that maybe the day's range has been defined. 22,600 calls, very active in today's trading session. And you have the 22,500 put, equally active in today's trading session as well. You put premiums on both of them together, it tells you that maybe around 22,450 or thereabouts is where we see some support, and upwards of 22,650 is where we see this resistance. So a 200-point band is where the street expects March series expiry, and as a result of which, closure of the Nifty at the end of this financial year to be.
Okay, all right, Mangalam, thanks very much for that. So low point of the day was 22,453. So we've recovered from those levels at least, but still some time to go till we get to 22,700 plus. We'll take a short break, but markets move in cycles, and for 26 years we've been tracking them closely, because in volatile times what investors really need is insight, not just information, and above all, perspective, not panic. If you have a question about your investments, we're here to help with guidance from experienced market experts who understand today's fast-changing market environment. So join our special market editors on Your Stocks and MF Corner every day at 2 p.m. and stay one step ahead of the market.
Welcome back. Joining us on the show now is Samit Guha. He's MD and CEO at MMTC PAMP India. Samit, hi, thank you so much for taking your time out. First of all, your sense really on what's really happening in the markets with the gold prices declining for the month of March, for the year 2026 as well. And the fact that the demand also, even with the declining prices, hasn't really picked up.
Yeah, firstly, thank you, Manisha, for having me on the show. It's a pleasure to be here. Good afternoon to all our viewers. I think you're right. I think the Iran conflict really, normally when we have a geopolitical event, the assumption is the price of gold, because it's seen as a safe haven asset, should normally go up. But these 2 months in the Iran conflict, the gold has behaved very counterintuitively. And you rightly said in March, we've seen sharp drop in price of gold and silver. Gold has gone down by about 15% and silver is down by about 25%. And you're absolutely right, Manisha. The first 20 days of March, we saw in the bullion wholesale market discounts being as much as $50 to $60, very tepid demand. Thankfully, in the last 5-7 days, we are seeing the demand coming back. Premiums have come back in the market, and I think the Akshay Tritiya-led buying for minted coins and bars is also picking up. We've seen reasonably good demand the last 4 or 5 days for our minted coins and bars. So I think, yes, March was bad after the February peak. But thankfully, I think that's becoming the new normal now.
I'm assuming March will end slightly on the weaker note. I get your point, Mr. Guha, when you say that April perhaps could be positive because we're looking at Akshay Tritiya, the prices are off its highs, wedding season will start, and in some sense, the festival season also starts to pick up. But what's your sense on the overall buying? Because the expectation still is that jewelry is not going to be a major component. It is going to be investment. So bars and coins perhaps continue to do well.
Yeah. So, India has this 800-ton kind of a steady demand, which so far has been agnostic to everything which is happening around the world. I think last year, 2025, was the first year when the overall, I think, sale of gold went down below 700 tons. And you're right, jewelry has taken a large part of the hit. And coins and bars, thankfully, the numbers are like it was 230 tons year before last, and last year it went up to 280 tons. So we are seeing increase in investment demand for coins and bars, both physically and digitally. Jewelry, yes, because the price of gold is up, especially it is volatile. So I think unless there is an emergency purchase, people are staying away from jewelry for the moment.
Mr. Guha, what is the sense that you make of various gold prices in the country? So one, of course, is the landed cost, the international cost that we look at. And then you have an MCX price, then you have a physical premium or discount therein. And then, of course, we've seen the kind of demand that and the kind of hit that it made on ETFs in the last year itself. How are you reading at these various forces within the country?
So I think internationally, there is always the LBMA price, which kind of guides the international pricing. You're absolutely right. In India, I think there is an urgent need of having a price discovery for spot. And, Manisha, you've seen in various forums, whether it is the industry body or in the ministry, I think there is a recognition of the need for having price discovery for what is really the spot price of gold. And I think various stakeholders are working towards it. But you're right, today for the consumer, there is a lot of confusion in terms of what is the actual price of gold in the international market and how does it translate to a coin and bar and jewelry, because there is the price of gold, there is a premium, there is duty. Then, you have making charges. So I agree it is difficult for an end consumer. But the general trend is that, international market price, caveated with some events which are happening domestically.
Mr. Guha, going forward from here, and we've seen the gold markets in India open up in quite a bit way, from physical to investment to ETFs to digital and even more. What is it that you're looking at? EGR is, again, something that markets are working on very strongly. Exchanges are looking to launch EGR futures as well. How are you looking at this market opening up going forward from here?
So I really think that, the digital investment in gold is an area we should watch out for because, we've really seen very high traction in our digital gold and silver. As you know, MMTC PAMP has been a pioneer in launching digital gold, and end of 24, we also launched digital silver. And over the last 6 months, we've seen huge traction. So I think there will be a shift in the way consumers are today investing in gold, which is largely physical. to also digital. And I think there is enough room for different digital investment platforms to coexist. What digital gold essentially does is it helps in fractional investment of gold. So today, a gram of gold is almost 16,000 rupees. So if somebody cannot afford a 16,000 rupee ticket, that he can invest in as low as 10 rupees. So I think there is a large play which will happen in the way people invest in gold and silver digitally. Also, I think India is almost half of its investment if you compare globally in terms of coins and bars. So I think there is room for additional investment in gold and silver. I think what the last rise in price of gold and silver has done is I think people are now very actively looking at gold and silver being a part of their investment portfolio. And I think that will really open up a very large investment market for gold and silver in India. And the traditional jewelry, which is, backed by our culture, heritage, I think that is always there to stay.
A quick final question on silver as well. And as you said, the silver digital is something, is the latest piece that you have put out and seems to be doing well as well. So when you look at gold and silver, where do you see better investment, bigger ticket size coming in?
So I think, of course, ticket size in gold will continue to be much larger than silver. And I think that's why silver is doing well because, it's poor man's gold. But I think silver is very unique, Manisha, because in addition to being an investment asset, and people are increasingly looking at silver as a possible option to gold when it comes to investment in precious metals. So there is that investment demand which we are seeing in silver. In addition, silver also has this huge industrial application. More than almost 50% of the global silver demand in the world is coming from industrial application, especially, PV, which is for the solar industry, EV, and electrical. And I think because it is so uniquely positioned as an investment asset as well as an industrial usage product, I think I see a very bright future for silver. Both in terms of consumption and I think in terms of pricing.
Okay, bright future for silver. Well, thanks. That would be music to a lot of investors' ears. Thanks, Manisha, for taking us through that conversation. We need to take a short break with the news that we have the Bank Nifty, which is down close to 1,400 odd points, and the Nifty, which is still reeling under pressure. So good time then to get a tech check in. We have Sudeep Shah of SBI Securities, who will be joining in just after a short break.
Welcome back. You're still tuned into Halftime Report. Well, it is March expiry from 31st or from the 1st of April. We'll see the new series, and of course, it's the end of this fiscal year as well. So let's take a look at what happened with FII flows, because that's been the big trending story that we have been talking about as well, right? So March saw outflows of 1,11,377 crore rupees, and out of the 12 months in this fiscal, only 3 months, that's the beginning of the fiscal year 2026, saw inflows coming in to the tune of 7,489 for June, around 11,800 for May, and 2,735 for April. Barring that, it has been a slew of selling from the FIIs, numbers going as high as 1,11,000 crores to around 47,660 crore rupees. So there's been continuous pressure that has come by from FIIs. And of course, we start the new fiscal, and I think March felt the longest in terms of a month in the fiscal year 2026. But that's been a big selling number that we've seen from the FIIs.
Yes, and just to add to that point, the net outflow has also been negative. So a lot of the times we've seen the DIIs buy more than the FIIs. But in the past couple of sessions, say maybe in the past 6 odd sessions or 8 odd sessions, we're now seeing that sort of ratio change much more than earlier, where the net outflows are still negative. So we have the DIIs buying, but not as much as the FIIs selling. So that is also definitely a disconcerting chart, and something to watch out for, which is obviously pressuring the rupee and the equity markets. We have Sudeep Shah, Head of Technical and Derivative Research, SBI Securities, who joins in on the show. Sudeep, hi, welcome to the show. Well, it is turning out to be a weak session. We haven't been able to sustain the levels that we saw on an intraday basis, both for the equities as well as for the rupee. So how would you approach today's trading session given the volatility?
Good afternoon, Ekta. Ekta, absolutely. In the morning, if we see the first round of pullback got completely sold into, and we are seeing that resistance at 25,650, 25,700 for the day. And overall, if we see positionally also, if we see the weekly charts, there is a clear series of lower top, lower bottom formations. And I feel the trend is getting incrementally weaker. So rather than trying to catch the bottom or trying to catch the next support, I guess we'll have to concentrate more on the resistance. Those levels crosses, we can try of going long, going on the long side. So 22,750, 22,800 from a Nifty perspective remains an important resistance. On the downside, 22,200, 22,100 now will be the next support going forward. From a Bank Nifty perspective, 51,500, 51,700 we feel now will act as a strong resistance on the upside. Any buy calls or any views on buying, I guess would fructify only once Bank Nifty crosses above 51,500 on the upside.
What about individual picks, if you can quickly tell us that?
Yeah, so Sonal, the stocks that we like, there are a couple of stocks which buck the trend, which are right now showing some kind of relative strength better than the market.
Sudeep, we'll connect with you again. Looks like it's a patchy line, but Nifty continues to be at an important juncture. We have broken last week's low, but we've recovered from that as well. So continues to be very volatile. Again, it is the monthly expiry. From 1st of April, we begin the new session in terms of April series. So a lot to talk about. And of course, it's a truncated week. We have a holiday tomorrow and on Friday. So whatever happens with West Asia crisis will continue to be on our radar.
Yes, absolutely. And we have a lot of time to possibly soak it in and react the next day. But thanks very much for joining in from the entire team of Halftime Report. It's a wrap on the show. Business Lunch will take all of the action ahead. Stay tuned.
Stocks slide as the street turns iffy on Donald Trump's peace talks as strikes across the Gulf continue and the likelihood of ground operations rise. Financials and realty are the big drags while metals and energy see some green.
RBI's directive on Friday asking banks to limit their open Forex positions to $100 million by April 10th sparks a sharp recovery in the rupee, but the currency comes off its opening highs. Banks move RBI to relax the deadline, even as analysts see the cap denting earnings. Bank stocks slide.
Continuing the tit-for-tat strikes by Israel and Iran dim hopes on early end to the conflict, fueling a jump in oil prices, while direct strikes on aluminum facilities in the Gulf have pushed up prices of the commodity in the global markets. Along with that, stocks of Indian producers as well.
Stocks are set to end FY26 on a dismal note, with Nifty expected to deliver negative returns. The silver lining is that a down year usually precedes a positive return fiscal. On the flip side, commodities from oil to base metals to gold and silver see a heady run in FY26.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Patakia. With me as always, Arundhati Raman. And Arundhati, good afternoon.
Good afternoon, Hormuz. I mean, it's the same story again, right? The war in West Asia not letting up. It's roiling markets around the world. And it's the same story for the Indian markets as well.
No change whatsoever. Starting off from where we left off last Friday, sentiments continue to remain firmly risk-off, and there are multiple factors behind that as well. Of course, tomorrow being a holiday, so the expiry has been pushed to today being the monthly expiry, so that brings along with it its fair share of volatility. But on the flip side, the Dow futures, where they were down around about 300, 350 points earlier in the day, have reversed course and are now trading higher by over 100 points. That's the only positive. The other moving parts are still the same. Oil prices continue to remain higher. Brent is still around about 115 plus a barrel. This is for the May contracts. The WTI is also well above 100. The dollar index is above 100 as well. So there has been no let off there. The currency, which had strengthened earlier in the day, has given up most of those gains, is still trading around about that 94.30, 94.40 range on last check. Oh man, it's recovered almost, given up almost all of those gains now from the morning. So 94.63 is where the currency is, and the Nifty Bank, no let off there as well. It is the financials that are leading this fall in today's market. The Nifty Bank is down 1,500 points, and with that, it's just around about 1,400 odd points away from entering bear market territory. So absolutely no let off.
Absolutely. As you pointed out, it is the financials that are feeling the pressure, feeling the heat, and that's what's bringing the market down, right? Take a look at the PSU Bank Index. It's the top loser, down over 3%. Canara Bank, Union Bank, Bank of Baroda, all of those stocks are seeing cuts of over 4%. Even the private banks, take a look at it. Axis Bank, IndusInd Bank, IDFC First Bank, all of them down over 3% in trade. Realty stocks also seeing big cuts. We've got Prestige that's down 4%. We've got Brigade that's down nearly 6%. And Lodha, which is down over 3% in trade. Now, the only little bit of green that we're seeing is with those metal names. We've got Hindalco, which is up 2%, Nalco up 5%, SAIL up 5%. And that's how the markets are looking today. Financials seeing the most pressure. But you know, the other story today is that rupee, right? The rupee opened sharply higher at 93.58, but has now fallen back to 94.63 levels. The strong opening was because RBI on Friday evening capped the total positions that the banks can take in the onshore currency market to $100 million. Separately, bond yields have risen despite the government announcing a lower than expected borrowing in the first half of FY27. Lata Venkatesh is here with all of those details. Lata?
Yes, the rupee did start higher as was expected and very strongly higher at 93.58. But there is a lot of demand, dealers tell us, from oil companies. They are buying dollars to buy oil because apparently the Russian oil permission, the leeway given, is going to expire shortly, and that's why there is a rush to buy Russian oil, and the dollars are in demand. Separately, what is the position for the banks itself? Yes, the rule said on Friday evening that banks have to cut down their open positions in the onshore market, here market, to $100 million. Actually, there has never been a limit on the gross positions. The limit was always on net positions. So banks could take any amount of positions. But if they had a contra position in the NDF or the offshore market, then the net would be very small. It would be within the limit of tier 1, 25% of their tier 1 capital. But now, since the gross position itself has been limited to 100 million, there is huge selling of positions by the banks. Why is it that the rupee has recovered? The other reason could be that many corporate clients are ready to help banks by taking their positions on their books. There is no limit for them to keep open positions. Corporates don't have the limit. Limit is only for banks. So apparently many corporates are going with offers. There also the banks suffer a bit of loss, but a little less than if they offloaded in the market. However, the bank losses seem to be trimming. If you looked at, say a 1 month contract, forward contract for the dollar rupee in the NDF market and in the onshore market, in the morning, the difference was as high as 70 paise. Now it has come down to 30 paise, and mostly people have 1 month forward contracts. If you look at a 3-month contract, that also has fallen from about over 1 rupee to about 55, 60 paise. So it looks like ultimately how much banks lose on every contract will depend on the end of the day difference between the forward rate, the NDF rate, and the local currency onshore rate. So we will have to wait to see to end of day. It's almost 40 billion. All these are guessworks of long positions that various banks have. Who knows everyone's positions? Only the Reserve Bank knows. The guess is about 35 to 40 billion. How much will each contract lose? We will know by end of day. But now banks are guessing that the loss may not be too much because the difference between the two is shrinking, the NDF market and the onshore market. Also, the loss has to be taken this quarter. There was some hope that, because you've got time till April 10th, whether some of the losses can be taken in the next quarter. No, it is a mark-to-market loss and it has to be absorbed in this quarter.
It has to be absorbed this quarter, and that is possibly the reason why you're seeing that kind of a reaction in banks.
If I may just add about the bond markets. The bond markets were expected to recede. The yields were expected to fall and bond prices rise because the government announced only a 51% of borrowing in the first half of the year that will start in 2 days. The expectation was they will borrow 54% of the total, which is what they usually do. In the first half, they borrow a little more. This time, they're borrowing just about 51%. Expectation was there be some improvement in yields. No, yields have risen by about 2 or 3 basis points, and that's not far to seek the reason. Crude prices are even higher. The war has got even more intensified. But most importantly, the bond market now thinks that if the RBI can take such a radical step to curb the rise of the rupee, who is to say that they will not raise interest rates to defend the currency? Even that's not out of the realm of possibility. So yields have started moving higher.
The yields have started moving higher. It's almost 7% now on the 10-year. And you lost count of the number of whammies that you have now for the banks, be it private banks or the PSU banks. You can see that in the price action as well. 1,500-point cut on the Nifty Bank and an equal cut on the PSU Bank Index as well. Lata, thank you for that. And earlier, Neeraj Gambhir of Axis Bank said that the move will break the link between the onshore and the offshore market. Listen into what he had to say.
It will break the link between the offshore market and the onshore market. Banks will no longer be able to arbitrage between onshore and offshore, and hence any activity that takes place in the offshore market will not necessarily transmit into the onshore market. Obviously, this has been done to curb some level of speculation that was going around probably in the offshore market. So I think that's the broad impact of this move. What Rupee does, obviously, in the short run, over the next few days, as the banks are required to square off their positions, that is what will happen. I think in the short run, positive for Rupee, but in the long run, I think fundamentals will prevail.
On that note, it is time for us to head into a short break, but more news and updates follow on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. The United States war in Iran is now into its 5th week, with all involved parties continuing to threaten attacks and escalate strikes. Israel and the US have continued to strike Tehran, while retaliatory strikes on Gulf states have also carried on through the weekend. Staging from the White House over a ceasefire continues to be mixed, even as US Marine ground forces arrive in West Asia. CNBC's Dan Murphy joining us with more. Dan?
Good morning to you from Dubai. And as you say, Operation Epic Fury now in its 5th week. We're also seeing oil prices pushing higher again this hour. Brent holding at around $115 a barrel as the market absorbs what has really been a steady drumbeat of escalation with no clear path to resolution. President Trump's declaration that he wants to take Iran's oil in the Financial Times, while also simultaneously saying a peace deal could be made fairly quickly, is pressuring the market to the upside and, of course, creating a lot of confusion for market traders out there. What was also interesting was that at the weekend, the Pentagon also said that it was nonetheless pressing ahead as well. The Washington Post reporting that the military is now drawing up plans for weeks of limited ground operations, potentially including a raid on. Also reporting that Trump is weighing a mission to extract nearly 1,000 pounds of highly enriched uranium from Iranian facilities as well. It's an operation that would likely put American forces inside Iran for days or for longer. Meanwhile, the conflict also changing color on the weekend as well. The Houthis firing a round of missiles at Israel, deepening their involvement and raising the risk of a blockade at the Bab el-Mandeb Strait. This would be a second critical choke point for global energy supplies. And then on the diplomatic front as well, regional foreign ministers met in Islamabad at the weekend. Pakistan saying it's ready to host these direct talks. Iran has agreed to allow 20 Pakistani flagged ships through the strait, but 2 vessels a day against a pre-war figure of around 130 means the waterway is effectively still closed. So we have seen progress on the diplomatic front, but of course, very little progress indeed. And at the same time, the military buildup is continuing. So traders here don't necessarily really know what to expect. The big question in the region right now is whether or not the US will go ahead with what could be a limited ground operation inside Iran to take the oil, as the president said in the Financial Times. But of course, exactly what could trigger that and when remains to be seen at this point. It's back over to you.
Dan Murphy, thank you for that update there. Now, noted economist Noria Rubini has warned that President Trump is likely to step up military action in Iran, risking a hit to the global outlook. He also adds that the baseline scenario is a slowdown and not a recession or a stagflation. Listen in.
My baseline is not stagflation or recession, it's a slowdown of growth. This is not like the 1970s, but it's not as mild as the June war that lasted only 12 days. The question is, what are the likely scenarios? Now, people make the argument, and this is commercial wisdom, that Trump and Israel miscalculated on 2 things. One, believing that the initial decapitation of the leadership is going to lead to regime collapse and regime change. 2, that Iran would be unwilling and unable to essentially block the Strait of Hormuz or attacking the energy facility of the Gulf. Those 2 things have turned out to be wrong. But now the conventional wisdom says that Trump is looking desperately for an off-ramp. His polls are down. He wants this war to be over because there'll be damage for the economy, growth, inflation, and the midterm election. But if you think about it, the damage has already been done. If there is a ceasefire on conditions that are Iranian style, he's going to look like a loser. His credibility weaker, is going to lose the election for sure. So my actually argument is that counterintuitively, he's going to decide to escalate. He's going to escalate by taking over Karg Island, continue to bomb with Israel the leadership of Iran and the military structures. And if everything goes well, maybe the war lasts a little bit longer because of this escalation, but then you could have regime collapse. And while in the short run, oil prices are going to be higher, if then there is a regime collapse, then you're going to have a situation that is better for the world in terms of geopolitical stability. The risk of it is that if you escalate and then the Iranians are able to continue to block Hormuz or attack the oil facility of the Gulf, then you end up into 1970s stagflation. But I think at this point, it's going to escalate. From his point of view, it's worth taking that risk, given the option value of winning the war.
In the face of this, are markets too sanguine?
In some sense, they are too sanguine because currently the markets are still pricing in the fact that the war is not going to last more than a few weeks, that they're looking for an off-ramp, it wants negotiation, it wants to end it, and therefore, even if that implies that there'll be a medium-term risk premium to oil prices, the market probably price in and prefer the war being ending soon. If it don't end soon and you have escalation, you have a binary situation, you escalate, you win, and then that's better for the world and for the market long term. But if you escalate and you don't win, they end up into 1970s stagflation. So the question is whether the market is pricing in the tail risk of ending up with a long war, with a shock like the 1970s, and then with stagflationary consequences for the world. It's not my baseline, but probably is a tail risk that the markets currently are not fully pricing in.
It's time for us to take another short break, but more news and updates follow on the other side. Stay tuned.
Welcome back. Shifting focus back to the banking space then. Operations at branches of Kotak Mahindra Bank and AU Small Finance Bank in Haryana's Panchkula were disrupted, with police personnel not allowing bank branches to be opened. Sources, however, tell us that operations are now coming back to normal. Ritu is here with more details. Ritu.
Well, our viewers can clearly see from the visuals on the screen right now, police deployed outside branches of both Kotak Mahindra Bank and AU Small Finance Bank. And these are visuals coming in from Panchkula in Haryana that our reporters on the ground sent this morning. Now, in Panchkula, we understand that the bank staff were reportedly prevented from opening their own branch locks. The police presence, of course, is being linked to the Haryana government investigation into suspected unauthorized transactions in the state government accounts that are held at both these banks. Now, the latest we understand from our sources at both of these banks is Kotak Mahindra Bank branches are now open and they're functional, and AU Small Finance bank branches are also resuming operations after this morning's disruptions. Now, we've reached out to both of those banks for their official comments that are still awaited. Now, just to give you a quick context, Kotak Mahindra Bank last week had clarified it was undertaking a reconciliation exercise at the behest of the Panchkula Municipal Corporation, which falls under the Haryana government, which had flagged irregularities in its deposit account. And similarly, last month in February, AU Small Finance Bank, along with at the time IDFC First Bank, had disclosed that the Haryana government had de-impaneled them from any state government business because of unauthorized transactions that were suspected at the time. AU had clarified at the time that there was no evidence of fraud, while IDFC First Bank had subsequently paid more than 640 odd crores to the Haryana government to close its part of the matter. Now, separately, sources are telling us that Kotak Mahindra Bank has also paid more than 120 crore rupees to the Haryana government linked to the Panchkula Municipal Corporation case. So the money has been paid on account of the discrepancies that may or may not have been found, because importantly, we understand the matter is not yet closed and the investigation in the Kotak case still remains ongoing.
All right, Ritu, many thanks for taking us through all of those details. But if you take a look at the markets, they're still deep in the red. The Nifty is down over 340 points below that 22,500 mark. It's at 22,471. If you take a look at the mid-cap index, that's now down over 2%. Sensex 1.5% down, but it's the financials that are feeling the pressure. The Nifty Bank down over 3%, seeing cuts of 1,580 points as we speak. So not good, not looking good for the financials today. But with that, it is a wrap on this edition of Business Lunch. Midcap Radar will take all the market action forward.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Putra. With me today is Ekta Batra. Ekta, good afternoon. Road respite for the market so far. We are below the 22,500 mark as we speak. Across the board, there's some selling pressure. Midcaps down 2%. Even Bank Nifty is down almost 600 now.
Hi, Sonal. Yes, absolutely, and no respite really on the currency as well. So good time then to take stock of all of the top headlines that we're tracking this afternoon. Stock slide as the street turns iffy on Trump's peace talk as strikes across the Gulf continue and the likelihood of ground operations rise. Financials and realty are the big drags, while metals and energy see some green. Mid-caps underperform.
RBI's directive on Friday asking banks to limit their open forex positions to $100 million by April 10th sparks a sharp recovery in the rupee, but currency comes off its opening highs. Banks move RBI to relax the deadline even as analysts see the cap denting earnings. Bank stocks slide.
Defence stocks rally. The Defence Acquisition Council clears acquisition proposals worth 2.38 lakh crore rupees for equipment including hovercrafts, air defence and communication systems.
And shares of Urban Company rise over 4% in trade today. The company's Star Help segment records over 1 million monthly delivered bookings in the month of March. Okay, those are the top headlines that we are tracking currently. A lot of moving parts in the broader markets. We'll discuss that in greater detail. But it is the West Asia war which continues to impact our own markets. It's the monthly expiry, and then we start after a break the fresh new April series. But for now, the Nifty at the day's low, Ekta.
Yes, absolutely. The Nifty is at the day's low. We do have a lot of stocks which are in focus on account of news. So NBCC, as you can see on your screen, has announced an agreement for a project management consultant services business worth around $75 million with the Republic of Seychelles. So good news coming in, but no respite really for the stock at this point in time. Bank Nifty down 3%, but we have a lot of mid-cap stocks to look at. And this is our segment, Mid-Cap Movers. We have Upasna to take us through all of the stocks that she's tracking. Upasna, over to you.
Well, certainly the sell-off continues as the West Asia war intensifies, and we can certainly see the impact on the mid-cap index as well, which is down about 2% as we speak. Now, let us look at some of the losers into today's trading session. Grow, HEG, Apar Industries, Ashok Leyland, and Swiggy. All these counters are seeing deep cuts of about 3 to 6%. Now, let us look at some of the defense stocks which are trading lower. Mind you, defense was at one point of time trading higher, but there are some of the stocks which are seeing deep cuts, such as Cochin Shipyard, which is down about 4%, Data Patterns down about 4%, and even MTAR Tech is down about 3.7%. Now, let us look at the key stocks which are near its 52-week low: ACC, Bharat Dynamics, and followed by Cyan DLM, which is down nearly about 3%. Now, on the flip side, now let us look at some of the gainers in today's trading session. Urban Company is buzzing today, up nearly more than 6%. This is on the back of the Insta Help that crosses 1 million monthly bookings in the month of March. IRB Infra is one of the key volume buzzers today. The volume is up nearly 4 times as compared to the 1-week average. KNR Constructions has received LOA worth 1,734, is again one more volume buzzer, and the volume is up 38 times compared to 1-week average. MRPL and Chennai Petrol also in focus, up nearly about more than 2% in today's trading session. Now, next up is the metal stocks. Even they are in focus as the war intensifies. Nalco and SAIL both up more than about 4%. And lastly, coming to the sugar stock, they remain in focus since the start of the trading session today. Now, they are trading higher on geopolitical oil shock, which is leading to an ethanol boom. Dhampur Sugar up nearly about 7%, Dwarkesh Sugar up 10%, and lastly, Sri Renuka, which is up nearly about 6%. So all in all, these are the key stocks that are moving in today's trading session.
A comprehensive list. Thank you so much, Upasna, for joining in. It's a good time to get a technical check on the markets. Ruchit Jain from Motilal Oswal Financial Services is joining us now. Ruchit, what next? We've broken important levels. That's the low of last week. Last 1 hour can be very interesting and quite volatile. What are the charts suggesting?
Yeah, hi, very good afternoon. Well, that low top, low bottom structure on the Nifty as well as the mid cap and the small cap indices still continued. Last week, we did see some in between pullback moves which are sold into. So until we get that signs of trend reversal, I think the near term trend still remains negative. I think main factors would be to watch out would be the factors on which, due to which the markets have corrected, whether it be war related news FIS selling, which has been still consistent in the cash segment as well as in the derivative segment, and the USD INR. Today, there were hopes that INR at least would see a reversal. But post-opening, we have again seen INR getting depreciated. So I think until we see any kind of positive factors or positive reversals in these things, market trend would remain on the negative side. We are approaching that oversold territory from where we could see some kind of reversal, but that major support zone is placed around 22,000 to 21,700 positionally. The weekly 200 EMA for Nifty comes around those levels. So I think if we get some dip towards 22,000, those would be good levels where one can expect a decent bounce at least.
Okay, all right, Ruchit. Well, in terms of specific stocks, what would your approach be in this market?
I think certain banking stocks are witnessing underperformance. So Bandhan Bank is one stock where if one wants to trade for the short term, can trade on the short side, where the trend remains very weak. One can go short in April futures in Bandhan Bank with stop loss over 147 for potential down move towards 134. And pharma is one space which relatively looks better in such environment. And Glenmark Pharma within the space, overall structure remains positive. The 50 DMA is holding out. So if anyone wants to take contra bias trades, then Glenmark Pharma can be bought with stop loss below 2040 for potential up move towards 2330.
Okay, take that point, Ruchit. Thank you so much for joining in. Interestingly, as you said, pharma has been a defensive space. So we'll discuss that and a lot more. We'll slip into a short break now. When we come back, we'll talk about markets, stock-specific action, and a lot more news updates on the other side.
Welcome back. Well, for the markets, it's definitely weak at this point. We have the Bank Nifty, which is shedding around 1,550 odd points as we speak. IndusInd Bank is your top loser on the Nifty, down around 4 odd %. And remember, it's already lost around 20% of its market cap this year. We have even Axis Bank, which has lost around 16% of its market cap this year. So it's been tough times for all of these banking stocks. But let's get across to Sudarshan, who's in fact tracking a rate-sensitive sector, which is autos. He's here with a March auto sales preview. Sudarshan, tell us more.
So we're at the end of financial year, say FY26, and day after tomorrow, all these auto companies will start reporting the sales numbers for the month of March 2026. And as of now, there is no impact being seen as far as the West Asia war is concerned. Production for majority of the companies has been normal, but sources are saying that if the gas supply issue lingers or it's prolonged, then production cut might be seen for a majority of the auto companies. And also March sales will be positively impacted with the onset of Navratri early. So this year, Navratri was from March 19 to 27 against March 30th to April 7 of 2025 last year that we had seen. Now, considering all the factors, we are expected to see a double-digit growth for majority of the segment. Passenger vehicle is likely to see a growth of 10%. Two-wheeler may see a growth of 18%. M&HCV and tractor too may see a growth in the range of 12 to 13%. Now, starting with two-wheelers, Bajaj Auto, TVS Motor and Eicher or say Royal Enfield are likely to see a growth of double-digit, while for Hero Moto, growth can be of 9 to 10% year-on-year. In the passenger vehicle space, both Maruti and Mahindra Auto can see a growth in the range of 10 to 13%, while the outperformance can come from Tata Motors passenger vehicle, which can see a growth up to 25%, while for Hyundai, it can be a flat month. In the commercial vehicle, both Tata Motors commercial vehicle and Ashok Leyland can report a double-digit growth. It can be in the range of 12 to 13%, and in the tractor segment too, Mahindra and Mahindra tractor segment can report a growth of 12%. So for the month of March, all the companies are expected to report a double-digit growth or likely in this that range, but we'll have to see how long this gas supply issue persists. If it lingers, then it might have an impact on the production.
It would. Thank you so much for bringing us all those details. But this is what we're expecting from March auto sales, which will be reported on the 1st of April. But Urban Company is a stock which is doing well in an otherwise weak market. Manglam is joining us to tell us what's happening here. Manglam.
Well, you know, after a big correction from its 52-week high, nearly 40%, all of this month, the stock has been doing well, briefly dipped below its issue price. That's when brokerages started to take note. And we also had a fund, SBI MF, top up on Urban Company as well. So this month, the stock is up 13%. Importantly now, the development is where the company has said that InstaHelp has crossed 1 million monthly delivered bookings in the month of March. And that's after having conquered the 50,000 booking per day mark in February itself. And to just explain the kind of scale that InstaHelp has taken, it was started just a couple of quarters ago. In the second quarter, it did 0.58 million throughout the quarter. In the third quarter, which is seasonally a very strong one given Diwali and, you know, the kind of InstaHelp required with the offers that the company was giving, that entire quarter it did 1 million. And now, in the month of March itself, with 3 days remaining, the company has gone ahead and done 1 million. In the third quarter, the revenue was 7 crores. The company reported an EBIT loss in this business of 61 crores. But importantly, they said that while this is a growth business, this loss per order will reduce over time. So with scale coming in and loss per order reducing over time, it's a big positive for Urban Company as a growth driver. And that's something we will monitor as a trigger for the company. The other triggers, obviously their core business, the India services business, how that performs, scale and competition in India, InstaHelp with Snabit and Pronto, all of them raising money in the private markets right now. And finally, profitability and scale of their consumer durables business, which is native, how that pans out could be an optionality. That explains why Urban Company has been outperforming all through this month.
Okay, all right. Thanks very much for that, Manglam. So that's Urban Company, up around 6 odd % in a weak market. Just want to point out that the European markets have opened and they've opened lower today. This is as, you know, the war in West Asia continues into its 5th week. Remember that we had Asia, which was lower in today's trading session, which was led really by the Kospi. And now we have the European markets, which are a bit subdued in terms of opening as well. We'll take a short break, but we'll get you more on the markets. A lot of stocks in focus on the other side. Stay tuned.
Welcome back. You're still tuned in to Mid-Cap Radar. Well, the government has announced approvals to investments of 7,100 crore rupees in the fourth round under electronics component scheme. Projects approved will see total production of around 85,515 crore rupees. Dixon Tech receives approval for around 1,100 crore worth of project under ECMS scheme. Ashmit Kumar spoke to Sunil Vachani of Dixon Tech. Let's listen in.
ECMS scheme is very timely. It's a very important scheme because, as you know, that we have achieved substantial progress as far as the scale is concerned. You know, we have already set up very large scale for manufacturing of mobile phones and other electronic products. Electronics as a category now is the third largest category for exports. We're exporting almost $50 billion worth of electronic products as a country. So I think what was required was a very strong and robust component ecosystem to make sure that the success that we've achieved is sustainable. And I think this is what the ECMS scheme is doing. At Dixon, we had already received approval, as you know, for our camera module factory. And I'm very happy to share that we have scaled up the production there substantially. We are looking at manufacturing almost 100 million camera modules pieces per year. As far as the display factory is concerned, we're very happy that we've received the ECMS approval today. And I'm also very happy to share with you, and this has been shared earlier, that we should hopefully start the production by July or so. And once we start the production, the trials start, we are hopeful that the value addition that was hovering at about 18% in the country for mobile phones will go up substantially to almost about 40% with both the camera modules and the display modules being produced in the country. Also, the factory that we are setting up for manufacturing display modules, very happy to tell you that this is going to be the most backward integrated factory. Kind of the processes that we'll be doing here, I don't think have been done so far. The COG, FOG, the polarizing, the bonding, the cutting of the glass, right? So I think this is a substantial step for India becoming Atmanirbhar.
Can you give us some indications? 3 proposals have been approved. How many are still pending? How many will still need the government's nod?
Well, are you talking about the PN3?
Yes, about the broader PN3 scheme.
Well, PN3 is now only one approval is pending. And as far as ECM is concerned, I think we will be looking at, making the investments now in the mechanicals, both for the mobile phone vertical as well as the IT hardware vertical.
The minister left while sharing some strong words about the need for design capabilities. Is that going to be the next focus? The minister says he's not going to make any exception. He wants a design to be made locally as well.
Well, very rightly so. The Honourable Minister pointed out a few things that now the industry should be focusing on, because I think the government has already done their part. They've come out with a very good policy framework, whether it was the PLI and now the ECMS. He rightly mentioned that now the focus needs to shift on skilling of the people. Sure. The focus needs to be on design of the products in India so that we become a products nation rather than just manufacturing in the country. He talked about creating a robust supply chain in the country. So I think, and of course, last and not the least, building Six Sigma quality. Mm-hmm. So I think these are very, very important, initiatives, very important focus areas that the minister highlighted. And I think the industry is already working towards this, but we need to make sure that we now come together, the all industry associations come together and really, set out a roadmap for the country and for the industry.
Okay, all right. So that's Dixon Technologies. But one sector that we should look at and keep our eye out on is the entire diagnostics and hospital company space. Now, the Rajya Sabha Petitions Committee has released a report recently where they flagged concerns around pricing of diagnostic, scanning and imaging services, noting that currently neither the Department of Pharmaceuticals nor the Ministry of Health has clear oversight on pricing. The panel has in fact recommended that ministries should work together to formulate a uniform pricing policy when it comes to diagnostic services, which are aimed at reducing the burden on patients. Now, separately, the report also takes a wider view on healthcare pricing. While cardiac stent prices have been cut by up to 85% and knee implants by 70%, saving around 5,900 crores annually, the committee notes that total procedure costs remain high, with 60 to 70% of costs coming from unregulated hospital charges, and has called for tighter regulation here. Now, on medical devices, the panel has flagged inflated MRP practices where hospitals prefer higher priced products, and it has recommended the NPPA monitoring of import prices versus the current price, and that hospitals should offer patients choices across price points with transparent display when it comes to medical devices. So that's the reason why you're seeing diagnostic stocks maybe a little under pressure, as well as hospital stocks, on the fear that maybe there could be some amount of stricter regulations which could be coming.
Okay, all right. That makes sense. Thank you so much for bringing us all those details. But this is Midcap Radar. We have to talk about midcaps. And Nimish is joining us to talk about midcaps, which have been bucking the trend, the market trend, since the beginning of the West Asia war. Nimish, take it away.
Hi, Sonal. So I'll talk about the names which are bucking the trend, but first the picture on what's happening in the market since the war broke out, right? Every index is down between 9% to 13%. So this is what, since the last 1 month, the Nifty is down 11%, Bank Nifty is the biggest hit, down 16%, others are down 10%, 11% each. So that's the kind of fall we've seen in the indices. The next plate would be how much has been the pain in the broader markets and across the board. Basically, it shows the breadth of the market. The breadth has become extremely poor in the last 1 month. In the Nifty 50, 46 stocks are down. In the Bank Nifty, all 14 stocks are down. In the mid cap, 90% of the stocks are down, and so is the case with small cap and the Nifty 500 as well. So the damage has been very severe across the board, across all indices in the last 1 month or so. And that's the reason why some of the stocks which will come up is really bucking the trend. The few winners, and this is the Nifty 50 stocks that I've picked up from. In the last 1 month, Premier Energy is up 21%, Wari is up 14%, Acme Solar 10%, so is Ether Energy, and so is Emcure Pharma. This is the first list of stocks. The second list will also come up. The likes of Happiest Minds, of course, there was a news there, but Adani Power is up 9%, Aurobindo Pharma is up 8%, Linde, I think it's fallen today, so it's pretty much flat, and Granules is up 7%. What stands out is, in this winners list, 2 sectors stands out. One is power, and one is pharma. So both have been seen as a defensive. Pharma is, of course, a defensive play. Pharma is also gained because of the rupee. But for power, there could be the powerful theme which can play out over the next year or year and a half. So that's the reason why you've seen, in a very bad market, some of the power names have actually outperformed. So given the fall, given the breadth of the market, we just identified some of the names, which includes the power names and the pharma names, which have bucked the trend and have rallied pretty hard in the last 1 month.
Okay, all right. That's an interesting list. Thank you so much for bringing out all these trends that we're seeing in the broader markets and the Nifty pack as well. But for the markets, continues to be a down day. We are below the 22,480 mark as we speak, at the day's low, actually below the 22,450 mark for now. Banks are the ones which are putting a lot of pressure, 3% lower on that one. And across the board, if you look at mid-cap index as well, it's a sharp cut from the highs, and the volatility index, or the VIX, is higher and surging in trade as we speak. But with that, we'll take your leave on this edition of Midcap Radar. Thank you so much for tuning in. Finding Alpha when we return.
As geopolitical risks intensify, defense spending is set to take center stage globally. How well is India placed, and which companies could emerge as the key beneficiaries? Vikas joins us from ICICI Securities on the show to help us out with his insights. Hello and welcome to Finding Alpha. I'm Nigel D'Souza from the Mumbai News Center, and today we're going to take a closer look at one of the most exciting and important sectors from here on, the defense sector. Well, Vikas, first of all, thanks a lot for coming down. We've spoken quite a few times, across Zoom and various other links, but good to have you in person. And this time we're going to be speaking about an interesting subject, which is top of mind, the defense space.
Thank you, Nigel, for having me on the show.
Okay, all right. Let's get a couple of basics out of the way then, Vikas. What's India's current defense spending, if you could help us out with that? And how significant it is in absolute terms? Give us the broad numbers.
So for FY27, the total defense budget is stated at 7.9 trillion INR.
Okay.
This is roughly about 2% of the total GDP. This is also 15% increase on year basis. However, this includes the pension and army payments as well. So the capital expenditure which we should really focus on is 2.2 lakh crore is what we should look at. That is a good 17-18% increase on year basis.
Okay, all right. So we have two numbers in there. One is the budget, which is close to 7.9 lakh crore. And the number you said with regard to defense capex is around 2.2 lakh crore. Is that the numbers?
Yes, that's correct.
And the number to track from an earnings perspective is the capex spend, defense capex spend, capital spend.
For the company's perspective, yes.
Got it. All right. We have that chart that's come up for our viewers on the screen. Give us a couple of details then. If you could tell us India's spend or India's defense budget. If you compare it with, say, global peers, how does it equate to that? If you want to give it to us as a percentage of GDP or an absolute number?
I'll give you both. So in percentage of GDP, if you look at the global average, it is sitting somewhere around 2.3, 2.4% of the global GDP.
Okay.
Now, out of that, US is the biggest. US has, in absolute terms, a little shy of $1 trillion budget spending. That is the highest. Out of the total $2.6, $2.7 trillion of the total global defense budget.
Okay.
So India, US, China, Russia, and Europe combined have more than 60% of the defense budget globally. In this context, if you look at India last year was roughly about 1.9%, and this year, FY27, we are expecting it to be 2%. So slightly lower than the global average, but we are expecting it to boost up, basically. In contrast, if you look at the China, in absolute terms, though in GDP terms, China looks a little bit lower than India, but in absolute terms, their defense budget is 4 times that of India.
All right. So both India as well as China, as a percentage, the defense budget as a percentage of GDP is in that vicinity of around 1.5% to around 2%, because China GDP is so much larger. The absolute budget for China will be 4 times that of India. Is that correct?
That's correct.
And if I look at it in percentage terms, I think Russia is very high. If I look at defense budget as a percentage of GDP, it's higher than normal, I think so.
Yes, both Russia and Ukraine after 2022 went very high. Russia is currently a little over 7.3, 7.4%, and Ukraine is currently giving almost 23-24% of their budget in the defense.
Got it. All right. So we've got a couple of those numbers then out of the way. The other big opportunity that we talk about is defense exports. That's something was not really heard about in India. But I think in the last few years, we have gradually seen defense exports from India that scale up. So could you tell us what was the number, what is it, and where is that number headed in terms of a growth number?
So if you look at a decade back, we were exporting only roughly about 600 crore odd, which has gone up to 23,000 crore. And by next 3 to 4 years, our target is 50,000 crore.
Okay, all right. And you think we can get there? That 50,000 crores, I think, is by 2029.
Yeah. So certainly, given the global conflicts has risen, if you look at the CIPRI data, then probably currently the cross-country conflicts are over 80. Countries are involved. This is the one of the closer to the highest after the World War II in the cross-country conflict. So definitely the defense export has a big leg room.
Got it. Okay. Let's talk about the India's defense sector then. You've given us the broad numbers in terms of capex, the budgets, how does India compare with the globe, as well as the exports number that's expected to go to 50,000 crores. There'll be a couple of areas where India has strategic importance, I think so, and we have an advantage. So could you tell us, where does India have a bit of an edge with regard to defense capabilities? And then maybe we'll get to an area where we can see some kind of improvement, in terms of where India is lacking, basically. Go ahead first with the pros. Where does India have that edge?
So I would not term it as an edge, but where we have done extremely good is largely on the missiles and rocket system. We have done BrahMos, which has been pretty celebrated of late. Then you have Agni 5, which is ICBM with 5,000 kilometer range. So missile ecosystem we have done really good, and we are further developing it. And we have also seen our interceptors has pretty good 99% plus kind of the interception rate during Operation Sindoor, which I have not seen across the world. So that
India's done well in missiles. We have done well in interceptors,
and developing the overall manufacturing ecosystem.
Rockets.
Yeah.
Okay.
The place where we are lacking is still the aerospace. The main problem we don't have our own engine, where the government is pushing a lot of efforts, and that's why our own fighter jet programs has been lagging behind. So the engines and engine manufacturing ecosystem is something which is a wishful thought process at this point of time for India.
Okay, one point I wanted to ask you, we'll get to the companies that are involved in each of these categories, be it rockets, missiles, and the aerospace, where you're saying that we are lacking a little bit in terms of manufacturing. Do you see it at a bit of a risk? Sometimes I speak to some market people, and what they tell me is, Nigel, the biggest client is the government, the biggest spender is the government, your payments are coming from there. So they believe it's a bit of a concentrated risk. What do you think? You think otherwise, I think?
So it's a double-edged sword, I would say. Yes, the concentration is very highly on government, and government finances may impact the order book as well as the procurement. But on a contrary, you see that government provides a stable revenue stream as well. Given the current geopolitical scenario, the defense capex is increasing, and you can't delay a program for a very long period of time. So yes, delays can be there from the government, but government also provides you a very significant revenue stream as well. Secondly, in order to counter this somewhat, we are actually developing the second source of income in terms of export. And eventually, the civil aviation industry is also developing a lot in India. So many of these players which is good in aerospace segment, can do work for both. For example, engine component manufacturer can manufacture for the commercial aircrafts as well as the defense. So this would eventually come as
So it's broadening their revenue stream, you're saying, because it can be used for defense as well as they can service commercial aircrafts as well.
That's correct.
Okay, all right. And what about, in terms of spends and payments, you believe that it's a risk, or do you think it's actually guaranteed money that they'll definitely get?
In case of government spending, definitely they'll get the money. Yes, like I said, there could be a little bit ups and downs or delays, basically. And it's not always because of the government, it's sometimes because of the manufacturing process gets delayed for XYZ reason. There are multiple reasons, because defense, the downstream of the supply chain is very complex, Nigel.
Okay, all right. Now let's get a few of these factors out of the way. You said India has done very well in missiles as well as rockets and interceptors. First, let's just focus on which are the companies that have exposure to these areas.
Okay, so before that, just to set up, so our thesis is also based on this. If you look at the way the war has been fought of late, it's not a ground troop, but more of a air-to-air combat. So we actually expected people who are into radars, missiles, interceptors, electronic warfare programs, and lastly, the aircraft manufacturing ecosystem. These are the few segments which should be disproportionately benefit in the defense segment. So in our coverage space, the company which is more prominent on the missile or the electronic or avionics side is BEL, BDL.
Okay.
Data Pattern is one company, but it's not under our coverage, so we would not give you the view on that. And then in the aerospace, HAL is still the king, because that is the only company in India who has ever manufactured an aircraft.
Okay. So.
And then in radars, you have people like Astra Microwave, again, Bell Data Pattern. So these companies should benefit.
All right. So missiles, and rockets, etc. That will be BDL and BEL. If you're looking at the
in the listed space.
In the listed space. If you're looking at the aerospace and manufacturers of aircrafts, you're talking about HAL, right?
HAL, some of the component manufacturer or the material provider would also get benefit in this system. In the material space, PTC Industries is one which is coming up with a large capex. Then in the component, basically probably companies like Azad, which can do the CNC machining, precision job work on that.
Okay.
And then lastly comes radar, which gets housed in everything from commercial to aircrafts to even the interceptors or the.
All right. Because when I asked you about where India is lacking a little bit or where we could actually play catch up is on the aerospace, I think so is what you said.
Engine manufacturing.
Engine manufacturing. But that could provide an opportunity as well, right?
Yes.
I mean, for the companies. So who is best placed to try to sort out this particular issue with regard to the engine manufacturing? HAL, is it?
Currently, HAL tried to develop an engine, but not that much successful. Our engine program was Kaveri, which was under development, but didn't yield out a desired result, I would say, as of now. So I believe that the technology transfer would be a little bit difficult thing. So the best you can do is that get the foreign manufacturer here to manufacture, like Safran has set up a shop here. And Safran probably, in order to give you 60% of the, to meet the government requirement of 60% domestically, they would go into material or some component manufacturing space. So material guys like titanium, super alloys, these guys would benefit along with the CNC machining guys, those who have managed to crack the code for the.
So when I talk about titanium alloys, companies that come to mind will be Midani?
Midani and PTCIL.
PTC
Industries.
So from the government-owned companies will be Midani, and the other one would be PTC from the private.
Industries.
This is into titanium
super alloys.
Super alloys. Got it. But let's focus on HAL first, because that's one of the big boys, right? I mean, people were so gung-ho on the company. The stock went dancing away, I think, to around 5,000, 5,500 approximately. From there, HAL saw a sharp correction. Could you tell us what are the drivers from here on? Because I've noticed that you're fairly optimistic on that stock. So if you had to tell us about one company that you were quite bullish on, would it be HAL? If yes, could you tell us what are the key driving points that you're factoring in now?
Yeah. So HAL, if you see, the problem started delays in the Tejas delivery, and it's been kept on hold for quite some time, plus couple of unfortunate accidents that happened. However, we believe that the government, though the AMCA program, they are looking for other partners to develop AMCA. We don't think that the HAL has been abandoned by the government. So if you look at currently, we have 42 squadron strength, which is sanctioned. That would require roughly about a little over 800 aircrafts. Currently, we have roughly about 540 aircrafts in service. Out
So
of
another
that,
250 aircrafts, sir.
no, see, there is Mirage as well, Jaguar. So next 5 to 6 years, a good number, 10, 11 squadron would go off. And Su-30 would come for a upgradation to Super Sukhoi. So if I adjust everything, then over the next, in order to meet even the 42 aircraft squadron over a 10-year period of time, we probably need more than 450 aircrafts. 180 would come from Tejas Mark 1. We have already ordered Rafale, 114 plus another 24, 26 for Navy. So 140. Then 120 odd probably would be AMCA in the first phase. So Tejas Mark II probably would also come. So this is the basis where we think that firstly, that the government can't just let go of Tejas program at this point of time because of our requirement. And AMCA would also take 10 years to develop, let alone be in the induction would be even further away. Secondly, HAL is also basically putting some efforts in the other segment. For example, the helicopter program, Prachand, then CJ100, which is the civil aviation, basically, a small aircraft to connect for the interconnectivity segments. And Sukhoi upgradation could be 60 to 70,000 crore program among itself. So HEL probably would do well in terms of earnings profile.
I just wanted to ask you a couple of points based on what you've said. The Tejas aircrafts, if you could tell us, how many are you factoring in terms of deliveries? Because we keep hearing about it getting pushed and delayed, etc. So, you know, in the coming year, how many are you penciling in terms of deliveries? And Su-30 as well, you said that you're expecting upgrades over there. So, give us some more clarity on both these 2 points.
So this year in FY26, we haven't factored in anything. Next year, we were factoring in 8 based on the factor that they already has said they have 5 aircraft ready with engines.
Okay.
And over the first half, probably 3-4 more engines would come. So 8 at least.
So 8 Tejas fighters in FY27 is what you're expecting for delivery for HAL.
Yeah.
And the point on Su-30?
Su-30 we have not factored in as of now in FY27. So once the program will be cleared and they would get the order, then we will look at the timelines and start factoring.
Got it. And just one more point with regard to HAL. I remember at the peak, people are talking that the valuations have gone way ahead of itself. After the correction, what is it trading at? And at its peak, what was it trading at on a PE basis?
So currently, I think on PE basis is 25-26 times on trailing, and on a 1 year forward looking is 23-24, and at a peak it went up to even 45 times. So significant correction in the valuation.
And HAL will be your top bet. If you have to talk about one stock, we'll talk about more stocks. But do you think that would be one of your top bets?
It is among our top picks.
All right. Vikas, we have plenty of more questions actually to ask you. But for the time being, we'll take a quick break, come back. We'll field some of your queries as well on the defense sector. Stay tuned. Welcome back. You're tuned in to Fighting Alpha, and we are in conversation with Vikas from ICICI Securities. He's told us plenty in terms of all the broad numbers and some of those government-focused companies. But Vikas, I wanted to ask you a query with regard to the private companies. You know, HAL we have discussed about in great detail. What about if I had to ask you, Vikas, tell us the top companies you believe will do well from here on in the defense sector from the private part of business? Could you name them and why?
So we like solar industries a lot.
Okay.
They are basically into ammunition, explosive, propellant, and all these would require, and they are also the one who has made Pinaka rocket. Okay. So we are expecting them to do well because explosive business would be a cash cow based on which their defense would build up. They have actually done tremendously good in defense as well. So from roughly about 100 crore revenue 5-6 years back to they went to almost 2,000 plus crore revenue. Probably this year they will end up with closer to 3,000 crore is the target. So solar is one thing, and they have basically a lot of export option as well. They are putting up a 155 mm ammunition where we think that the Europe would have a lot of demand.
Okay.
Plus Pinaka could also be exported. They've already done a batch to Armenia. So solar is one thing which we like. And then we like Azad Industries. It's a CNC precision job work manufacturing company. They are currently, the exposure is more towards the gas turbine at this point of time.
Okay.
But they have been gradually moving towards aerospace segment and already proven their capability in some of the significantly difficult area.
Yeah.
So we are of a believer once the defense aerospace manufacturing ecosystem picks up, Azad could be a big beneficiary in terms of providing the component which also would fill the 60% of the domestic component requirement.
So Solar Industries and Azad. And you met Pinaka. Pinaka is the
Solar Industries product.
Yeah,
is a rocket.
Is a rocket launcher, right?
Rocket.
Rocket is, and that you're saying that has tremendous potential from here on as well. Just one more query. Explosives. Solar used to also give some explosives for the mining sector, I think for Coal India.
Yes.
So they have a twin thing with regard to explosives there, and also the defense vertical is which was very small, which now has scaled up.
Yes.
Got that. So two companies from the private space that you've told us is Solar Industries and Azad. Let's get to a couple of queries though, Vikas, because we've got viewers that have written in there. Praveen writes to us from Andhra Pradesh. He holds around 220 shares of Bharat Dynamics at around 1,450 rupees. Wants to know what's the outlook on the stock. Bharat Dynamics is the stock actually, Vikas. It's quite interesting because I think you were one of the few analysts that were negative on the stock. You could correct me on that. The stock has corrected from its peak. But what would your advice be at around 1,100 rupees on a stock that's seen a big correction from the top?
Yeah, so we actually downgraded a couple of quarters back when the stock was roughly about closer to 1,550, 1,600 levels.
Okay.
We were negative, but now the stock has already came below our target price, basically. So from this price point, we are no longer that negative on the stock at this point of time.
So advice would be might as well hold on, since you've seen
currently hold.
Got it. Another query comes in. We have Yamini Jain who writes to us from New Delhi. She holds around 100 shares of Bharat Dynamics at around 100 rupees. Well, she wants to know what are the future prospects of the company. Well, she's got in at a very good price, I think, sir. That's BEL. Bharat Electronics is the company that we're talking about. She got in at around 100 rupees. What would your advice be? The stock is at 400 rupees right now.
So we are positive on BEL. Basically, if you look at the electronics and avionics, whoever gets the order, basically, BEL would get their fair share of 15 to 20%. So despite even for the example, AMCA program, if somebody else comes, BEL is also trying. BEL would get their fair share of overall defense spending. AMCA.
Okay.
So basically, our fifth generation aircraft program.
Okay.
So BEL would get their fair share of the electronics and avionics in almost all of the things. So BEL would be gradually would keep earning money. So BEL is something which she should hold on.
All right. And the advanced medium combat aircraft is the one that you're talking about. So BEL will get some proportion of business from that as well.
So BEL is in partnership with L&T. This consortium is one of the three which has been currently government is looking them to award AMCA. Okay. Whom it will go, we don't know at this point of time. But even if it doesn't come to this, BEL is basically providing electronics to almost most of these bigger programs.
So they have something to gain once the award of this particular contract comes off. So
For
BEL
most of the orders in the defense bid, they have something to
will
gain.
be a direct or an indirect beneficiary. So you'll continue to remain positive on a stock like BEL. Fair?
That's correct.
All right, let's get our next query. We have for Manu Thomas, who writes to us from Kerala with an investment query. He's planning to invest in the defense sector, wants to know if he can invest an amount of around 1 lakh rupees in Zen Technologies. Zen Technologies, I recall the company went from 100 rupees to 2,200 rupees or more. And then it saw a sharp correction. What's your view on the stock at around 1,300 rupees? Mr. Atluri, in the past, he's been talking about big numbers. Some of those defense orders didn't come in on time. Stock at around 1,300 rupees, your advice?
So we've been ad rating on the stock basically. Zen is actually entering into a lot of other spaces apart from their traditional simulation business. Drone is one area where we are positive. Like we said earlier, that the future wars is more of a different drone or missile led rather than the foot soldier. So Zen should benefit. How much is something which need to be seen, because in drones, the category from a smaller drone to a larger drone like UAVs, it's a long category, and many other players have entered into in this space. But we have a slightly positive view at this point of time.
Okay, all right. Vikas, so just to sum things up, you're sounding quite optimistic on the defense sector. Your top bets from the government space would be stocks like HAL as well as BEL. From the private pack, you like a company like Solar Industries as well as Azad Engineering. And you believe that India will do well in terms of the defense spend, and maybe exports as well could be an option.
That's correct.
It's been a pleasure having you on the show, Vikas. Thanks a lot for joining in and breaking it all down for us. Well, I hope you learned as much as me on Finding Alpha. We try to explain everything you need to know on defense on this particular sector. Thanks a lot for watching.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Hang Seng's down 1.5%. The Taiwanese index is down almost 2%. Maybe we take Kharg Island, maybe we don't. We have a lot of options.
So Brent oil prices have jumped to actually they're now closer to $117. They're up on your screen, almost $117.
And just to prove that they're serious, they gave us all these buffs. When I talked to about 4 days ago, a presenter said they gave me a present.
The first time what Reserve Bank is capping is the gross position itself, which can only be 100 million. I mean, that's far less than what banks would have been prepared for.
Some banks having huge open positions, and they were actually playing on the speculative trends in the market.
They would short in the domestic market speculatively, but cover in the NDF market.
22,590 on the Nifty, 51,474 on the Nifty Bank.
The base case scenario, we're probably looking at a 50 basis points or 60 basis points global inflation risk.
The major gains clearly have come in for the crude derivatives. So whether it is about gasoline, heating oil, it's gained more than 80 to 100% in the last 1 year.
This year, Nifty is down 5%, erasing almost the entire gain that we had seen in FY25.
So in short, some of these facilities are getting hit. For the time being, the street is focusing on the supply side shock.
The Nifty is at the day's low. We do have a lot of stocks which are in focus on account of news.
Okay, it's 400-point cut on the Nifty, so 22,390 is where we find ourselves at. So large caps under severe amount of selling pressure. And of course, it's not being held by banks, which are top of the list in terms of losers. Actually, the last I checked, the PSU Bank Index was by far the biggest losing sector. This is Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant and Reema. With me, Reema, hi.
Hi, everything's getting punished today. But the thing is that Europe is actually on the flatter side. You've got a little bit of green for the CAC and the FTSE. We should pull up the European indices, and even the Dow futures right now is up 200 points. Yes, Asia ended in the red, but the cuts were not as bad as what they were when we started trade. So when we started trade at 8 o'clock, we had the Japanese markets, the Korean markets down 4-5%. The ultimate closing for Asia was not as bad, but Europe is in the green now, resilient, flat, muted, but there is no, big correction there. And Dow futures currently is up 200 odd points. Mid caps, small caps are getting bludgeoned. Both those indices are down 2.5%. The advanced decline ratio tells you the story. 2,700 stocks currently in the red for about 400 stocks in the green. On the way down, as Prashant said, PSU banks taking a knock. The Nifty banking index is now down 1,800 points, but there is no place to hide. The only index which is in the green is CPSC and the metal index, and that too by a smidge. The big losers today on the large cap screen: Tata Motors, Bajaj Finance, Axis Bank. You've got Geo Financial, NHPCs, Bajaj Finserv, SBI, Adani Enterprises, HDFC Bank. That are some of the large caps which are extremely weak in trade.
Well, let's just look at the rupee as well for a quick bit. I mean, that intervention in the form of that circular coming through. And we are where 94.75. So this is basically back about what very, very close to the lows that we hit on Friday. So we got a massive move, 93.60-ish. So we've had a 1 rupee strengthening and then almost a 1 rupee weakening as well on the rupee, all in the matter of one trading session. So that's the dollar rupee picture at this point in time. Let me just quickly tell you what's coming up. So markets, of course, are in focus without a doubt, and we'll talk more about this in a bit from now. Get you some expert opinion. Mid cap and small cap indices are also under pressure. Rupee is the second story, maybe the first story, and Lata joins us in just a bit. Sugar is rallying, and we'll have our research team join in on names like Dhampur and Balrampur, etc., which are jumping up. So there's the sugar bit, but there's also news on ethanol coming up, which is leading to a bit of excitement. But let's go across to Lata, who is now ready with us with the latest feedback in terms of what we've seen. As I said, big move in terms of recovery, and then back down again. Lata, take it away.
Yes, opened very strong at 93.58, if you remember, which would be a rise of about 1 rupee 22 pice stronger. We hardly ever see such a big recovery. But now closing in on Friday's close. Dealers come with several reasons. One being that there is a lot of buying from oil companies because apparently there is a deadline sometime in April, first week, of Russian oil that you can buy, afloat Russian oil, which has been given leeway by the US. And therefore, there is a hurry to mop up that oil, and that's why there is a dollar demand. The more important point to note is what is the impact on banks. Now, as we were saying, that the chatter in the banking circles was that about $35 to $40 billion is the kind of long positions that people are sitting in. And the difference between the forward rate in the NDF market and the domestic market, that difference will constitute the loss. Now, what has happened is over the day, when we started, the 1 month forward versus the 1 month onshore forward were trading at a difference of about 70 pice. By lunch, it had fallen to about 30 pice. And now it is 35 pice. So the loss is not as much as people assumed earlier in the day and definitely over the weekend. Likewise, if you take the 3 month, early morning trades at 9 o'clock, the difference between the onshore and offshore was as high as a rupee plus, a rupee plus 10 pice or thereabouts. And now it is whittled down. It whittled down to 70, and now people are talking about 75 pice as the difference. It's a moving rate because both forwards in the onshore and offshore market are moving. There is another thing. If everyone is not able to sell off in the market, clients have come. Corporates don't have such a, limit from the Reserve Bank. Therefore, they are ready to take the position from the bank for a fee. This is what happens, when markets get dislocated, there is always someone else who's taking the, filling in and taking advantage of the position. So banks have been able to whittle down. So what we hear from bankers is that feared over 1 rupee on every dollar of trade, it may not come to that, anywhere near that. It may probably be even less than 50 pice. And so the loss could be smaller, more manageable. And that about 1,500 crore is going to be spread over the entire banking sector. And there'll be some bit for foreign banks as well. So listed banks will have a manageable hit, but it has to be taken in this quarter. There is no postponing it. Even if you sell it off later, the mark-to-market strikes on March 31st. So today is the last day that they can sell. I must spend a second on the bond market as well. The bond market was expected to react benign because the borrowing program for the first half was only 51%, as announced on Friday, 51% of the total borrowing for the year. Normally, the government borrows between 55 and 60% because the first half is the slack season. Corporates don't borrow because, cement, construction, sugar, all those are not borrowing at that time. So there is usually a lopsided borrowing of more in the first half. This time, the borrowing is only 51%, as announced on Friday. So one was expecting a bit of a rally in the bond markets. What has happened? It has moved from 6.93 on Friday to 6.98. And what people tell us, of course, crude has moved up and, therefore that changes the grammar of inflation and fertilizer subsidy and fuel subsidy. But the bigger thing is if RBI can take such a big step for the rupee, who is to stop them from taking, a rate hike to protect the currency? That is not out of the realm of the possible. Right now, no one's talking of a rate hike on April 8th or anything like that. But they may start the VRRR, take out liquidity, generally sound less dovish and cautious. And that's why you're seeing yields move up to 7% almost.
Absolutely. The unusual steps being contemplated around the region in India as well. I mean, take Japan as an example, right? I mean, I think we've seen the strongest statements from the Japanese central bank governor saying that, well, they will not hesitate to increase interest rates. I mean, $160 yen is the line in sand. And I think at least, I mean, rate cut expectations have all disappeared. Rate hikes, some 2, some 3, some more. But that's the severity of the situation we've seen across the globe. Well, Ashish Kayal is with us, author and CMT Wave Strategy Advisory. Ashish, good to have you with us here. Thanks very much for joining us. Just a quick word on the Nifty in terms of if there is a trade there, and then go on with what stocks would you recommend?
Hi, Prashant. Afternoon to you and all the viewers. See, if you look at Nifty, the overall trend is down. There is no second thought to it. But it's better to be selling on the rise rather than selling on the breakdowns because Nifty is falling by nearly 800 to 1,000 points and then recovering back equally around 500 to 600 points. So net, we are moving down by around 500, 600 points, but there are equally sharp reversals that we see. So my take is going to be, rather than selling now when we are a little oversold, it's better to use the pullback that we get again back towards 22,640, 22,620. Use that as an opportunity to sell, and then maybe expecting a target of around 22,150 on the downside. This is also the zone that we have seen previously in April 2025, where from where sharp reversal on the upside happened, and also in April 2024. So we are at the zone of April 24 right now. So 2 years of correction is what we can say in terms of time correction. Having said that, with respect to stock specific action, we can look at forward to create long positions in something like National Aluminium, NELCO, because the overall tone for aluminium stocks and the metal stocks are still positive, and one can create long positions here. We can expect a target on the upside at around 410 over near term, and on the downside, one can maintain a stop loss of 375. The next stock on the buy side is going to be DMart. If you look at it, after a long time, we are seeing some kind of a double bottom formation, a positive traction here. Volumes over past 3 days have been heavy, and the stock has managed to cross that 20 DMA after a long time. So DMart, one can look forward to create long positions for the target of 4150, maintain a stop loss of 3830 on the downside.
Anything on banks? Ashish, we're seeing large cuts across banking names. Look at mid-cap banks. Union Bank, 5.5%. DCB, City Union, Bank of India, Canara. AU Small Finance Bank has fallen on very large volumes. Innocent Bank in the private sector space, down 4.5%. You can feel the jitteriness, anxiety in the banking stocks today, the way they've fallen on large volumes.
Absolutely. So the overall sell-off that we are seeing in Nifty is broadly driven by Bank Nifty this time, because we can clearly see Bank Nifty was trading somewhere around the levels of 60,000 when the sell-off started, and it is now at 50,450. So very severe sell-off, a nearly 10,000 point sell-off that we have seen has come from Bank Nifty. And the reason being, it has been rotational sell-off that we are seeing. The private sector banks were already weak. We can see that how HDFC Bank behaved, how ICICI Bank behaved, and now there is pressure creeping into the PSU banking space also. So having said that, I would not recommend something to sell now, something like a Canara Bank or an SBI or a Union Bank at these levels. Rather, Canara Bank can be a good sell on pullbacks again, somewhere around 126 to 127 levels. Use that as a pullback to sell, and then ride it down towards 120 on the downside. Do not bottom fish in this market, because anyone who has been doing that for the last 4,000 points sell off on Nifty or 10,000 points on Bank Nifty has been burned their fingers. So use pullback to sell.
Okay.
Okay, all right. Well, let's get in Deepan Mehta then for a quick check. Thanks a lot for that, Ashish. Well, Deepan, I wanted to ask you about the aluminium players. You're normally not interested in the metal stocks, but it seems, aluminium, it's going to be quite interesting. Only if demand destruction comes about, then they could disappoint big time on earnings. Because otherwise, some of these smelters that have shut down, they'll take 6 to 8 weeks just to restart. So supply has clearly been sucked out of the system. Do you like any of them? Nalco, Vedanta, Hindalco?
Good afternoon, Nigel, and thank you for having me on your show. I think Vedanta remains the best pick within the sector, and the fact that the company getting split into 5 units would mean that there could be some amount of value unlocking over there. And I think gradually all concerns around the holding company debt have dissipated. So that would be one company which is worth looking out for. And of course, Hindalco as well, being one of the largest producers of aluminium. And this war and the rupee depreciation overall is supportive of metal prices. And to an extent, even I think the kind of moves which are coming through in the international markets do suggest that you could have a good run for some more quarters for the metal companies. So I would remain overweight in metals. It's a great trading play as well as a medium-term investment opportunity as well. But getting in at this prices, I'm not sure in a market like this, which is collapsing on all sides, to put fresh money to work as just a bit of a question mark that I'm trying to deal with just now.
Deepan, I'm sure many of your friends, family, they all would be asking you for advice, and you get a sense of the retail pulse also when you speak to people in the building, for instance. Are you getting a sense that the retail faith in the equity markets is now getting shaken with this kind of fall?
No, I don't think so. Actually, people are still quite keen to invest in the markets, and I still keep getting inquiries. Okay, market has fallen so much, so what should we do? And somehow or the other, I think there are enough investors who are still on the sidelines. and they have more money to put to work. But this relentless fall in the market, I'm not sure how many of them are really serious in putting investment at this point of time. But I don't see any panic per se that investors around us or our clients or friends or family offices we know are liquidating just because they think that this pain is going to last really long, and even from these levels they would get negative returns. I think the general mood is that okay, we have seen this picture before, and it may be as bad as it gets. But eventually, having seen COVID, having seen the global financial crisis of 2008, we're in a similar situation where markets have corrected deeply, but they will come back in a couple of years' time, and they come back very strong. There's no point in selling off and going away. That's the broad consensus I get. Don't sell, and no point liquidating at these levels.
Yeah, no, absolutely. That's the view on a broader view on markets. Sugar is higher. Sugar stocks are higher. Dhampur, etc. Some of them over 10% in the green. Ria is here with what's happening. Ria, take us through the news.
Well, yes, sugar stocks have surged in today's trade, and this is after global sugar prices have spiked to a near 5-month high, supported by the sharp rise in crude oil amid the war in West Asia that is going on. Now, this increase in oil prices generally supports higher values for ethanol, and key sugar-producing nations, including Brazil, have shifted more cane towards ethanol production instead of sugar, which has pushed sugar prices higher, and sugar supplies have also tightened, which is leading to this move today. Now, in fact, mills in Brazil's key center-south sugar belt have allocated almost 95% of their sugarcane to ethanol production in the first half of March, which is up from almost 70% on a year-on-year basis. And dealers have said that at present, it is more profitable for mills to use cane to produce biofuel ethanol rather than sugar. Now, going ahead, this shift may also tighten sugar supplies, which is why we're seeing this move in sugar stocks today. The biggest gainers include Dalmia Bharat Sugar, Sri Renuka Sugar, DCM Shriram, all up anywhere between 4 to as much as 14% today.
Yeah. That's the sugar rally. By the way, look at this. My God, 94.77 on the rupee. I think we hit 94.
93.60 at the start of today. We have given up all the gains that we made on in the first few minutes, and currently the rupee is at the low point of the day.
But the point that I was looking at is 94.80 was the low on Friday. We are not there, but apparently we hit 94.86. So 94.88 is the.
94.80. We gave up everything.
Yeah. Basically we've broken through Friday's low, and now we are holding around Friday's low. So that's the picture as things stand right now. I think though that the values is it updating real time? Because I think we're saying 94.90. So I think we hit 94.90 and we've come up a little bit at this point. So 94.77 or so. Deepan, any thoughts on this one? I mean, massive moves and red by the end of it.
Sorry, on which specific...
Rupee, Deepan, Rupee. I mean, I'm just saying that...
You are the best expert on Rupee in your studio, Lata. I keep listening to her and getting gyan from her. What can I say? I mean, you can ask me about the equity part. But look, everything's going to be under stress till oil prices don't stabilize. Rupee can go even lower, and this gradual downward because the RBI is, kind of ensuring that there's no violent and sharp move over there. But it's the right strategy to let the rupee depreciate rather than letting our reserves just go down significantly. So I think this is going to be the new norm, that rupee is going to be around these levels or so. And once all this is over and done with, I think on the brighter side is the export businesses. We should do pretty well going forward. So whether it's software services, whether it is textiles or chemicals for that matter, I think they should get a very good boost. Same holds true for pharma as well. And even if they are adjusting the prices lower because of rupee depreciation, end of the day, India becomes far more competitive.
Yeah, I was saying our values are not updating, and that's why I was kind of referring to it. The live rate is not updating. We are at 94.98, and we'll update it on the flashes here. But this is, and maybe it's oil demand, oil marketing companies in the market buying, etc. But one would imagine there is some kind of coordination, right? On the day when the RBI comes in and sort of, in a way, pushes back speculators and forces banks to cover positions and, takes the currency almost back to about 93.60. Okay, we're at 95, past 95. I think now it's updating. 95.14, that is what is coming through. And that's a massive move. It's 1/3% lower on the dollar rupee, higher on the dollar rupee, beg your pardon, which means the dollar is up and the rupee is lower. So 95.15, almost a one-way move. And we should put that out as breaking. And just look at the, if you can have the intraday up, it'll tell you the state of affairs, because big, surge early in the morning on the rupee, and then completely the other way, breaking through Friday's low and making another move. There you go. That's what I'm talking about. It's a massive move in the last 5-7 minutes of trade on the dollar rupee at 95.15 as things stand right now. So yeah, it's one market leading the other, but basically it's like a vicious cycle, vicious circle. There's the rupee market, and of course there's the equity side of things. I mean, many in the rupee market believe, Forex market believe it is lack of portfolio flows, dollar outflow, etc. And with RBI, of course, being the sole sort of provider of dollars, and the Reserve Bank of India, of course, coming in and trying to make sure that its dollars are not wasted. When it intervenes in the market, it goes towards actually plugging the gap rather than trying to fight with hedgies and speculators, etc. And that was what the Friday circular was all about, when they asked banks to square off, unwind arbitrage positions between onshore and offshore. But this is a significant move coming through, and almost a one-way. We just had Lata about 15 minutes back talking about this, and well, this is materialized out there at this stage. Deepan, thank you very much for joining us. Good speaking with you. Appreciate your time here. And we have a midweek holiday tomorrow, but news, of course, will not stop. Thank you. We have Tushar Pradhan joining us on the other side. There's an eye, of course, on the rupee, but equities as well. Stay tuned.
Welcome back. The 400-point fall has now become a 470-point sell-off on the Nifty. It's below 22,350, while the Sensex has tumbled nearly 1,600 points. Crude prices continue to remain elevated, and Rupee is in a free fall, hitting record lows, but now stabilized at 95.06. We've got about 30 minutes to go. In the meanwhile, let's turn our attention now to the IPO markets. We've had many large IPOs over the last couple of years. How have they fared? Hormus now joins in to take us through that analysis.
Well, you know, the last 5 years have seen some large, giant-sized IPOs, and the bottom line here is that barring a couple of them, most of them have just disappointed investors. Now, I look at the criteria here. We are taking IPOs from 2021 onwards till date, and a benchmark of around about $1 billion of around 8,500 crores and above being the size. Now, let's take a look at the last year's IPOs first, the big disappointments from last year. You look at Tata Capital, the big IPO from the Tata Group, 15,500 crores below its issue price. HDB Financial, the much talked about IPO from the HDFC Group, the HDFC Bank stable as well, saw decent enough subscription below its IPO price. Hexaware Tech relisted on the bourses through the IPO route, well, 3x subscription as well. Significantly below its IPO price, almost a 40% downtick from the issue price. Now, look at the other disappointments from the last 5 years. LIC, at one point the largest IPO of the country, saw subscription healthy enough, but 23% below its issue price. Paytm has never seen its issue price since its listing, almost half from its issue price despite the recovery from the record lows. Swiggy, 11,000 crore rupee IPO, a complete OFS, saw subscriptions that were full, that's still down around 33% from its IPO price. The fall from the post-listing highs is even more significant when you compare Swiggy and NTPC Green, the other 10,000 crore rupee plus IPO, a PSU IPO, saw decent enough subscription, continues to trade below its IPO price. Which are the outliers here? You look at LG Electronics, the current or the most bid IPO of the country, 11,500 crores, got bids worth almost 4.5 lakh crore, a 54x subscription, still up around 30% from its issue price. ICICI Pro AMC, a recent listing, around about 30% from its issue price. And Eternal, of course, the 2021 IPO fell to record lows, saw a significant jump up as well, still around about 3x from its issue price. Now take a look at the fall from the 52-week highs that these names have seen. LG is down 16, ICICI Pro is down 13, Eternal is down 40% from its 52-week high, still remains a 3x from its IPO price, but all of these names that have bucked the trend are still significantly below their 52-week highs. HDB Financial is down 36% from its 52-week highs, and Swiggy, which was a post-listing high of well over 600 rupees, has nearly halved from those levels. What is the commonality in all of these names? None of these mentioned IPOs have retail subscription in excess of 10x. Retail has been fairly cautious in this, if not overly aggressive. And even the big names like Hyundai Motor and ICICI Pro AMC have seen IPOs that were undersubscribed when it comes to the retail front. Now, and most of the other IPOs which we mentioned have subscription of anywhere between 1x to 7x, which is in the case of Eternal, but most of them still lies anywhere between 1 to 5 times. And so most of them so far have been a disappointment for investors. We would only hope that when the market turns, the tide turns for them as well.
All right. Thanks very much for that. Well, we have Lakshmi Iyer, who's with us now, somebody who's watched currency markets for a long time. Lakshmi, good to have you with us here. I mean, this is relentless dollar demand, Lakshmi. I mean, that RBI-led move just sort of disappearing. A 122 paisa strength in the morning, that's been given back, and then some. If you are tracking things on the screen, what seems to be the reason, if you have a pulse of what's going on right now?
So I'd say, it's a combination of multiple, events which are playing truant on the market all at one go, and it's not just playing truant on the currency markets, it's all across bond yields, liquidity. So I think it's a combination effect, I would say. Plus, it's also the last working day of the financial year for the bond market. So I'm saying multiple permutation combinations, so it's very difficult to give you a cause-effect relationship. The only thing I'd say is that, probably these could be one of the many measures that possibly the central banker has in mind. And if you do take past as a precedent, when the taper tantrum happened back in 2013, or when you saw a surprise off cycle by RBI in 2022 during Russia-Ukraine. So I think you saw a slew of measures. So I'd say that this would be probably one of the many salvos which the central banker has invoked, and there could be many more to come.
There is no, sometimes, and this is not about the rupee or anything, right? But in situations like this, the market is what it is, Lakshmi, right? I mean, it sniffs out weakness, and I'm not sure if this is one of those cases. I mean, trying to, the point is it's done this, right? And the market always looks ahead. Now what? I mean, this is like a one-time thing. It's not repeatable. So is there that element as well, Lakshmi?
No, I'd say this, as I said, one cannot undermine, how the policymakers are really thinking. So I think when you least expect, and see, firstly, we need to bear in mind that we've not originated this issue. We are obviously recipients of this. I mean, whoever foresaw this even a month back, that 3 months into this calendar year, we've seen outflows from FPIs equivalent to what we saw in the entire 2025 or more than that. So I think
no, Lakshmi, nobody is undermining. I'm just asking. I mean, it is what it is. We're just discussing not right or wrong or what. Obviously, nobody foresaw it, right? I'm just asking you: is there the element? You've been in markets long enough, right?
So I would say that, the duration blindness and the incremental, I would say, spillover news of what's happening on the geopolitical front, whether Iran striking incrementally US and Israel or something or the other is constantly driving. So I say that, are we completely out of arsenal from a central banker perspective to take care of some of these issues? The answer is well not. But we need to be mindful of the fact that some of these, trying to defy gravity from a global perspective can be a little bit counterintuitive. So I think one needs to really play the fine balance. And as practitioners of the market, the only thing that we can do is, hope for more stability to come into the market, which I don't think has come yet.
Yeah. By the way, the 10-year has also hit 7%, Lakshmi, and that has happened as we speak up on your screen right now. By the way, there was relative calm on the dollar on the 10-year bonds. I mean, RBI, of course, has been an outsized buyer of government bonds, I mean, actually, I think they've more than bought the gross supply of bonds this year, which basically means that perhaps it is the only buyer, and there is, on the other side, there is some selling which is coming through from other players, investors, and private parties, banks, insurers, etc. So RBI has been a big buyer. But of course, I mean, beyond the point, the yields also now started to move higher. So 7%, past 7% now on the India 10-year. As things stand right now. Lakshmi, thank you very much. Good to speak with you as always, and appreciate your time. Let's get Tushar Pradhan in, Director, Hexagon Partners LLP. Tushar, good afternoon. Good to have you with us here. Thanks for joining us. Just your thoughts on what we're seeing out there, Tushar. A bit of a macro chakra view.
Yeah, that's a good word. What I would think is that we've had market events before. And I think if we take a step back and try to figure out what kind of market crisis are we facing? So if I go back to COVID, for example, it was a very new kind of crisis. It had nothing to do with the conventional, economic chaos that we generally see. Even the one prior to that, the global financial crisis, emanated in the subprime crisis, following which, most banks in the world were in trouble. This one is more of a conventional crisis. Largely driven by a constraint in supply of energy across the world. We saw a little bit of that in the year 2022 when Russia was sanctioned, as a result of which the world was worried that energy supply into Europe, for example, and even to other parts of the world is going to get constrained. Inflation is likely to shoot up. Interest rates as a result will stay up, and the resultant GDP decline. I think the current crisis is probably a more acute one of the same. And I think all of the prognostications in terms of where the economy will go, what earnings will take hits, etc., are more of a classic economic mold rather than the really surprising and market-defying situations that we had faced in the past. So I think it is more of a conventional crisis, and I think it's just the natural outcome of the fact that the markets price fear probably a lot before the actual numbers come out. So if you say earnings are going to be hit, they're not going to be hit for the quarter ending March. They're going to be probably, by the time if the crisis gets over, then over a year's time, you will not even see some, much of a blip in terms of the earnings picture also. But people like to feel happy about the fact that they are worried and they become more conservative, etc. So I would think that, yes, it is an evolving situation. The markets are reacting to whatever is happening. And I think at best, investors should understand that knowing where their term is, I think all of these are incorporated in the average returns of these asset class over long periods of time.
Tushar, so finally, what's the advice in all this? No one knows how long this war is going to go on for, what the duration is going to be. There are so many unknowns now. And as one of the experts was earlier pointing out, the tail risks are asymmetric. As this war goes on, the impact, the losses are going to be asymmetric. What does one do in such times then?
Yeah, I think I buy the point that we really don't know what the future is. But again, as I was saying earlier, that if you look back on the crises that we have seen in the past, if you remember in 2022, the fear was that the military intervention between Ukraine and Russia will spread into a broader war crossing Europe, and the NATO nations will get involved, etc. So that was a fear then. The fear now is that it becomes a broader conflict across the Middle East, and the whole energy superstructure comes under some sort of crisis, etc. I will think that if you want to invest in this market, I think obviously you can never time such an event. If you are looking to invest for the next 3 years, the next 5 years, I think the expected returns from Indian equities especially look particularly good, because you're assuming that the supply shock gets corrected at some point of time, whether it takes 6 months, 8 months, who knows. So I think in the next few months, it may not be the right time to just put all your eggs in one basket and bet on it. But I think incrementally, if you have allocations and your risk tolerance allows you to look for a horizon between 3 to 5 years, I think one should selectively start coming in. And I think the crisis in the banking sector especially is much more attractive to me, because clearly there has been a lot more reaction, and coupled with the fact that the currency also is a factor here. But I think most banks are not really exposed to foreign exchange the way the markets seem to indicate. And I think overall, India being a more of a domestic economy, I think there are more opportunities as they will come across. But when to buy, I think that's the million-dollar question.
All right, Tushar, thanks a lot for joining in. Short but effective chat. People are very, very fearful about, how bad can things get from here, and also the ghost of 2008. Hopefully, we don't have to talk about that. But thanks a lot for joining in. Time to slip into a short break. On the other side, we'll tell you what to buy, to sell today for a reverse call. You stay tuned. Welcome back. Some signs of stability finally after a sharp downtick in the last 60 minutes. The rupee has stabilized a little bit after slipping past that 95 odd mark. Some signs of stability out there. And on the Nifty as well, we've recovered close to around 50 points from the day's low. So thank God for small mercies. I think that's what we're doing right now. But that said, let's hop across to Nimesh. He is joining in. I think we're shifting focus today to the big NSE IPO. CNBC TV 18 has assessed the company's letter to shareholders to tender shares in the IPO. Nimesh, today you're joining in on this. Tell us more.
So there is not much to talk about markets or chatter, Nigel. So I thought I'll talk about NSE today. So NSE has written to all the shareholders, the existing shareholders of NSE, to tender the shares for an IPO. So it's basically a next step forward as far as the NSE IPO is concerned. The deadline for submitting the shares is 27th of April by 5 p.m. So that's when we'll get to know how many shares get tendered. Who is eligible to tender the shares? Anyone holding the shares for more than a year. Basically, June 15, 2025 is the threshold deadline. If you're holding beyond that, then you can tender the shares for the IPO process. One of the important point is that if you tender the shares in the IPO, then you can't buy the shares in the IPO. So obviously that's a lock-up for there. And obviously for all existing shareholders who participate in this, there's going to be a lock-in for the IPO shareholders. Anyway, there is a lock-in of 6 months after the issue gets listed. So that's the process. So now all eyes will be on April 27 as to how much the shares do get tendered for the IPO. Remember, for a 5% equity IPO, the minimum number of shares to be tendered is 12.5, roughly 12.5 crore shares has to be tendered. I had done this piece earlier as well. For the NSE, the large shareholders, who are the largest shareholders for NSE? Largely the institutions. So LIC owns 10.7% stake. Stockholding Corporation owns 4.4%. SBI Capital owns 4.3%. SBI, the listed entity, the bank owns close to 3.2%. And there are some insurance companies like GIC and Oriental Bank. They own 1 to 2% each. Among the large ownership, with the PSUs, the ownership of NSE is close to 31%. Insurance companies is 17%. Financial firms own close to 9%. And banks owns close to 4.5%. But as I said, for the IPO to go to the next leg, for a 5% dilution, if the valuation is less than 5 lakh crore, at least 2.5 crore shares has to be tendered by these existing shareholders for the IPO to go through in the next stage.
Yeah. It's a big one, right? So it's not the best of markets, but it is what it is. And the IPO process is very much on. Thanks very much, Nimesh, for that. Well, let's just get the, BDST calls out of the way. Ashish is back with us. Ashish, what do you have?
See, it's better to stick with the names that are outperforming in this kind of a market. So Hindalco is one where we can see, because of the aluminum, there can be some benefit which can be seen here also. There is some profit booking that we saw from the higher levels, but possibility that Hindalco can move back to 933 levels on the upside as the target. Stop loss can be maintained at 855 levels. And the next stock is going to be ONGC. We can clearly see the oil companies, energy companies are benefiting from what is happening across the globe right now. And ONGC can see the levels of around 300 on the upside. On the downside, one can maintain a stop loss for the stock at around 274 levels.
Thank you very much for that. Counting down to FY26, and it's going to be the worst year in terms of market returns in a decade, excluding the COVID hit year. However, history offers a silver lining. In the last 22 years, markets have never declined for 2 consecutive financial years. Does that suggest that a potential rebound is ahead? Can we hope for that? Sudarshan joins in with the numbers and the history and the perspective.
So FY26 comes to an end and market is set to close FY26 with a cut, and after gaining for 2 consecutive years, Nifty is going to see a close of FY26 with a cut of 5%, erasing almost entire gain that we had seen in FY25. And amongst all the 50 Nifty stocks, 16 Nifty stocks still have given double-digit returns, while 16 to 17 stocks are down more than 10%. So which were the major indices that have seen a sharp fall in FY26? Realty was the biggest losing index, falling falling more than 21%, followed by IT that has seen a fall of 20%, and FMCG too has seen a fall of 13%. Amongst gaining indices, PSU Bank has gained the most, gaining more than 30%, followed by Metal Index up 23%. All the auto stocks were higher in second half of H2 FY26, and because of that, auto index has gained 14%. And amongst Nifty stocks that have gained the most, Shriram Finance was the biggest gainer, almost 40%, followed by BEL, SBI, Titan, and Asha Motors gaining in the range of 27 to 34%. Come to the losers list. Trent was the biggest loser, down 36%, followed by TCS 34%, Wipro, Interglobe, Aviation, and Adani Enterprises too have seen a fall in the range of 20 to 34%. But bigger fall was seen in mid-cap names. But first, talking about the gainers in the mid-cap space, Delivery up 68%, AB Capital 65%, and AUSFE, L&T Fin, and Indian Bank too have seen a gain in the range of 64 to 65%. Amongst losers, KPIT Tech was the biggest loser, down 50%, followed by ACC 32%, Jubilant Food, Tata Chemicals, and Coforge too have seen a fall in the range of 30 to 32%. What's going forward, or what's say in FY27? So after 2003, we have not seen two consecutive financial years when market had seen a fall. So in 2003, market had fallen 13%. Following with in 2004, we had gained as much as 81%. Similar move was seen in FY09, 21% down. In FY10, up 74%. Similar pattern was seen in FY12, FY16, even in FY20, COVID year, down 26%. In FY21, up 71%. This financial year, we have seen a fall of 5%. So we'll have to see how exactly FY27 pans out. Hope history repeats and market takes cues from our tagline, onwards and upwards.
Well, nice way to wrap it up. Thanks very much. So for that, the financial year has been what it is. The calendar year has been, I think, compressed version of the financial year. Losses and at an accelerated pace from the beginning of this year. I think there's 11 minutes to go for market closing. We have Ambrish Baliga with us. Ambrish, good afternoon. Good to have you with us here. You like Sagility, Ambrish, which is like it's a healthcare revenue management sort of, it's like a BPO, but for healthcare revenue systems, right?
Absolutely. They provide operational and technology services to the healthcare industry, mainly serving health insurance companies and healthcare providers. And the company handles a wide range of processes that sit behind the functioning of health plans. And these include member engagement services, claims management, prior authorization support, revenue cycle management, and clinical workflow assistance. And they have about 81 clients, and about 12 clients were added in the current year till Q3. And if you look at the growth in the last 12 months, it's been excellent. Q3 revenue was up around 36% Y-on-Y at about 1,971 crores. EBITDA margins at 26%. PAT was around 323 crores, up about 23% Y-on-Y. And PAT margin again was decent at 16.4. Debt has been coming down year on year. If you look at the long-term growth, which has been indicated by the management, we should see about 10,000 crores of revenue by FY28. And again, the rupee depreciation should also be positive for the company because most of the clients are in US. Expected EPS for FY28 is around 3 rupees, and with that, the target price which I have is 54.
Ambrish, the Realty Index is down 38% from its 52-week high, 26% lower since the start of the year, because of the negative wealth effect of, poor equity markets now for a while. Do you expect demand on the ground for real estate getting impacted? What's the anecdotal evidence, and what does that mean for individual stocks?
No, see, it's already been affected since the last couple of months. We had 2 or 3 good years for real estate. And after that, what's happened is the inventories have really shot up because the existing players launched many more projects. You had new builders coming in. So there's huge amount of inventory across. And along with that, because of this war, the input costs surely will move up. It's already moved up. So that's also going to affect the real estate players going ahead, at least for the next couple of months. But then again, when you're investing in real estate, I think one should also look at those companies which, those builders which are in specific geographies, micro markets, which will see huge growth. For example, I mean, I'm in Navi Mumbai and I'm seeing the sort of a growth which is happening in Navi Mumbai right now. And with the new airport coming up, we'll have something like BKC2 coming up over the next 2 or 3 years. I think the maximum amount of spend by the in Maharashtra is actually happening in Navi Mumbai. So this has to pay off over the next, foreseeable 5 to 10 years. So this is the next big growth area. So I think one should look at those players who are concentrating in Navi Mumbai. I think they should do much better than the rest of the country.
You know, the person who's quite bullish on Navi Mumbai from our team is Sudarshan. He's just picked up a flat over there, Amrish. But thanks for giving us some insight out there. But we want to ask Sudarshan about the real estate market. But Sudarshan's come back because he wants to tell us about what do we expect from the March auto sales numbers. Sudarshan?
So come Wednesday, we'll start seeing these wholesales for the month of March 2026. And if you'd have expected that West Asia war would start impacting the production or say sales, well, the answer is no. March wholesales and the retail sales for auto companies have been strong, and it's been positively impacted by the onset of early festive season, or say Navratri. In 2026, Navratri was from March 19 to 27 against last year of March 30 to April 7. That positively impacted the sales. Now, considering all the factors, all the segments are expected to see double-digit growth, with passenger vehicles expected to see a growth of 10%, two-wheelers 18%, and other two segments, commercial vehicle and tractor segments, are expected to see a growth of 12% each. Now talking company-wise, starting with two-wheelers, Bajaj Auto, Royal Enfield and TVS Motors are expected to see a double-digit growth, while for Hero Moto, growth can be of 9%. In the four-wheeler space, in the passenger vehicle segment, Mahindra & Mahindra Auto and Maruti are expected to see a double-digit growth of 12 to 13%, but outperformance will come from Tata Motors passenger vehicle, which can see a growth of 25%, while for Hyundai, it can be a flat month. In the commercial vehicle, both Tata Motors commercial vehicle and Ashok Leyland may see a growth of 12% each for the month of March. And even in tractor segment, we might see a double-digit growth for Mahindra & Mahindra tractor segment. But the concern is going forward, because if the gas supply shortage is to persist, sources say all these auto companies will start seeing a production cut. So we'll have to see how exactly next few months pan out.
All right, we will slip into a break. Thanks, Sudarshan, for that. We'll come back with more on the markets.
Welcome back. Well, we are drawing the curtains down on a very, very difficult series actually for the bulls. The Nifty will go home with a cut of more than 12%. The Nifty Bank actually will go down home with a cut of close to around 18%. So that's the kind of selling that you have seen. Both those two indices getting into correction territory. And the end as well, not very, very pleasant, though from the lows we did see some kind of recovery in today's trading session. Let's wind down the markets for you with news that in today's trade itself, more than 1,000 stocks made a 52-week low. That's the kind of pressure we've seen in our markets. Well, stocks that lost out, Bajaj Finance, SBI, Bajaj Finserv as well as Shriram Finance, all of them down between 3.5% to around 5% or thereabouts. Kotak Mahindra Bank came in for a sharp knock. That was down 3.5% in trade today. What did pretty okay? Well, there was some hiding to do in metal stocks. Hindalco was the outperformer. The biggest gain on the Nifty, up 2%. Tech Mahindra as well. Maybe valuations have come to a point where the street is interested. That was up close to around 2%. And Coal India as well was up close to 1%. Big boy Reliance Industries was up only around 0.5%. But when that big boy holds one end up, it's at least good news from a bullish perspective. From the broader markets, there were a few winners. So let's run you through them first. Ganesha Ecosphere, well, that stock is up close to 7.5% in an otherwise very, very weak market. Remember, the stock is a third of what it was at its peak, but big move out there. KNR Construction going out there. What lost out? Tata Motors. CB was under pressure. Grove was down close to around 8%. Ola Electric, now a 22 rupees stock, that was down close to 7%. HEG as well gave away close to around 6% of what it's put on. Orient Pro was down close to around 5%. Syrma was down close to around 5%. And losers...
Hello and welcome. You're watching On the Record with me, Shireen Bhan. It's been 12 days since the abrupt exit of Atanu Chakrabarti as the chairman of HDFC Bank. In his resignation letter, Chakrabarti said, and I quote, "Certain happenings and practices within the bank that I've observed over the last 2 years are not in congruence with my personal values and ethics," unquote. The bank's board said it had no indication of the issues involved. Mr. Chakrabarti's resignation also prompted the RBI to issue a rare public statement to allay fears of customers and shareholders. The RBI says it has found no material concerns on record as regards the bank's conduct or governance. Since his exit, HDFC Bank stock has fallen about 13%, wiping out nearly 1.6 lakh crore rupees in market capitalization. Joining us now for his first interview since his resignation is Atanu Chakrabarti, the former chairman of HDFC Bank. Mr. Chakrabarti, many thanks for joining us here on CNBC TV 18. Let me start with the 18th of March, sir. That is when you decided to put in your papers. Now, abrupt, sudden, there's nothing routine, quote unquote, in your words. You call your resignation routine, but there's nothing routine in the manner in which the resignation happened and what transpired post that and what you said in your letter. If I could start by asking you, what prompted you to put in your papers? What was the trigger? What was the tipping point? What was the final nail in the coffin?
Well, permit me to first thank so much for having me on your show. It's always a pleasure being here. Let me tell you, there is a bit of a background to it. I joined the bank as a part-time chairman, which is also seen as a non-executive chairman. Both are very similar terms, similarly understood. And independent director on the board of HDFC Bank about 5 years back, slightly less than that. However, my name had been doing approval rounds with RBI before. So I had some opportunity to study the bank and felt that it needed to grow bigger and also improve its asset side. And so within a year, you had seen, and with the help of management and HDFC Limited, which was erstwhile promoter of the bank,
right,
that the bank went into a merger with its parent, which was one of the biggest mergers in the history of the bank. The very well executed merger as well, because, however, as always, there are small and bigger flaws, which always remains, but that is okay. It went off well, which also improved the asset side. However, I have written in my letter that there are, it has to fully fructified. I'll come to that later. Subsequently, the bank was also able to sell Credila, one of its companies, in a sense monetized it as per regulatory instructions. Subsequently, bank could also do the IPO of HDB Finance, one of the NBFCs under it, as per the regulatory guidelines laid down for the banks as well as for systemically important NBFCs.
Right.
These were all part of some of the actions on the business side, on the strategic actions during the time that I was in. Apart from setting up rather being a participant in, shall I correct myself, in setting up a good assurance setup under a very good teams who are able to do that, and also improve the governance structure. All those existed, but they needed better structuring and better flow of information to and fro between the committees themselves, and allow greater free-flowing discussions in the committees and the board, so that the issues are discussed, addressed, spoken to, and good informed decision-making takes place, in which every director, whether executive, non-executive, or independent, participated wholeheartedly, with varying degrees, naturally. So that was the background. And rest, as you asked my question that what happened? Well, my resignation letter needs to be read in its entirety. starting with the first paragraph, which I elaborated further. Then I have also told towards the end that I have great faith in the verve and energy of the middle level management. That's what I always look at. Senior level will move on, but the middle level is very important. And that was where I see a great amount of energy, verve. They need to be channelized. Now that is
if I may, sir, it doesn't answer my question because as I pointed out, you specified that there was a period of 2 years that you observed certain practices and happenings that clearly made you uncomfortable, that eventually led you to put in your resignation letter. Were these matters discussed with the board in any form or fashion? Did you raise your discomfort at the board level over the past 2 years in any form or fashion? And perhaps if those were not then adequately met, was that the cause for your resignation? I'm still trying to understand, as is everybody else, why did you put in your papers on the 18th of March?
Leave aside 18th of March. It could have been 19th of March as well. So leave aside the date.
I'm only going with the date that you actually put in your papers.
Yeah, that's even a month later would have had as much speculation as this because of a bit of lack of understanding in the larger domain about the word of value and ethics both. Now, if you see, my first term was largely covered grappling with the issues arising out of merger, which was very large, disbalances balance sheet, so on and so forth, and also preparing for meeting the regulators' conditions. Not that things were not happening during that time. But if we largely see that what are independent directors charged with, they have onerous responsibilities with respect to upholding ethical standards, probity, integrity, ensuring that management performs adequately, shareholders' wealth is maximized. They also have fiduciary responsibility with respect to depositors, which means that value terms, there needs to be a very high level of values with respect to honesty, integrity, transparency, fairness, and accountability, which translates for customer. And that's very important because for me, customer is the God, and I guess should be. That's what Gandhiji said, is that there has to be a long-term relationship of loyalty with the customer, not transactional. There has to be avoidance of risky practices which puts customer or depositor or anybody else dealing with bank at risk. Also that the bank contributes to the stability of the economy, improves credit growth. These are few of the conduct issues, and all these onerous responsibility ensuring that also lies, or rather largely lies with the independent directors. Therefore, that largely is the background setting. But you wish to ask me something there.
You've said a lot of things there, Mr. Chakrabarti. Let me try and unpack them. You said risky practices. Now, if I may ask you, was the bank indulging in risky practices that made you uncomfortable? If yes, did you raise that particular issue or those particular issues at the level of the board with the management?
Normally, I do not share any boardroom discussion. So, Shirinji, here also, I would not have shared any, except for one matter, which has come to public light by an interview by the CEO of the bank itself. Otherwise, I would sort of apologizing for not elaborating further. But just to elaborate, and if that throws any light, in the interview with the ET, date that's Economic Times, Mr. Jagdishan who has been the CEO of the bank for the last 5 years, with respect to the issues in Dubai, where the conduct issues with respect to customers, onboarding, and other things have been continuing from 2018, had come under both regulatory lens, both with international and domestic regulator. And they're all on record. So it's it's not that it's not known. And however, what he has said is that this was a technical lapse in documentation and regulatory interpretation. So it's seen as something technical. I feel if large number of customers are hurt, some amount of regulatory, or rather large amount of regulatory focus has come on the bank. It also brings reputational risk to the bank. Therefore, while the issues have been addressed, there has been involuntary separation of 3 senior mathematics. That has been reported.
The termination, yes.
As well as 12 other people punished from major penalties to minor penalties. They are all at very senior levels. But they are a posteriori action. Something goes on for 8 years and suddenly we take an action. People will say that those are concerns addressed, go home. Perhaps, and that's where I'll come to that. I feel that these conduct issues should not arise at the first place, or the supervision, tight supervision, should ensure that even if they arise, they are nipped in the bud. However, if they are termed as technical, it leaves a little bit of a leeway. Perhaps they are experienced people, their reading may be correct. That's why I have not used divergence, I've used the word incongruence with my value and ethics. My value and ethics are very different from that. It's not that I am talking about values in a very rarefied atmosphere, that I have already elaborated deliberately before that, and nobody will deny that they are not needed for a DSIB-like HDFC Bank, and I take pride in being part of the bank for all these years. And, but that is where the incongruence took place. There are many other matters, and apart from that, underperformance with respect to the share value not performing up to the mark, which meant that shareholders' wealth was not getting maximized. Also, CASA was low, and cost-to-income ratio was high. A lot of people say, in the bank also I heard that chatter that it is because of merger. No, merger, if anything, was the best thing that happened. CEO himself has also mentioned on record. I'm in complete agreement with him. And that really didn't distort the balance sheet. And if at all, some distortion should have got corrected. Therefore, both underperformance, which is important for maximizing share, is a part of duty of the independent director, which comes out of the values and the ethical standards which we independent directors are required to uphold. And I was an independent director. So that was my dilemma.
Mr. Chakrabarty, again,
I'm sorry for being voluble on this.
No. I'm glad that you are being voluble in explaining to us what may have led to your resignation. But I want to go back to what you just said, sir. And you're raising the 81 mis-selling issue as one of the issues where you believe the bank ought to have handled the matter differently. Now, was there something that you had raised at the level of the board prior to the actions that were taken? And do you believe that there are larger governance issues at HDFC Bank that require being addressed at this point in time? And is that a concern today for shareholders, for depositors of HDFC Bank?
Look, as a private citizen, as I have said that, you mentioned that certain practices, the board was seized of this matter at least recently since 2023 when regulator had raised a concern. Central bank had also raised, our own central bank had raised the issue way back in 2018 and subsequently always brought forth as and when the matters came up. So it's not that, as I said, there was a regulatory focus on this particular matter. I'm referring to this matter because others matter I don't wish to discuss unless they are in
But there are other matters where you believe that supervisory oversight should have been better.
Of the bank?
Yes.
The
management.
I guess that's where we have, I wish to clarify things further. Apart from supervisory oversight, that is a matter of a posteriori conduct. There has to be a priori conduct also, because bank keep people's money. Bank advise people. If I'm taking advice, I need a priori, that is before occurrence of an event. Ideally, event should not occur. I'm not saying that in a large system like this, events will not occur. They occur world over. However, the incentive structures, the oversight of the management and the board should ensure that they are aligned with the interest of depositors, shareholders, and public at large. And that's a belief system which translates into ethics and conduct. So it is not that action has been taken. What more I can say in this? Action has been taken. I'm sure there would be remediation action. But we don't dig wells after the fire is there. It causes reputation loss. Why should it cause at the first place? But that's with respect to bank. What about the faith and belief of so many other people? I'm not saying that people are not concerned about it. I'm sure each director, each senior manager of the bank is concerned about it. However, the level, somebody has calls it technical, I feel they are serious, should be nipped in the bud. They feel it's once in a kind of misinterpretation which has possibly caused it. I possibly feel that where was the value in interpreting this thing? So there are incongruences in thinking. And I felt that if there's an incongruence, one lives in a dilemma. I have referred to 2 years as a broad time framework. Don't read too much into it, but as a broad time frame during which my observance has taken place. Beyond that takes me down the memory lane, which may be a bit hard to recollect. But having said that, this incongruence only puts an individual in a dilemma. And as an independent director, and I'm very democratic in the process, and in any case, there's no way I would like to impose my will on others. If I feel that it doesn't match with the way I think I should.
So let me put this plainly, Mr. Chakrabarty. When you talk about ethics and values, you talk about governance, right? Because you've also brought up performance-related issues. Now, performance-related issues, underperformance can be another matter entirely, can be assessed and evaluated entirely. That doesn't necessarily have to do with concerns on ethics. So you're raising two concerns. You're raising governance concerns and you're raising performance concerns.
Very interesting question you asked me. Well, ethic and conduct, they go together. They encompass the entire governance, the corporate governance issues within them, which inter alia. After all, why bank is set up? It's meant to be for shareholders and depositors and other stakeholders. Schedule 4 of companies law is very clear about it. Therefore, when I mention these issues, they are actually encompassing the entire thing within the 4 corners of the company law and Banking Regulation Act, which also provides for superintendence, control and direction of the managing director, which means the entire senior management for the board. And I feel as a chairperson, if my value and ethics, and I'm at pains to explain, is not incongruence. I'll time and again use this geometric term which I learned in my childhood. With those standards which I want and what are set in the bank, and which people may rightly feel that they're not matching with the commercial requirement of the day, I should move on.
You talk about this being a dilemma for you. Did you raise this in any form or fashion, formally or informally, with the regulator? And I say this in the context of the fact that on the very same day, in a very unusual move, we actually had the Reserve Bank coming out and saying there is no concern with HDFC Bank, that there have been assessments and reviews done periodically, and coming out in support of the competence of the management. A, did the RBI statement surprise you? B, did you have any conversation, informally or formally, with the Reserve Bank of India, with some of the issues that you believed that you were uncomfortable with?
With RBI as well as with other regulators, as I mentioned initially, during the merger, it was more intense. Subsequently also I had been interacting with them, both informally and formally. Formal occasions are few during the course of the year. Informal occasions are many. However, those discussions are privy between me and the regulator. Frankly, I would not like to discuss that. You will appreciate
Fair enough. But if you could at least confirm to us whether you did, with the regulator, raise some of your discomforts. I won't ask you for the specifics, but did you formally or informally raise?
As I said, large number of issues, various issues do get discussed, and it will not be fair to the other person, and those are, many discussions are informal in nature. It will not be fair.
Did you have formal or informal conversations with the government about any matters related to your discomfort or any specific issues with respect to HDFC Bank?
I think the role of non-executive chair ends with the regulator. Most of the issues, unless they are very broad policy issues, structural issues, which once in a while I met once in a year or something. But no, not nitty-gritty of it. That's, I don't think.
Did the incongruence that you speak of lead to differences in the way that you believe the bank was being run by the management? Did you have run-ins, differences of opinion with the management over some of these issues? Because it's also being viewed as a fallout, as a personal clash between you and the management.
I've seen some amount of chatter on that. So differences should be there in running a very large institution. I myself have always, as a chairperson of the board, whether here or anywhere else, have promoted a lot of dissent, so that the voices and ultimately harmonization, so that people come around to a particular point of view, which should go through, because institutions have to run and do their business as well. They can't be stalled, but various point of views need to be discussed, brought forth, analyzed if need be, and brought forth. And that's the structure of governance I was earlier talking to you about. It formed a very important part of it. So during that course, differences would be there, not only with, would be expressed, people would express a different view, vice versa. With everybody else, it could be there. And as a chairperson, it's also my role to bring all the differences as much as possible within a certain boundary. Therefore, I don't think personality differences are generally played up as a causing factor, because people feel that I don't even live in Mumbai. I barely travel 3 to 4 days. I think that is overblown.
It's overblown.
Yeah.
But it wasn't the determining factor for your resignation.
No, not at all. Not at all. Not at all. Actually, not by a long distance.
Not by a long distance. And there's been a lot of rumors.
I hold all the directors who worked with me in very high esteem.
There's been a lot of rumors, so let me get you to address some of those. The reappointment of Mr. Jagdishan as CEO. Were you opposed to the reappointment? Of course, that reappointment process is still work in progress, and the name of the reappointment hasn't been sent to the Reserve Bank of India, is what we're given to understand just yet. But were you opposed to his reappointment?
Just to clarify and kill the speculation on that front, the matter of his reappointment, ideally the process is it should be first discussed in the NRC, that's a Nomination and Remuneration Committee of the board, and then comes to the board, in which both the chairperson is just a member. It hadn't even come there along with the full documentation and a third-party agency who would look into the issues, does the full analysis and performance and so on and so forth. So something which was not even discussed, how could differences be there?
So you had no objection to his reappointment?
No, objection or even having a view, the situation had not arisen. So, how do I, if I say that I had objection or no objection, which means a priori view without facts and figures. It was not, if something doesn't come up as an agenda item, why should I have an opinion at that point without reading about it? It's very important if on the board of any bank or that matter, any organization, that you should examine all the facts and everything. And as of today, why should I have an opinion? I am out of the bank and have nothing to do with it, apart from being a customer with sizable relationship value with the bank.
And again, I go back to more specific issues. HDB Financial Services and MUFG, a deal that was apparently being stitched together, and a deal that didn't have your blessings, didn't have your support, and which is why it fell through.
Well, as an independent director, I guess, and a part-time chairman, too much of attention is being drawn to the chairperson. Is at the end of it, no paper comes to the chairperson. He or she does not take any independent decisions. Apart from that, I personally was living in Delhi, as I just mentioned. I ensured that I do not interact with major shareholders directly or clients directly. I rarely sent forwarded any proposal other than somebody came and said, go and meet those people, and ended there. Idea was to avoid any impression that I was trying to influence decision making. I've been very careful, knowing that these organizations are very sensitive. Therefore, my blessings, they, since you use the word, do not matter till I speak my mind on the board or committee if it's needed. However, now coming to the specific, HDB Finance was promoted by the bank before the merger, and RBI had desired that by September or October 2025 it should have an IPO. So it was to meet that requirement that IPO was carried out, and under Shri K.K. Mistry ji, who is a director on the board and a very well-known person with great reputation. He headed the committee with 3 other independent as well as whole-time directors, and was cleared by the board for going to the IPO. Rest was overseen by this committee. So where do I figure, apart from saying yes to whatever recommendation which seemed absolutely logical and in keeping with the regulatory requirement also. So where anything else comes up.
Let me go back then to the nub of the matter, because as you said that it is on the matters of values and ethics that you chose to step away from the bank, even though you had little more than a year left to go for your tenure to conclude. At this point in time, do you believe, and straightforward question, do you believe that there are deficiencies in the governance structure at HDFC Bank?
Which institution doesn't have deficiencies? If you ask a very absolute, so you are asking question on absolutes. In absolute term, for any institution, there would be deficiencies which have to be regularly corrected. I'm not looking at defects. I do not wish to value judge conduct of an organization beyond what during my currency there. So I'll, as a bad penny, keep coming back to this issue of incongruence. I'm sorry about that, but I guess I must impress upon why I did it, because, as you said, there's some amount of controversy around that. Again, controversy, I'm using
ambiguity, because people are still unclear as to what led to your resignation and whether the issues that led to your resignation are issues that shareholders and customers and the regulator should be concerned about, worried about. The regulator at this point in time seems to suggest no, which is why it comes back to then what were the points and the specific issues that you were raising?
Regulator takes its decisions, gives a judgment on the basis of the data and everything provided to it. And I have absolutely no quarrel. I'm very happy with that. And one of the words that is well capitalized, I completely agree with the regulator on that. It's a sound institution. However, a sound institution has to become even more sound. As I said, that if value and ethics cause ambiguity, then I guess I'm a bit pained, so as to say, because events don't describe even ethics and the standard of ethics. If you look at the law itself, and I'm now taking down you to the law itself, the first line in Schedule 4, when it talks about the responsibilities, upholding ethical standards, probity and integrity. No, they are not attaching, they are not putting down parameters, 5 points for this, 6 points for this. You have to judge on the basis of the values that you feel organization should have. They're regularly discussed across, spoken to, I guess, directors, if they do not, and they did, and everybody forms their own opinion based upon that. And I've never said that X is wrong, Y is right, or I am right, they are wrong. My only point was that it was not congruent with my own standard.
And I go back again.
I'm sorry, you may be exasperated.
No, values can still be subjective. But in the context of any organization, and especially in the context of a financial institution, there can be no debate on ethics. And which is why I come back to ask you, and I think that is the question that's being asked by others, including, of course, the market, is that if you had concerns with governance, then should you not have been more explicit? Should you not have been more specific? Should you not have given a clearer picture and a clearer view as to why you chose to walk away from the chairmanship?
Well, I guess amount of churn which this has generated, a lot of independent directors in future would refrain. Not so many questions have been asked to the bank on this matter, and once the clarifications from them have come, as much has been questions have been thrown at me for resigning, for saying something about two terms which are extremely important. You said values can be are subjective. No, they are not.
No, I said they can be, but there can be absolutely no debate on what ethics.
Now, even on values, if honesty and integrity are valued, transparency is valued, you can say the level of transparency varies because there are practical considerations. I appreciate it. Some people would turn out to be dishonest, but once, what level do we take those? Conduct is driven from that. And conduct and ethics are very interwoven. They're very intertwined. As I mentioned.
So then how is this not material, sir? Because then
it is material.
It is material because in your letter then you go on.
Otherwise I won't. I won't.
Because
I won't move away. It is material, but the materiality of it could vary, as I think was my standard, was maybe different than what the prevailing standard. I would only say the prevailing standard. then it's better to move away without placing blame, but leaving a door open for introspection for the board. And board introspects, they feel all is well, I'm a happy person.
Questions have been raised about the fact that you have been remiss in your fiduciary responsibility that you ought to have, and you know the SEBI chief also on record stating that independent directors, if they're insinuating, then should back that up with the requisite evidence. How do you respond to that? Because I come back again to the value erosion, the wealth erosion that has happened since the time that you put in your resignation. You know, we've asked questions of the bank. The bank says, we don't know. We're as shocked and surprised as everybody else. Now, that leaves the customer and the shareholder wondering what exactly is going on.
Shirinji, that's an excellent question. I guess you have brought around the entire debate. And let me conclude that part of the debate. A value erosion on share price of the bank had been falling for various reasons even before that. And if you see on that given day, my choice was not that Iran would drop a missile on Ras Laffan, and also Khadak or Paris Island were attacked the same day. Also Fed had some decision which was not in keeping with general expectation. Sensex next day tanked by about 2,500 points or more. And BFSI sector being 40% of the economy and bank having some amount of weightage, a rolling effect does take place on the bank shares. To that, perhaps my resignation also added a little bit. After all, people come and people go. If I was thrown under a bus, would that kind of
no, the point is that you threw them under the bus, that you've thrown the management under the bus.
Now you know, the part that value erosion took place, I guess is on account of resignation, is wrongly portrayed, and I completely refute that. Now, second, people say that insinuation. I'm particularly now addressing, where is the insinuation? I have said it's not incongruence. People need to understand the meaning of incongruence. I've been at pain to. I have not said anybody is wrong or anybody is right. I have not pointed out any. And even today's discussion, I have only referred to what is in the public domain, what the regulator has said. So if somebody has bothered to use the word insinuation, they need to read the dictionary themselves. I'm sure, you know, people wouldn't have, but there's no insinuation made in my letter. As I read it very correctly and plain English, I think there is none whatsoever. I hate to make insinuation. That doesn't keep with my own values and ethics. Third, I'll come back to the final issue of what were your concerns. I had mentioned that all the concerns are, if you're addressing concern, is a posteriori. It is like a 5-page audit and you answer them. Why those things should arise at the first place? What is the root cause? How would ensure it never occurs? Rest otherwise becomes ticking the boxes. So I'm saying improve the thinking level of value level, root your ethics and value. Perhaps they feel it's done. I'm not saying that they're wrong or the thinking is overall wrong, but I find it very strange, the debate around value and ethics, when people should be discussing these issues, what is value, what is ethics, or rather asking what is your concern? Describe your concern through on value and ethics. I guess people need a primer on value.
Well, if I may, do you believe that there was malign neglect or benign neglect?
As I said, my saying any of these things would amount to an insinuation. So I'll refrain from commenting.
2 law firms have now been appointed to look into this matter, so to speak, to assess, you know, the governance structures, I would imagine, and the fallout of your resignation. Have you been in touch with anybody? Have they reached out to you in any form or fashion? And what do you make of this appointment?
Well, ideally, I shouldn't be concerned, but I read that in newspaper also. Otherwise, I'm devoting most of my time on reading the sports page of the newspaper these days. However, appointing a lawyer is more of a compliance requirement. Perhaps that may be an input that the board of the bank may be seeking. But what I mentioned, resignation is more a larger governance and governance plus kind of an issue, which the board of directors of the bank themselves should be introspecting and doing. No external lawyers would do that for them, apart from pointing out this meets the law, which doesn't meet the law, with a very strong four corners, or it met this audit para and it didn't meet that audit para. I don't know. That's not how things go. Lawyers could be appointed. I have nothing. I have no comment on to make on that. But that's essentially a compliance requirement which the board of the bank may have sought.
I come back again, Mr. Chakrabarti. You said in your words, this is a governance plus issue. Now, when you talk about a governance plus issue, as the chairman of the board, did you bring some of these governance plus issues to the notice of the board? Did you make them an agenda that the board needed to discuss, as you said, so that you don't act post-event, but you act pre-event and ensure that you don't follow the same pattern, in your words, that has perhaps transpired in many of these
Excellent question again, Shirinji. But kindly permit me to say this. Whatever has been discussed in boardroom, for me, remains in the boardroom unless brought by somebody into the public glare. I have discussed one issue to describe something, to say that how the differing conduct issues or ethical issues, the standards differ. And they may be correct standards on both sides. I may also be correct, they may also be correct. It's just an incongruence. And both of them may be meeting the requirement of the law at a given point. So that's not an issue. However, all that has been discussed, whatever has been discussed in the boardroom, I will not like to reveal at this stage by myself unless they come in public.
Let me end by asking you, Mr. Chakrabarti, do you regret having written this letter?
No. Why should I? Do you have any reason to ask me that question?
No, because again, I go back to the point that there are questions being raised, and some with some legitimacy, that you should have been more explicit if you were making a very sort of significant material statement, that there should have been some explicit time given by you to explain what you meant when you talk about governance as well as performance related issues.
I guess materiality or issues, they are subordinate to the larger matter that I mentioned. And what I mentioned was internal to me. As I had told you, that it caused dilemma for me. Whether it causes for the bank, its board has to address that. If it causes dilemma to me and I find it difficult to live with, I should move on. They feel it's okay, let it be done. So I guess for me, that's where the entire thing ends, because I've got over with my dilemma. That, as I've explained to you, tried to explain to you at length. I don't know how clear I have been. However, the demand for certain amount of evidence to go with value and ethics, I guess we will enter into a very philosophical debate, which is better avoided for the given course of time. So maybe a separate primer with somebody else who understands these issues much better. But as an individual who wanted to live with certain code, I feel that is how it is. And if the bank feels out there, and I'm not saying they have been wrong or anything. So that's no insinuation even intended, or no malice intended. Let me put it this way: malice is intent, insinuation is more material. So no, the rest, materiality and everything, are very subordinate issues. And again, as I said, a posteriori.
So you believe that there is cause for concern for shareholders, depositors, customers, or do you believe that that the structure, practices are in place, and perhaps every large organization goes through some degree of pain and some degree of negligence, and it is manageable?
I would not like to comment on that part since I'm not with the bank. It would be unfair of me to comment and assure the shareholders of something for which perhaps now I don't have visibility or responsibility.
Ms. Chakrabarty, thank you very much for joining us here on CNBC TV 18, for giving us an understanding of what transpired and what led to your decision to resign ahead of your tenure ending at HDFC Bank, and why you believe that it's an incongruence of values and ethics that you spoke of, and explaining to us the dilemma that led you to make the decision that you eventually did. But appreciate you joining us here on CNBC TV.
Thanks to be on your show. It was a pleasure.
Thank you. With that, it is time for us to wrap up this edition of On the Record. From all of us here on the team, goodbye. Thanks for watching.
Hello and welcome. You're watching CNBC TV 18. A quick look at the headlines at this hour. Crude oil prices breach $115 as tit-for-tat strikes between Israel and Iran continues to roil sentiment. Brent crude is on track for the steepest monthly rise in history. Kuwait says an Indian worker has been killed in an attack on a power plant. Iran-backed Houthis enter the war and fire missiles at Israel. US President Trump says Iran's new leaders are being very reasonable in negotiations, even as thousands of more US troops arrive in the region. Trump also warns he could seize Iran's Kurg island easily and take the oil. Iran accuses Washington of seeking negotiations while preparing for ground operations, says proposals conveyed to Tehran via intermediaries have been mostly unrealistic, unreasonable and excessive. Pakistan says it is ready to host the talks between US and Iran. Sensex and Nifty end the financial year with losses of over 5%. This is the worst annual performance barring the COVID pandemic shock. Nifty, IT and real estate down over 20% this fiscal. Rupee gives up all the gains in late trade to hit another record low against the dollar. This despite RBI's decision to limit open Forex positions of banks at $100 million. Bank asks RBI to relax the April 10th deadline. Nifty Bank loses over 3% today.
And over a period of time, those who do not invest in design will be weeded out. We'll make sure that they are weeded out. I'm saying that very blunt and very open.
IT and Electronics Minister Ashwini Vaishnav warns of harsh measures, including freezing of production-linked incentives to the electronic component industry, urges companies to invest in design and cautions those not doing it will be weeded out. Vedanta moves Supreme Court seeking a stay on Adani's resolution plan to acquire bankrupt JP Associates. Vedanta chairman Anil Agarwal claims his company was declared the highest bidder, but the outcome was later reversed. Police deployed outside Kotak Mahindra Bank and AU Small Finance Bank branches in Haryana's Panchkula this morning, days after an alleged fraud involving the civic body's fixed deposits came to light. Kotak Mahindra Bank tells CNBC TV 18 it has placed an amount of 126 crore rupees with the municipal corporation while the investigation continues. Less than 4 weeks to go for Tamil Nadu elections. DMK Supremo and State Chief Minister M.K. Stalin files nomination from Kolathur, a seat he has represented since 2011. Actor turned politician and TVK founder Vijay files his nomination from Perambur. He is also contesting from Trichy East. Those are the headlines that we're tracking for you at this hour. Market Forward coming up next to take all the action forward. Stay tuned.
Broad-based sell-off wipes out nearly 10 lakh crore rupees in market cap. The Sensex plunges close to 1,600 points. The Nifty slips over 500 points, while the broader market sees sharper cuts. FY26 ends as the second worst year for the markets in a decade if you discount for COVID.
The rupee gives up all the gains in late trade to hit another record low against the dollar. This is despite the RBI's decision to limit open forex positions of banks at $100 million. Banks asked the RBI to relax the April 10 deadline. The Nifty Bank drops over 3% in today's session.
Crude oil prices breach $115 per barrel, remain on track for the steepest monthly rise in history, while direct strikes on aluminum facilities in Gulf push up prices and stocks of Indian producers. Good evening. You're watching us here on Markets Forward, your go-to show where we aim to get you key data points together for the next trading day and also summarize today's trading day. I'm Mangala Malu, with me, Hormaz Fatakia. Hormaz, it was a broad-based sell-off today. 500 points shaved off Nifty. The Nifty Bank nearly 2,000 points lower. The broader markets as well. At any point during the day, if you sold, you would have made money. That's the kind of day it was, trending lower. And it's not that we had a big gain earlier. Multiple weeks of a sell-off. We start another week with another sell-off as the war goes into its fifth week. So uncertainty all over.
Uncertainty and absolutely no surprises, no let-offs whatsoever as well. The Nifty breaking below every possible level that it was supposed to defend today, which included last Monday's low of 22,470. It's ended convincingly below those levels. And as Mangla was pointing out, the big drag was the Nifty Bank and is down 2,000 points, heading towards that bear market territory now, just around about 900 points away from those levels. So not good going for the banks, not good going for the currency. The yields touching 7%, oil prices remaining elevated. There is absolutely no respite whatsoever. Now here's a lineup of what we have in store for you today. We start with the top movers and shakers of the day with Sudarshan. FY26 has turned out to be the worst fiscal for the markets in a decade, excluding the COVID shock. We get you the details shortly, and we also discuss why metal stocks and urban company were buzzing in today's session. And last but not the least, we hear out the key corporate voices through the day. To our first segment, Sudarshan is here with the big movers of the day. Sudarshan.
It was a fall across the board, and amidst major fall in the market, one sector, one segment where we have seen a deeper fall was the financial names. Bajaj Finance, Axis Bank, SBI, HDFC Bank, even in the mid-cap space, all the PSU banks, all the NBFCs were sharply lower. You can see a cut in the range of 3 to 5% in all the major Nifty financial names. And that has come on the result of big fall we have seen in rupee and big surge or spike that we have seen in 10-year bond yield that has gone past 7% for the first time in last 2 years. And also all the CV players have been under pressure because there is a concern regarding the production cut that we might see over the next few months because of gas supply shortage issue. And that's the reason Ashok Leyland has been moving in one direction. Today also down more than 5%. Tata Motors commercial vehicle has seen a deeper fall, fallen almost 8%. And Bharat Forge 2 has seen a cut of almost 3%. But there were some names which have seen a gain even in this week trading day. And first was Nalco, because there was a positive news related to aluminium plant shut in a different country, not in India, and that has impacted positively to all the aluminium names. And Nalco up 4%. Avenue Supermarts up more than 2% ahead of its quarterly update, and Dwarkesh Sugar tracking a big surge in sugar price. This stock has surged 9%, and Urban Company on the positive commentary related to InstaHealth has surged more than 3%.
Take that point, Sudarshan. So few stocks gaining a lot, but a lot of stocks losing a lot in today's trading session as well. To take this discussion forward, we have with us our market experts, Amrish Balika and Chandan Tapre of Motilal Oswal Financial Services joining in. Chandan, where's the respite? I mean, that's the simple question, because the market's been seeking lower levels. Every time we hit a panic low, we hope that maybe that low will hold on to the next week. And come next week, we actually break that and seek lower lows.
Yes, good afternoon, Mangalam. The market is continuously making lower top, lower bottom on weekly chart. It has seen a corrective move of almost 4,000 points, and there is no respite. Every even meaningful bounce or a small bounce is being sold. And till this, the trend of lower top, lower bottom is not negated. It would be tough for market to get stability. Even now, the lower level of 21,750 is opening, and that was the low made on April 2025 at the time of previous the key trigger. So as of now, I believe 21,750 could be a major support. But yes, we need to keep in mind until market doesn't surpass an immediate hurdle, the immediate structure could be negative. So till it remains below 22,750, use any small bounce for selling opportunity, and index can go down towards 21,750 and below. If I look at the data internal, India VIX further moved by around 4%. It's now at 28 marks. And we have noticed that in this month, the VIX has moved by more than 100%. It was near 13, 14, now it's near 28. So at the 28 weeks, the movement of 400, 500 points will be the new normal. So as of now, the structure is weak until 22,750 is not surpassed. Any bounce could be sold for 21,750 marks.
Right. Any bounce could be sold into, and the VIX too continuing to remain around levels of 28. Meanwhile, FY26 has turned out to be the worst year for the market returns in a decade, excluding the COVID shock. But does history offer a silver lining? Sudarshan is back with us. So over to you.
FY26 comes to an end and market has posted negative returns after gaining for last 2 financial years. Nifty is down 5%, erasing almost the entire gain that we had seen in FY25, and more than 15 Nifty stocks have gained positive returns, while more than 16 Nifty stocks are down more than 10%. So which were the biggest major losing indices? Nifty Realty down 21%, followed by Nifty IT, that too has seen a fall of 20%, and Nifty FMCG too has seen a fall of almost 13%. But if you talk about gaining indices, here PSU Bank has gained the most, up almost 32%, followed by Metal, that has seen a gain of 23%, and Auto Index too, because of the sharp gain that we had seen in the second half of FY26, this index too has seen a gain of 14%. Now coming to the top Nifty gainers in FY26, Shriram Finance was the top Nifty gainer, up almost 38%, followed by BEL up 34%. SBI, Titan, Eicher Motors too have seen a gain in the range of 27 to 32%. But if you talk about the losers, Trent was the biggest Nifty loser, down 36%, followed by TCS down 34%. Wipro, Indigo and Adani Enterprises too have seen a cut in the range of 20 to 27%. Bigger cut was seen in the mid-cap names, but first talk about the mid-cap gainers. Delivery was the biggest gainer, up 68%, followed by AB Capital, AU Small Finance Bank, L&T Fin and Indian Bank. These stocks have seen a gain in the range of 64 to 65%. But if you talk about the major mid-cap losers, here KPIT Tech was on top of the chart, down 50%. ACC, Jubilant Food, Tata Chemicals and Coforge too have seen a fall in the range of 30 to 32%. So what about FY27 or say going forward? Since 2003, we have not seen 2 consecutive financial years where market had seen a fall. And normally history says that after falling in a fiscal in the next financial year, we have seen a big reversal or say big gain. So in 2003, Nifty was down 13%, followed by a gain of 81% in FY 2004. 2009, 21% down. 2010, almost up 74%. Similar pattern was seen in FY12, FY16, even in FY20. COVID year, we had seen a fall of 26%. Then we followed by gain of 71% FY21. This financial year, we have seen a cut of 5%. We'll have to see how the FY27 pans out. But there is a hope that we'll see, like our tagline suggests, onward and upward move. And we'll have to see after a fall of 5% if there is a gain in the next fiscal we see.
Take that point, Sudarshan. Thanks a lot for that. And where we go the next fiscal depends a lot on how the rupee performs as well, because while we're down 5% on an absolute basis in dollar terms, it's a lot more. And that's the next story that we're tracking today. RBI's directive to cap banks' open forex positions at $100 million triggers a sharp rupee rebound. However, the currency ends the session at record lows once again. Bank stocks too slip on concerns of an earnings impact. Lata joins in with a comprehensive wrap on that detail. Lata.
Well, the rupee started higher and expectedly so, almost a rupee and 20 pies higher than where it closed on Friday. That was because of the Reserve Bank rule forcing banks to sell their long positions. But it didn't last long because at lower levels, there were buyers of dollars. FPIs who are exiting left, right and center. But more importantly, we understood that a lot of oil companies were buying the dollars because there was some deadline about buying Russian oil, which had got a bit of a leeway from the United States. And therefore, there was that hectic buying as well. But more importantly, if you look at, Kospi or Nikkei, or if you looked at the currencies, won, ringgit, all of them have fallen rather sharply today by about 0.5%, the currencies and the stock markets by about 2-3% almost. So it couldn't have been that India would have stood out of that. So that same selling of equities and buying of dollars led to the rupee, losing all that it had gained in early morning trade because of the RBI steps. Now, to come to the RBI steps itself, basically what it meant is the prevailing rule is the net positions of banks are to be limited to 25% of their total capital. But there was no limit on the gross position. What the Reserve Bank introduced on Friday evening was that gross positions should be only 100 million. And the chatter in the market was that banks have something like, 35 to 40 billion of open gross positions, which have counter positions in the NDF market. So the net positions are not very heavy. All those long positions had to be brought down. Would there be a loss? The expectation was that there would be. And if you took, maturity by maturity, for instance, 1 week maturity in the morning trade, the NDF market rate for a 1 week forward dollar was, at least 70 pice higher than what it was in the domestic market. The 1 month forward was again, something like 70, 75 pice. By end of day, that difference had narrowed down to about 30, 35 pice. Likewise, the 3 month dollar. I'm taking 1 month forward dollar and 3 month forward dollar because these are the places at which there are more contracts. More people hedge for 1 month. So there the difference has shrunk. Likewise, in the 3 month dollar as well. Early morning, the difference was about 1 rupee plus, 10 pice or thereabouts. By end of day, that had shrunk to about 70 pice, 75 pice. So it looks like the losses that the bankers expected at the start or over the weekend was not as severe. It was less. And there were also client deals that they could do. The limit of 100 million open positions is only for banks. Clients can keep open positions with their books, and many clients had a deal with banks. They could offload some of their positions. So as of March 31st, the net open positions and the mark-to-market losses are perhaps less than what was feared over the weekend. I must add a word on the bond markets as well. The negative sentiment across and crude going to $117 meant that, there was negativity in the bond markets. The 10-year yield went to 7%. There were also fears that if the Reserve Bank can move so strongly on the currency front, it might also tighten liquidity or raise rates to protect the currency at some future date. So that also spoilt the mood in the bond market.
It did, and that showed up on the prices as well. Lata, thank you for that. Amrish, well, what about banks then? There are multiple headwinds that are surrounding them. The latest directives from the RBI, be it the rising bond yields. We are about to report earnings as well for the quarter gone by. With the correction that these banks have seen, do you believe that they have reached attractive levels, particularly the larger private names?
I mean, if you look at the way most of the PSU banks had moved in the last close to 9 to 12 months, and with the sort of a correction which I've seen, started looking attractive, but then these worries are still there. I mean, you don't know as to when the next sort of issue could come up. I mean, the one which we saw lately was because of Forex positions. Possibly there could be some losses. They may not be as high as what we thought over the weekend, but surely there would be losses. So I think we could see further fall as far as the banks are concerned, maybe either 5 to 8% more fall from here. I think at those levels one should look at buying.
All right, we take that point. Amrish, just a final question to both of you all before we move on, and this one is on the metal space. Direct strikes on aluminum facilities in the Gulf push up aluminum prices and stocks of Indian producers. What's the fundamental and the technical call on that? We'll come to both of you all, but before that, let's go across to Nigel, who has more. Nigel.
Well, that's right. Over the weekend, there were attacks being seen by Iran on Emirates Global Aluminium's Al Tawali unit. Now, this is significant because the unit itself produced close to 1.6 million tons of aluminium in 2025. Remember, as is, there was a bit of a supply shortage, and this will further intensify that particular shortage. To just recap, in this month itself, you had a couple of shutdowns at Qatalum, that is in Qatar, as well as Aluminium Bahrain. And put that together, that pulled out close to 500,000 tons. And with this fresh attack, well, there'll be further supply disruption. In turn, aluminium prices could remain elevated for longer, and there'll be a bit of a supply deficit as well. So who stands to gain? Well, some of the Indian aluminium producers like Nalco, Hindalco, as well as Vedanta, they did a relative outperformance in today's market.
Nigel, thank you for that update. One of the few names that bucked the trend in an otherwise weak market. Amrish, ferrous, non-ferrous, tactical call, investment play? Where do your preferences lie within the metal space?
No, in fact, in the metal space, I mean, I've been bullish on steel and aluminum. I mean, whatever happened in the Middle East in the last few days is quite unfortunate. And that was surely not accounted for when I was suggesting buying into aluminum and steel. But then I think that will also help the Indian companies, I mean, at least over the next couple of months, because for these capacities to come back, I mean, into play, I think we will take a couple of months, even if the war ends tomorrow. Still, I think it will take a couple of months for these I mean, facilities to come back in stream. So I think for the next at least foreseeable, I mean, 1 to 2 quarters should be good for Nalco and Hindalco.
All right. Chandan, you have a top chart pick in the metal space?
Yeah, so comparatively quite positive on the Nifty metal. There are multiple reasons. First, Nifty metal, however, corrected by 9%, but comparatively resilience when I look at the market selling. And already 3-4 days back, it formed the bottom, and I believe selective counter could do well. And Nelco, National Aluminium, could be our preferred pick. In fact, even after the market decline in this series, the counter is up by around 10 to 12%. Supports are gradually shifting higher, holding well above its rising trend line. So one can accumulate this counter with support of 372, and I believe this can head towards 400 to 410.
Chandan, Amrish, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. Take a short break, get you all the top corporate voices on the other side. Stay tuned.
Welcome back. You're watching us here on Markets Forward. Now, before we get to the top corporate voices of the day, we've spoken about a bunch of these stocks which were moving around. One of them was Urban Company. It's up around 4% in today's trading session, but also up 13% in this month, where the market saw a sharp correction. And that's because the stock had already seen a big correction. A couple of these updates of the company doing extremely well. The latest reason being their Insta Help services doing extremely well in the month of March, which has crossed 1 million services delivered in this month with a few days pending. And this comes after the company hit a milestone of 50,000 daily orders somewhere in the month of February itself. To put these things into perspective, when this business started in the second quarter, they did about over 500,000 deliveries in the entire quarter. Then came the third quarter, which is seasonally very strong given the festive season and strong demand for all these people. Throughout the quarter, they did about 1.6 million deliveries. And here in the month of March itself, March and a little less, they've gone ahead and crossed that 1 million mark. They are still loss-making on this business as of the third quarter, but the company has promised that losses will reduce out there. So that makes it an important trigger to watch, especially given the correction that we've seen in the stock price. This, along with core improvement in their services business and the optionality of Native, has this stock fairly excited. But with that, as we speak about all these things, Hormaz, we'll have to obviously look at how the stock pans out in light of all the other platform companies too. The Sensex was lower today, as was the Nifty. Let's see where the Urban Company stocks goes.
Indeed, it was one of those stocks that did well today, though 4% higher for Urban Company. But on to the top corporate voices of the day, Triveni Engineering's managing director told CNBC TV 18 that persistently high crude oil prices may squeeze global sugar supplies as major producers divert cane to biofuel. He added that the Q4 has been good as elevated crude prices make ethanol production more profitable.
Quality Power Management joined CNBC TV 18 today, said they're targeting an additional 1,000 crore rupees in order inflows in FY27 while maintaining its guidance as West Asia exposure remains under 10%. Management told CNBC TV 18 that growth will be driven by rising demand in renewables and battery storage. The stock ended 7% lower.
Jupiter Life has secured a 10,000 square kilometer land in BKC and plans to set up a 500-bed hospital. The management expects to benefit from strong Mumbai pricing. The company says it has adequate cash to fund its 300 crore rupee capex and is comfortable taking on debt up to 2 to 3 times of its EBITDA.
All right, with that, it's a wrap on this edition of Markets Forward. Thank you so much for watching. Stay tuned to CNBC TV 18. We'll be back with more news and updates on the other side.
Hello and welcome to the special broadcast on West Asia War. I'm Ashmit Kumar. Now, US President Donald Trump, in an interview with Financial Times, has said that he wants Iran's oil and is interested in seizing Karg Island, an island that handles 90% of Iran's oil exports. The statement comes within hours of him saying that talks with Iran are going good and that it has accepted Trump's 15-point demands. He also claims that regime change has already taken place in Iran amidst the conflict, adding that the new regime is very reasonable. Meanwhile, Iran has warned that the US of consequences if it decides to seize Karg Island. Tehran believes Washington is deploying troops on the ground with plans to invade. In the last 24 hours, US and Israeli forces have launched massive strikes on Iran, even damaging a petrochemical plant in Tabriz, leading to power outages across parts of Tehran. Now, this comes amidst Iran striking an industrial zone in southern Israel, sparking fire and raising fears of a chemical leak. Now, Israel says that Iran has been targeting energy infrastructure. Fumes of smokes can be seen at the Haifa oil refinery. Meanwhile, Kuwait reported that one Indian worker was killed in an Iranian attack, which also disrupted power and damaged a water desalination plant at a facility. Now, Saudi Arabia's defense ministry has claimed that it intercepted 5 missiles heading towards the kingdom, while sirens went off in Bahrain, with authorities asking people to remain calm. Israel has also expanded its offensive in Lebanon. The UN peacekeeping mission there said that one peacekeeper was killed when a projectile exploded. Well, to discuss the implications of Trump's remark on seizing Karg Island are with us former diplomat Anil Trigunath, also with us strategic geosecurity analyst Anju Gupta and Banyan Tree Global CEO Sanjeev Yadav. To all of our panelists, thank you so much for joining us. Ms. Gupta, let me come to you first. We're hearing from Donald Trump, from the horse's mouth, that as far as capturing and regime change in Iran is concerned, he's looking to deploy forces. He's talking about taking over Karg Island. Karg Island, again, a key military economic outpost for Iran, controls 90% of their oil shipments. Donald Trump says, I want it. Is this a negotiating tactic that we're seeing, or these are actual war plans in action with troops being deployed in the region?
Good evening, Ashmit, and good evening to you all. Thanks for having me on the show. Well, I think I would like to begin with the conditions that the both sides have laid. If you look at those conditions, it is impossible to reconcile them. So what the one side is saying, the other side is saying something where there is no middle ground, so to say. So it is unthinkable right now as to what kind of talks are going on, because the conditions are so different from each other. The attacks are continuing, which basically suggests that both sides are determined to fight till they meet their objectives that they have set. And they don't seem to be backing out. President Trump has been changing his statements by the day. It could be a deliberate attempt, as many people say. It could also be a nervous response. I think that will become clear, I think, in next 3 to 4 days. That's my assessment. Iran definitely appears very well prepared for a long haul. And from the way they responded to the first strikes on the 28th of February, you know, the kind of preparation that they had in place for a symmetric war against a military superpower. And if I believe the inputs which are doing rounds, that Iran has already parked hundreds of millions of barrels of oil in the Chinese water in anticipation of a long haul, so as to keep earning revenue, that actually tells you how prepared Iran is. Whether they succeed or not, I'm not commenting on it. And secondly, they've managed to, hold on to the regime. Lastly, from Israeli point of view, it's a unique chance. I think in decades, Israel has got a chance to get US in combat against Iran directly. So it'll be difficult for Israel to let it go.
Sure. Ambassador Trigunath, again, similar question to you, that Donald Trump clearly saying, I want Karg Island, I want to deploy troops in the region. We're already seeing movement of US troops as far as the Persian Gulf is concerned. Again, is this merely a negotiating tactic, or is this the announcement of a broader war plan of escalation as far as this conflict is concerned?
You know, Ashmit, the thing is that if you look at what happened in June 2025 and what happened on February 28th, then the Iranians would be foolish enough not to take everything into account, which means even attempt to occupy Kharg Island. That will give them a strategic advantage. But whether it will be easy for them to take or to retain it is something I'm not quite sure. There are no doubt about 5 to 10,000 troops will be in the region, apart from their naval assets and the air power that they have. But at this moment, it appears that it is simply some kind of a pressure tactic to start with. And they are hoping, and now today, the statement that has come from Pakistan is that the direct talks between US and Iran are likely after the four countries, Egypt, Saudi Arabia, and Turkey, their foreign ministers met in Pakistan. So it appears that the efforts are going on simultaneously, but as is the wont of President Trump, I mean, he says something, he doesn't know whether he'll be able to carry it through. Then he jumps on to another dimension. He probably listens to half the things that his advisors would be telling him and then shoots off in that sense. So I think that while the Iranians, as Dr. Anju said, is fully prepared for the long haul to fight it out and fight to the finish, basically, for them. They have really nothing much to lose. So they'll just give it a very tough fight. They may not win the war, but they will make the victory for the Americans or the Israelis extremely prohibitively costly. And it'll be impossible for them to do anything after that. The whole region will come onto big fire. I mean, that is something that I think is America is also being pressured into that. In this whole game, the one, as I say, the joker in the pack is actually Israel. Even if the United States wants to have a deal, which it wanted even on 27th of February, the Israelis will not settle for it. They have been waiting for this time, and they want to also demolish as much as the strength and the power of the Islamic regime to the extent possible, so that they, at least in their own mindset, think that the threat of the Islamic regime is over. That's nowhere there at the moment as one sees it. So we'll have to see how it eventually plays out with President Trump. As I said, it's very, very difficult exactly which way he's going. Of course, all these countries, three of them, are facing a depletion of their firepower. That is also a fact. Now, the war can only stop with some kind of when there is sort of an equally negative dimension playing it out there. So I hope that President Trump, in his typical style, calls it a day, claims victory, and leaves the region to, do whatever it wants to do later.
Right. Mr. Yadav, coming to you again, Ambassador Trigunai, they're referring to Israel as the wild card. Now, over the last couple of days, we've seen reports of J.D. Vance expressing his displeasure at how Prime Minister Netanyahu may have oversold the Iran war. We've previously seen Donald Trump not being happy about South Pars, the energy facilities in Iran being struck without informing the United States. Are there cracks now emerging? Cracks owing to battle fatigue as far as this conflict is concerned between U.S. and Israel?
So I think we need to take a step back. I think first, to answer your question directly, I think the Israeli-U.S. alliance is fully working in concert with each other. While there might be divergent specific goals that both sides have in this larger conflict, I think the ultimate objectives are being directed fully forward by the U.S. president, and the Israelis will fully support that. I think Vice President Vance's concerns that were expressed in the call were more around the intelligence estimates or projections about how easily the regime could fall with a popular uprising in the country. But taking a step back, a lot of what I've just heard is a lot of the challenges that the U.S. side or the U.S. president and administration faces. But I think we also need to balance that with the challenges that the regime has in place right now in terms of what it faces. First off, with the U.S. president and the administration and the American-Israeli action, I think they are quite cohesively buying time and aligning all of their forces and options and optionality in the region to be ready to go, whether that's a total mass of 50,000 American forces in the region. Today we received confirmation that the Marine Expeditionary Force of 3,500 has arrived. So the 82nd Airborne is on their way. So I think what we're seeing is multiple options are on the table for the US president, whether that's seizing the uranium with a multi-day operation in Iran, whether that's seizing or Karg Island, whether that could
Mr. Yadav,
be
I'll just have to come in there. I'll just have to interject for the benefit of our viewers, the latest Truth Social post that has been put out by Donald Trump. It says, and I quote here, "The United States of America is in serious discussions with a new and more reasonable regime to end our military operations in Iran. Great progress has been made, but if for any reason a deal is not shortly reached, which it probably will be, and if Hormuz Strait is not opened immediately, we will conclude our lovely stay in Iran by blowing up and completely obliterating all their electric generating plants, oil wells, and Karg Island, and possibly all desalinization plants, which we have purposely not yet touched. This will be in retribution for our many soldiers and others that Iran has butchered and killed over the regime's 47-year reign of terror." Thank you for your attention, President Donald Trump. Ms. Gupta, let me come to you again. Like Mr. Yadav was pointing out, all options are currently on the table. Donald Trump says that should this deal not materialize shortly, the key word there being shortly, he's threatening an attack against all their energy facilities, against all their desalination plants. Have we seen now the next step of the escalation ladder? Ms. Gupta.
Definitely. It again looks like a very nervous response to avert a big battle, which he will have to undertake because situation has reached that level. Well, let's look at this. US and Israel entered this war with different goals. But what is that they got to see within few days is they ended up losing the freedom of navigation through the Strait of Hormuz. And their attacks on their bases in GCC and other, their allies, even beyond GCC, say as in on their base in Iraq. So the priority, to me, the number one priority for the US, I'm not talking about Israel, is to restore some kind of freedom of navigation through Hormuz. That, to me, appears to be the topmost goal. And your, what you read kind of corroborates that. And probably that is the reason why he himself, President Trump, and also lately Prime Minister Netanyahu have been stressing that, we've obliterated their nuclear threat, ballistic threats. He's given a very long explanation of why this is a regime change, because first level gone, second gone, third is very reasonable, and we are talking to them. So why are these claims being made? Because now the overarching goal is Strait of Hormuz. And there's a very strong anti-Iran lobby right now working in the US, and I'm not saying they're just Israelis. There's a very long history between these two countries. So my sense is that if President Trump doesn't get some kind of a deal based on this huge threat that he's just now issued, which is unlikely. To me, Iranians are not backing out. A big battle is coming, and it's coming sooner than later. Energy crisis will deepen. Other trade will also be affected. GCC-based businesses will be in far greater trouble. And if there's a reckless attack on nuclear sites, there is a scope for miscalculation in this no-holds-barred war that we are seeing right now, then many nations will face the risk of a nuclear fallout. So my sense is that the situation has been baked to this last point to an extent where it is difficult for President Trump to back out without some kind of a victory deal. Otherwise, we are in for a very big blow.
Right, Ms. Gupta, situations may get just worse from here. I'd like to request all of our panelists to stay on with us. We're heading into a very short break, but we'll continue this discussion on the other side. Welcome back to this special broadcast on West Asia War. I have with me former Ambassador Anil Trigunath, Strategic Geosecurity Analyst Ms. Anju Gupta, as well as Banyan Tree Global CEO Mr. Sanjeev Yadav. Thank you so much to all of our panelists for joining us. Ambassador Trigunath, let me come to you again. We've just heard from Donald Trump once again, on one hand, claiming that the talks are progressing well with what he calls is a quote-unquote reasonable regime. On the other hand, threatening the utter and total annihilation of all their civilian energy infrastructure, desalination plants. As a diplomat, how do you see this? Is this an indication of talks going well, or the talks perhaps not taking off, definitely, or maybe not as well as what Donald Trump would like it to believe?
Well, I think this is very typical of President Trump. You know, everything that he says, it comes up with a caveat and a very big threat. That's his typical style. Personally, I feel it means really nothing. I mean, he has been threatening all the time. At the same time, he is basically, in my view, looking for an off-ramp. How he can get out of here. Because, see, back home also, he's facing a lot of trouble. Out here, he does not have very much to really accept destruction to save home. And the West Asian countries, especially the Gulf countries, are in a big soup for themselves, basically, facing so much of a problem. Suppose, let us say, he says, I'm going to bomb everything. Now, have they ever estimated what is the power that the Iranians have? Do they know what happens which Houthi has just now come in? And Houthis and Americans in May last year had bought peace together. They could not overcome the Houthis, just that small challenge. Now, on the other side, the Hezbollah is fighting the Israelis. So everybody is going through a tremendous stress at the moment. So I feel that his first option is somehow to get some kind of a deal. Now, the Iranians are also being very difficult in this sense because they also want to have some kind of a guarantee. And asking for a guarantee from President Trump or from anybody is, I think, very naive. But that's precisely what they're looking for at the moment, one of the things that they will not be attacked yet again. Secondly, their conditions are pretty much similar to what the Americans want to have, but they're exactly the opposite. And so I hope that they find some kind of a way out. So first preference for President Trump definitely is this. Secondly, his threat that he's going to decimate. He has a firepower. There is no doubt about it. They have air dominance there. But despite the air dominance, for 1 month, the Iranians have not only been able to withstand that pressure, but at the same time have been able to respond in kind and with much vigor, I think, and continuous attacks on key installations. And I believe that they have not yet even come up with their hypersonic and other missiles. And they look at this. If Iranian, let us say, the desalination plants, the power plants, everything is decimated, do you think that what happens there in the neighborhood? I mean, those countries are dependent for 90% of their water requirements from the desalination plants. So we are looking at the whole region going into a very, very terrible state. I mean, is that what President Trump is looking for? Some people are talking he might even use nuclear weapon. The only country that has ever used nuclear weapon is the United States. So I think that just because there's no balance of power today in the global sense of the term, he is able to threaten and get away with that. But whether he's able to get away with this war, I doubt very much.
Right. Mr. Yadav, coming to you again, and this I want to focus on the choice of Pakistan as the mediator, possible talks in Islamabad, at least that's what their foreign minister seems to be alluding to. Some are questioning the choice of Pakistan as the mediator. Many point out that even when there were strikes being launched against Iran in June of 2025, President Donald Trump was also hosting General Asim Munir in Washington. That takes away, many say, from the credibility of Pakistan as a neutral mediator. Can Iran trust this process that is being hosted in Pakistan?
Well, I think we also need to note that there's two processes from reports going on. One are indirect back channel talks directly between the American negotiators and the Iranians and members of or factions within the regime. And then there's the organized talks that Pakistan and some of these other nations are leading. Pakistan's in a tight position because Pakistan has a military alliance with the Saudis. They obviously do not want to get drawn into this conflict if the Saudis choose to directly get involved and support the Americans. One, so they're incentivized to find some sort of off-ramp or pathway to peace or a deal here. Number two, the Pakistanis have had fairly strong conversations, it appears, with various forces within the regime and are enabling some sort of sharing of information and massaging in terms of the talks. But you know, Pakistan has a long history with Iran, good and bad. And I think Pakistan has to think about their immediate neighborhood first, and then the broader region, and balance that with their alliance with Saudi Arabia. So they're in a very difficult spot, and I think they are heavily incentivized to get some sort of deal in place here or ceasefire, because that really helps them both in the short term and long term. The question of whether they can be a neutral party, I think at the end of the day, the Iranians seem to have accepted them, or at least portions of the regime have accepted them. And there seems to have been some sort of comfortability and back channel conversations that have enabled that. But I think going forward, Pakistan is probably the right party, win or lose, whatever happens here. And it's a tough position for a country to be in, because if nothing proceeds here and we proceed with further conflict, there's nothing to gain really for Pakistan being put into that role. But I still think we need to see that the U.S. has put all options in its back pocket now in the region in terms of what they can do. And President Trump is controlling the media narrative, and he can define what is the off-ramp for the U.S. in terms of pulling out or moving forward with further conflict.
Right. Ms. Gupta, I'll come to you for one final comment that let's take what Donald Trump says on face value, that yes, talks are progressing well, that yes, both sides are being reasonable. Assuming that to be so, what does a minimum viable deal for both the sides look like to you?
Opening of Strait of Hormuz for everybody, and I'm sure it's going to come. If that were to happen, I see it highly unlikely. It's going to come with very severe conditions by Iran. That will be acceptable to Iran, and also to the US, because US also been talking about, President Trump has been talking about joint patrolling and joint control, something that Iran will not accept. So that could be one immediately. That is something, if it were to happen, will immediately calm down. At least can give President Trump a rough ramp for now. But that does not mean that Israel and Iran will stop fighting. That really doesn't mean. And if you recall, in June 2025, US just came in to attack the nuclear sites, and otherwise the war was between Israel and Iran. So that could continue with much greater ferocity. But I don't really see much chance of a deal at this stage. Doesn't look like.
So no signs of a deal. Ambassador Trigunath, just 30 seconds to you. Can you even visualize a common minimum viable deal between the two sides that are so diametrically opposed to each other? Do you see any resolution in sight?
Well, I think that the deal was almost there on the 27th of February. And that deal, as far as the nuclear dimension of this deal is concerned, that's almost there on the table. I mean, Iranians had agreed not to pursue the enrichment and hand over all the enriched material. What was the problem was the missile program. And therefore, the missiles, I think that this is possible to reach a deal, provided both sides do give due respect. But as I mentioned earlier, the US and Iran can agree to some kind of a deal, but Israel is not happy with it. So it is quite possible that you might have some kind of a false flag operations, or you might see direct hits on some desalination plants or power plants in Iran, and Iran will be forced to then use all its might against its neighbors and others.
Right, Ambassador. I'd like to thank all of our panelists. We've completely run out of time, but I'd like to thank all of our panelists for sharing their insights. But with that, it's a wrap on this special broadcast on West Asia War. More news and updates will continue right here on CNBC TV 18.
Hello and welcome. You're watching On the Record with me, Shireen Bhan. It's been 12 days since the abrupt exit of Atanu Chakrabarti as the chairman of HDFC Bank. In his resignation letter, Chakrabarti said, and I quote, "Certain happenings and practices within the bank that I've observed over the last 2 years are not in congruence with my personal values and ethics," unquote. The bank's board said it had no indication of the issues involved. Mr. Chakrabarti's resignation also prompted the RBI to issue a rare public statement to allay fears of customers and shareholders. The RBI says it has found no material concerns on record as regards the bank's conduct or governance. Since his exit, HDFC Bank stock has fallen about 13%, wiping out nearly 1.6 lakh crore rupees in market capitalization. Joining us now for his first interview since his resignation is Atanu Chakrabarti, the former chairman of HDFC Bank. Mr. Chakrabarti, many thanks for joining us here on CNBC TV 18. Let me start with the 18th of March, sir. That is when you decided to put in your papers. Now, abrupt, sudden, there's nothing routine, quote unquote, in your words. You call your resignation routine, but there's nothing routine in the manner in which the resignation happened and what transpired post that and what you said in your letter. If I could start by asking you, what prompted you to put in your papers? What was the trigger? What was the tipping point? What was the final nail in the coffin?
Well, permit me to first thank so much for having me on your show. It's always a pleasure being here. Let me tell you, there is a bit of a background to it. I joined the bank as a part-time chairman, which is also seen as a non-executive chairman. Both are very similar terms, similarly understood. And independent director on the board of HDFC Bank about 5 years back, slightly less than that. However, my name had been doing approval rounds with RBI before. So I had some opportunity to study the bank and felt that it needed to grow bigger and also improve its asset side. And so within a year, you had seen, and with the help of management and HDFC Limited, which was erstwhile promoter of the bank,
right,
that the bank went into a merger with its parent, which was one of the biggest mergers in the history of the bank. The very well executed merger as well, because, however, as always, there are small and bigger flaws, which always remains, but that is okay. It went off well, which also improved the asset side. However, I have written in my letter that there are, it has to fully fructified. I'll come to that later. Subsequently, the bank was also able to sell Credila, one of its companies, in a sense monetized it as per regulatory instructions. Subsequently, bank could also do the IPO of HDB Finance, one of the NBFCs under it, as per the regulatory guidelines laid down for the banks as well as for systemically important NBFCs.
Right.
These were all part of some of the actions on the business side, on the strategic actions during the time that I was in. Apart from setting up rather being a participant in, shall I correct myself, in setting up a good assurance setup under a very good teams who are able to do that, and also improve the governance structure. All those existed, but they needed better structuring and better flow of information to and fro between the committees themselves, and allow greater free-flowing discussions in the committees and the board, so that the issues are discussed, addressed, spoken to, and good informed decision-making takes place, in which every director, whether executive, non-executive, or independent, participated wholeheartedly, with varying degrees, naturally. So that was the background. And rest, as you asked my question that what happened? Well, my resignation letter needs to be read in its entirety. starting with the first paragraph, which I elaborated further. Then I have also told towards the end that I have great faith in the verve and energy of the middle level management. That's what I always look at. Senior level will move on, but the middle level is very important. And that was where I see a great amount of energy, verve. They need to be channelized. Now that is how.
If I may, sir, it doesn't answer my question because, as I pointed out, you specified that there was a period of 2 years that you observed certain practices and happenings that clearly made you uncomfortable, that eventually led you to put in your resignation letter. Were these matters discussed with the board in any form or fashion? Did you raise your discomfort at the board level over the past 2 years in any form or fashion? And perhaps if those were not then adequately met, was that the cause for your resignation? I'm still trying to understand, as is everybody else, why did you put in your papers on the 18th of March?
Leave aside 18th of March. It could have been 19th of March as well. So leave aside the date.
I'm only going with the date that you actually put in your papers.
Yeah, that's even a month later would have had as much speculation as this because of a bit of lack of understanding in the larger domain about the word of value and ethics both. Now, if you see, my first term was largely covered grappling with the issues arising out of merger, which was very large, disbalances balance sheet, so on and so forth, and also preparing for meeting the regulators' conditions. Not that things were not happening during that time. But if we largely see that what are independent directors charged with, they have onerous responsibilities with respect to upholding ethical standards, probity, integrity, ensuring that management performs adequately, shareholders' wealth is maximized. They also have fiduciary responsibility with respect to depositors, which means that value terms, there needs to be a very high level of values with respect to honesty, integrity, transparency, fairness, and accountability, which translates for customer. And that's very important because for me, customer is the God, and I guess should be. That's what Gandhiji said, is that there has to be a long-term relationship of loyalty with the customer, not transactional. There has to be avoidance of risky practices which puts customer or depositor or anybody else dealing with bank at risk. Also that the bank contributes to the stability of the economy, improves credit growth. These are few of the conduct issues, and all these onerous responsibility ensuring that also lies, or rather largely lies with the independent directors. Therefore, that largely is the background setting. But you wish to ask me something there.
You've said a lot of things there, Mr. Chakrabarti. Let me try and unpack them. You said risky practices. Now, if I may ask you, was the bank indulging in risky practices that made you uncomfortable? If yes, did you raise that particular issue or those particular issues at the level of the board with the management?
Normally, I do not share any boardroom discussion. So, Shirinji, here also, I would not have shared any, except for one matter, which has come to public light by an interview by the CEO of the bank itself. Otherwise, I would sort of apologizing for not elaborating further. But just to elaborate, and if that throws any light, in the interview with the ET, daytime, that's Economic Times, Mr. Jagdishan who has been the CEO of the bank for the last 5 years, with respect to the issues in Dubai, where the conduct issues with respect to customers, onboarding, and other things have been continuing from 2018, had come under both regulatory lens, both with international and domestic regulator. And they're all on record, so it's it's not that it's not known. And however, what he has said is that this was a technical lapse in documentation and regulatory interpretation. So it's seen as something technical. I feel if large number of customers are hurt, some amount of regulatory, or rather large amount of regulatory focus has come on the bank. It also brings reputational risk to the bank. Therefore, while the issues have been addressed, there has been involuntary separation of 3 senior management executives. That has been reported.
The termination, yes.
As well as 12 other people punished from major penalties to minor penalties. They are all at very senior levels. But they are a posteriori action. Something goes on for 8 years and suddenly we take an action. People will say that those are concerned, addressed, go home. Perhaps, and that's where I'll come to that. I feel that these conduct issues should not arise at the first place, or the supervision, tight supervision, should ensure that even if they arise, they are nipped in the bud. However, if they are termed as technical, it leaves a little bit of a leeway. Perhaps they are experienced people, their reading may be correct. That's why I have not used divergence, I've used the word incongruence with my value and ethics. My value and ethics are very different from that. It's not that I am talking about values in a very rarefied atmosphere, that I have already elaborated deliberately before that, and nobody will deny that they are not needed for a DSIB-like HDFC Bank, and I take pride in being part of the bank for all these years. And, but that is where the incongruence took place. There are many other matters, and apart from that, underperformance with respect to the share value not performing up to the mark, which meant that shareholders' wealth was not getting maximized. Also, CASA was low, and cost-to-income ratio was high. A lot of people say, in the bank also I heard that chatter that it is because of merger. No, merger, if anything, was the best thing that happened. CEO himself has also mentioned on record. I'm in complete agreement with him. And that really didn't distort the balance sheet. And if at all, some distortion should have got corrected. Therefore, both underperformance, which is important for maximizing share, is a part of duty of the independent director, which comes out of the values and the ethical standards which we independent directors are required to uphold. And I was an independent director. So that was my dilemma.
Mr. Chakrabarty, again,
I'm sorry for being voluble on this.
No. I'm glad that you are being voluble in explaining to us what may have led to your resignation. You're raising the 81 mis-selling issue as one of the issues where you believe the bank ought to have handled the matter differently. Now, was there something that you had raised at the level of the board prior to the actions that were taken? And do you believe that there are larger governance issues at HDFC Bank that require being addressed at this point in time? And is that a concern today for shareholders, for depositors of HDFC Bank?
Look, as a private citizen, as I have said that, you mentioned that certain practices, the board was seized of this matter at least recently since 2023 when regulator had raised a concern. Central bank had also raised, our own central bank had raised the issue way back in 2018 and subsequently always brought forth as and when the matters came up. So it's not that, as I said, there was a regulatory focus on this particular matter. I'm referring to this matter because others matter I don't wish to discuss unless they are in.
But there are other matters where you believe that supervisory oversight should have been better.
And of the bank?
Yes.
The
management.
I guess that's where we have, I wish to clarify things further. Apart from supervisory oversight, that is a matter of a posteriori conduct. There has to be a priori conduct also, because bank keep people's money. Bank advise people. If I'm taking advice, I need a priori, that is before occurrence of an event. Ideally, event should not occur. I'm not saying that in a large system like this, events will not occur. They occur world over. However, the incentive structures, the oversight of the management and the board should ensure that they are aligned with the interest of depositors, shareholders, and public at large. And that's a belief system which translates into ethics and conduct. So it is not that action has been taken. What more I can say in this? Action has been taken. I'm sure there would be remediation action. But we don't dig wells after the fire is there. It causes reputation loss. Why should it cause at the first place? But that's with respect to bank. What about the faith and belief of so many other people? I'm not saying that people are not concerned about it. I'm sure each director, each senior manager of the bank is concerned about it. However, the level, somebody has calls it technical, I feel they are serious, should be nipped in the bud. They feel it's once in a kind of misinterpretation which has possibly caused it. I possibly feel that where was the value in interpreting this thing? So there are incongruences in thinking. And I felt that if there's an incongruence, one lives in a dilemma. I have referred to 2 years as a broad time framework. Don't read too much into it, but as a broad time frame during which my observance has taken place. Beyond that takes me down the memory lane, which may be a bit hard to recollect. But having said that, this incongruence only puts an individual in a dilemma. And as an independent director, and I'm very democratic in the process, and in any case, there's no way I would like to impose my will on others. If I feel that it doesn't match with the way I think I should.
So let me put this plainly, Mr. Chakrabarty. When you talk about ethics and values, you talk about governance, right? Because you've also brought up performance-related issues. Now, performance-related issues, underperformance can be another matter entirely, can be assessed and evaluated entirely. That doesn't necessarily have to do with concerns on ethics. So you're raising two concerns. You're raising governance concerns and you're raising performance concerns.
Very interesting question you asked me. Well, ethic and conduct, they go together. They encompass the entire governance, the corporate governance issues within them, which inter alia. After all, why bank is set up? It's meant to be for shareholders and depositors and other stakeholders. Schedule 4 of companies law is very clear about it. Therefore, when I mention these issues, they are actually encompassing the entire thing within the four corners of the company law and Banking Regulation Act, which also provides for superintendence, control and direction of the managing director, which means the entire senior management for the board. And I feel as a chairperson, if my value and ethics, and I'm at pains to explain, is not incongruence. I'll time and again use this geometric term, which I learned in my childhood. With those standards which I want and what are set in the bank, and which people may rightly feel that they're not matching with the commercial requirement of the day, I should move on.
You know, you talk about this being a dilemma for you. Did you raise this in any form or fashion, formally or informally, with the regulator? And I say this in the context of the fact that on the very same day, in a very unusual move, we actually had the Reserve Bank coming out and saying there is no concern with HDFC Bank, that there have been assessments and reviews done periodically, and coming out in support of the competence of the management. A, did the RBI statement surprise you? B, did you have any conversation, informally or formally, with the Reserve Bank of India with some of the issues that you believed that you were uncomfortable with?
With RBI as well as with other regulators, as I mentioned initially, during the merger, it was more intense. Subsequently also, I'd been interacting with them, both informally and formally. Formal occasions are few during the course of the year. Informal occasions are many. However, those discussions are privy between me and the regulator. Frankly, I would not like to discuss that. You will appreciate
Fair enough. But if you could at least confirm to us whether you did, with the regulator, raise some of your discomforts. I won't ask you for the specifics, but did you formally or informally raise?
As I said, large number of issues, various issues do get discussed, and it will not be fair to the other person, and those are, many discussions are informal in nature. It will not be fair.
Did you have formal or informal conversations with the government about any matters related to your discomfort or any specific issues with respect to HDFC Bank?
I think the role of non-executive chair ends with the regulator. Most of the issues, unless there are very broad policy issues, structural issues, which once in a while I met once in a year or something. But no, not nitty-gritty of it. That's, I don't think.
Did the incongruence that you speak of lead to differences in the way that you believe the bank was being run by the management? Did you have run-ins, differences of opinion with the management over some of these issues? Because it's also being viewed as a fallout, as a personal clash between you and the management.
I've seen some amount of chatter on that. So differences should be there in running a very large institution. I myself have always, as a chairperson of the board, whether here or anywhere else, have promoted a lot of dissent, so that the voices are ultimately harmonization, so that people come around to a particular point of view, which should go through, because institutions have to run and do their business as well. They can't be stalled, but various point of views need to be discussed, brought forth, analyzed if need be, and brought forth. And that's the structure of governance I was earlier talking to you about. It formed a very important part of it. So during that course, differences would be there, not only with, would be expressed, people would express a different view, vice versa. With everybody else, it could be there. And as a chairperson, it's also my role to bring all the differences as much as possible within a certain boundary. Therefore, I don't think personality differences are generally played up as a causing factor because people feel that I don't even live in Mumbai. I barely travel 3 to 4 days. I think that is overblown.
It's overblown.
Yeah.
But it wasn't the determining factor for your resignation.
No, not at all. Not at all. Not at all. Actually, not by a long distance.
Not by a long distance. And there's been a lot of rumors.
I hold all the directors who worked with me in very high esteem.
There's been a lot of rumors, so let me get you to address some of those. The reappointment of Mr. Jagdishan as CEO. Were you opposed to the reappointment? Of course, that reappointment process is still work in progress, and the name of the reappointment hasn't been sent to the Reserve Bank of India, is what we're given to understand just yet. But were you opposed to his reappointment?
Just to clarify and kill the speculation on that front. The matter of his reappointment, ideally, the process is it should be first discussed in the NRC, that's a Nomination and Remuneration Committee of the board, and then comes to the board, in which both the chairperson is just a member. It hadn't even come there along with the full documentation and a third-party agency who would look into the issues, does the full analysis and performance and so on and so forth. So something which was not even discussed, how could differences be there?
So you had no objection to his reappointment?
No, objection or even having a view, the situation had not arisen. So, how do I, if I say that I had objection or no objection, which means a priori view without facts and figures. It was not, if something doesn't come up as an agenda item, why should I have an opinion at that point without reading about it? It's very important if on the board of any bank or that matter, any organization, that you should examine all the facts and everything. And as of today, why should I have an opinion? I am out of the bank and have nothing to do with it, apart from being a customer with sizable relationship value with the bank.
And again, I go back to more specific issues. HDB Financial Services and MUFG, a deal that was apparently being stitched together, and a deal that didn't have your blessings, didn't have your support, and which is why it fell through.
Well, as an independent director, I guess, and a part-time chairman, too much of attention is being drawn to the chairperson. Is at the end of it, no paper comes to the chairperson. He or she does not take any independent decisions. Apart from that, I personally was living in Delhi, as I just mentioned. I ensured that I do not interact with major shareholders directly or clients directly. I rarely sent forwarded any proposal other than somebody came. I said, go and meet those people, and ended there. Idea was to avoid any impression that I was trying to influence decision making. I've been very careful, knowing that these organizations are very sensitive. Therefore, my blessings, they, since you use the word, do not matter till I speak my mind on the board or committee if it's needed. However, now coming to the specific, HDB Finance was promoted by the bank before the merger, and RBI had desired that by September or October 2025 it should have an IPO. So it was to meet that requirement that IPO was carried out, and under Shri K.K. Mistry ji, who was a director on the board and a very well-known person with great reputation. He headed the committee with 3 other independent as well as whole-time directors, and was cleared by the board for going to the IPO. Rest was overseen by this committee. So where do I figure, apart from saying yes to whatever recommendation which seemed absolutely logical and in keeping with the regulatory requirement also. So where anything else comes up.
Let me go back then to the nub of the matter, because as you said that it is on the matters of values and ethics that you chose to step away from the bank, even though you had little more than a year left to go for your tenure to conclude. At this point in time, do you believe, and straightforward question, do you believe that there are deficiencies in the governance structure at HDFC Bank?
Which institution doesn't have deficiencies? If you ask a very absolute, so you are asking question on absolutes. In absolute term, for any institution, there would be deficiencies which have to be regularly corrected. I'm not looking at defects. I do not wish to value judge conduct of an organization beyond what during my currency there. So I'll, as a bad penny, keep coming back to this issue of incongruence. I'm sorry about that, but I guess I must impress upon why I did it, because, as you said, there's some amount of controversy around that. Again, controversy, I'm using
ambiguity, because people are still unclear as to what led to your resignation and whether the issues that led to your resignation are issues that shareholders and customers and the regulator should be concerned about, worried about. The regulator at this point in time seems to suggest no, which is why it comes back to then what were the points and the specific issues that you were raising.
Regulator takes its decisions, gives a judgment on the basis of the data and everything provided to it. And I have absolutely no quarrel. I'm very happy with that. And one of the words that is well capitalized, I completely agree with the regulator on that. It's a sound institution. However, a sound institution has to become even more sound. As I said, that if value and ethics cause ambiguity, then I guess I'm a bit pained, so as to say, because events don't describe even ethics and the standard of ethics. If you look at the law itself, and I'm now taking down you to the law itself, the first line in Schedule 4, when it talks about the responsibilities, upholding ethical standards, probity and integrity. No, they are not attaching, they are not putting down parameters, 5 points for this, 6 points for this. You have to judge on the basis of the values that you feel organization should have. They regularly discussed across, spoken to, I guess, directors, if they do not, and they did, and everybody forms their own opinion based upon that. And I have never said that X is wrong, Y is right, or I am right, they are wrong. My only point was that it was not congruent with my own standard.
And I go back again.
I'm sorry, you may be exasperated.
Values can still be subjective. But in the context of any organization, and especially in the context of a financial institution, there can be no debate on ethics. And which is why I come back to ask you, and I think that is the question that's being asked by others, including, of course, the market, is that if you had concerns with governance, then should you not have been more explicit? Should you not have been more specific? Should you not have given a clearer picture and a clearer view as to why you chose to walk away from the chairmanship?
Well, I guess amount of churn which this has generated, a lot of independent directors in future would refrain. Not so many questions have been asked to the bank on this matter, and once the clarifications from them have come, as much has been questions have been thrown at me for resigning, for saying something about two terms which are extremely important. You said values can be are subjective. No, they are not.
No, I said they can be, but there can be absolutely no debate on what ethics.
Now, even on values, if honesty and integrity are valued, transparency is valued, you can say the level of transparency varies because there are practical considerations. I appreciate it. Some people would turn out to be dishonest, but once, what level do we take those? Conduct is driven from that. And conduct and ethics are very interwoven. They're very intertwined. As I mentioned.
So then how is this not material, sir? Because then
it is material.
It is material because in your letter then you go on.
Otherwise
say,
I won't.
Because
I won't move away. It is material, but the materiality of it could vary, as I think was my standard, was maybe different than what the prevailing standard. I would only say the prevailing standard. Then it's better to move away without placing blame, but leaving a door open for introspection for the board. And board introspects, they feel all is well, I'm a happy person.
questions have been raised about the fact that you have been remiss in your fiduciary responsibility that you ought to have, and the SEBI chief also on record stating that independent directors, if they're insinuating, then should back that up with the requisite evidence. How do you respond to that? Because I come back again to the value erosion, the wealth erosion that has happened since the time that you put in your resignation. We've asked questions of the bank. The bank says, we don't know. We're as shocked and surprised as everybody else. Now, that leaves the customer and the shareholder wondering what exactly is going on.
Shirinji, that's an excellent question. I guess you have brought around the entire debate, and let me conclude that part of the debate. A value erosion on share price of the bank had been falling for various reasons even before that. And if you see on that given day, my choice was not that Iran would drop a missile on Ras Laffan, and also Khadak or Paris Island were attacked the same day. Also Fed had some decision which was not in keeping with general expectation. Sensex next day tanked by about 2,500 points or more. And BFSI sector being 40% of the economy and bank having some amount of weightage, a rolling effect does take place on the bank shares. To that, perhaps my resignation also added a little bit. After all, people come and people go. If I was thrown under a bus, would that kind of
no, the point is that you threw them under the bus, that you've thrown the management under the bus.
Now the part that value erosion took place, I guess, is on account of resignation, is wrongly portrayed, and I completely refute that. Now, second, people say that insinuation. I'm particularly now addressing, where is the insinuation? I have said it's not incongruence. People need to understand the meaning of incongruence. I've been at pain to. I have not said anybody is wrong or anybody is right. I have not pointed out any. And even today's discussion, I have only referred to what is in the public domain, what the regulator has said. So if somebody has bothered to use the word insinuation, they need to read the dictionary themselves. I'm sure, people wouldn't have, but there's no insinuation made in my letter, as I read it very correctly, and plain English, I think there is none whatsoever. I hate to make insinuation. That doesn't keep with my own values and ethics. Third, I'll come back to the final issue of what were your concerns. I had mentioned that all the concerns are, if you're addressing concern, is a posteriori. It is like a 5-page audit and you answer them. Why those things should arise at the first place? What is the root cause? How would ensure it never occurs? Rest otherwise becomes ticking the boxes. So I'm saying improve the thinking level of value level, root your ethics and value. Perhaps they feel it's done. I'm not saying that they're wrong or the thinking is overall wrong, but I find it very strange, the debate around value and ethics, when people should be discussing these issues, what is value, what is ethics, or rather asking what is your concern? Describe your concern through on value and ethics. I guess people need a primer on value.
If I may, do you believe that there was malign neglect or benign neglect?
As I said, my saying any of these things would amount to an insinuation. So I'll refrain from commenting.
Two law firms have now been appointed to look into this matter, so to speak, to assess, the governance structures, I would imagine, and the fallout of your resignation. Have you been in touch with anybody? Have they reached out to you in any form or fashion? And what do you make of this appointment?
Well, ideally, I shouldn't be concerned, but I read that in newspaper also. Otherwise, I'm devoting most of my time on reading the sports page of the newspaper these days. However, appointing a lawyer is more of a compliance requirement. Perhaps that may be an input that the board of the bank may be seeking. But what I mentioned, resignation is more a larger governance and governance plus kind of an issue, which the board of directors of the bank themselves should be introspecting and doing. No external lawyers would do that for them, apart from pointing out this meets the law, which doesn't meet the law, with a very strong four corners, or it met this audit para and it didn't meet that audit para. I don't know. That's not how things go. Lawyers could be appointed. I have nothing. I have no comment on to make on that. But that's essentially a compliance requirement which the board of the bank may have sought.
I come back again, Mr. Chakrabarty. You said in your words, this is a governance plus issue. Now, when you talk about a governance plus issue, as the chairman of the board, did you bring some of these governance plus issues to the notice of the board? Did you make them an agenda that the board needed to discuss, as you said, so that you don't act post-event, but you act pre-event and ensure that you don't follow the same pattern, in your words, that has perhaps transpired in many of these
Excellent question again, Shirinji. But kindly permit me to say this. Whatever has been discussed in boardroom, for me, remains in the boardroom unless brought by somebody into the public glare. I have discussed one issue to describe something, to say that how the differing conduct issues or ethical issues, the standards differ, and they may be correct standards on both sides. I may also be correct, they may also be correct. It's just an incongruence. And both of them may be meeting the requirement of the law at a given point. So that's not an issue. However, all that has been discussed, whatever has been discussed in the boardroom, I will not like to reveal at this stage by myself unless they come in public.
Let me end by asking you, Mr. Chakrabarty, do you regret having written this letter?
No. Why should I? Do you have any reason to ask me that question?
No, because again, I go back to the point that there are questions being raised, and some with some legitimacy, that you should have been more explicit if you were making a very sort of significant material statement, that there should have been some explicit time given by you to explain what you meant when you talk about governance as well as performance related issues.
I guess materiality or issues, they are subordinate to the larger matter that I mentioned, and what I mentioned was internal to me. As I had told you, that it caused dilemma for me. Whether it causes for the bank, its board has to address that. If it causes dilemma to me and I find it difficult to live with, I should move on. They feel it's okay, let it be done. So I guess for me, that's where the entire thing ends, because I've got over with my dilemma that, as I've explained to you, tried to explain to you at length. I don't know how clear I have been. However, the demand for certain amount of evidence to go with value and ethics, I guess we will enter into a very philosophical debate, which is better avoided for the given course of time. So maybe a separate primer with somebody else who understands these issues much better But as an individual who wanted to live with certain code, I feel that is how it is. And if the bank feels out there, and I'm not saying they have been wrong or anything. So that's no insinuation even intended or no malice intended. Let me put it this way, malice is intent. Insinuation is more material. So no. The rest, materiality and everything are very subordinate issues. And again, as I said, a posteriori.
So you believe that there is cause for concern for shareholders, depositors, customers, or do you believe that that the structure, practices are in place, and perhaps every large organization goes through some degree of pain and some degree of negligence, and it is manageable?
I would not like to comment on that part since I'm not with the bank. It would be unfair of me to comment and assure the shareholders of something for which perhaps now I don't have visibility or responsibility.
Mr. Chakrabarty, thank you very much for joining us here on CNBC TV 18, for giving us an understanding of what transpired and what led to your decision to resign ahead of your tenure ending at HDFC Bank, and why you believe that it's an incongruence of values and ethics that you spoke of, and explaining to us the dilemma that led you to make the decision that you eventually did. But appreciate you joining us here on CNBC TV 18.
Thanks to be on your show. It was a pleasure.
Thank you. With that, it is time for us to wrap up this edition of On the Record. From all of us here on the team, goodbye. Thanks for watching.
Hello and welcome to Startup Street. I'm Ritu Singh and with me is Arundhati Ramanan, and here are the key headlines from the startup space. Furniture and appliance rental platform Rento Mojo has filed its DRHP with SEBI for an IPO, which includes 150 crore rupees fresh issue along with an OFS, with early investors like Accel pairing stake.
Space tech startup Bellatrix raises $20 million from Cactus Partners in a pre-Series B funding round led by Cactus Partners as it looks to scale up manufacturing and delivery of its propulsion systems. The funds would be used to expand manufacturing capacity to meet rising demand from satellite constellations in India and abroad.
Agri-tech startup CropCoin Technologies raises 12 crore rupees in a pre-Series A led by Unicorn India Ventures and Climate Angels. They're set to close the year at 10 crore rupees ARR while maintaining minimum burn.
Epic, a try and buy quick commerce startup, Focused has raised $1 million in a pre-seed funding round led by InfoEdge Ventures. Currently fully operational in Bengaluru since October 2025, the company said it has scaled nearly 20x since its launch with zero platform returns.
Epic Games is facing criticism after its 1,000-person layoff left a terminally ill employees without life insurance. The staffer's wife took to social media to highlight the human cost of restructuring, prompting CEO Tim Sweeney to personally intervene.
Those were the headlines that we're tracking for you this evening. But on what's brewing today, furniture and appliance rental platform Rento Mojo has filed its draft papers with SEBI to launch its IPO with a 150 crore rupee fresh issue and an offer for sale by early investors. However, the listing faces a legal hurdle with co-founder Ajay Nain moving the NCLT to halt the IPO over a dispute related to his stake sale. Aishwarya Anand joins us now with all of those details. Aishwarya?
Rento Mojo has filed its DRHP with SEBI, setting the stage for its public market debut. And notably, this is a relatively measured IPO compared to the last cycle. The fresh issue is pegged at around 150 crore rupees, while a significant portion of the offer is an exit for early investors like Accel and Sharate Ventures. Proceeds will be used for debt repayment, lease expenses, and general corporate purposes. However, there is a clear legal overhang. Co-founder and former CEO Ajay Nain has moved the NCLT seeking to halt the IPO, alleging mismanagement and irregularities in share transactions. He claims he was misled into selling his nearly 9.4% stake in 2023 to the company's employee benefit trust and has sought to have that transaction declared void and his stake restored. He has also sought removal of the promoter from the board, curbs on management powers, and has named the company, its promoter, directors, CFO, and the employee trust as respondents. Now, from a business standpoint, Rento Mojo is betting on subscription-led consumption, particularly in urban markets. It has scaled to over 2 lakh subscribers across 20-plus cities with occupancy levels above 80%, a key metric for a rental-led model. Financially, the company has turned profitable with revenue of over 260 crore rupees in the last financial year, reflecting a broader shift towards capital efficiency. So while the IPO itself is not very large, it will be closely tracked both for how the legal challenge evolves and whether subscription-led capital-efficient businesses can find traction in the public markets.
Thanks, Aishwarya. Now, moving on, global VC firm QED Investors is putting $250 to $300 million in India over the next 2 fund generations. Their India Field notes say AI spend in the Indian financial services is going to double this year. They flag 3 specific investable categories and make the case that India has moved from a market of promises to a market of consequences. Co-founder Nigel Morris is with us now to break it all down. Nigel, always a pleasure to have you back. 250 to 300 million in India in the next 2 fund generations. Break down the opportunity for us. Where will you be putting the money?
We're really excited about India, and it's lovely to be back. I think we talked last a full year ago. Yeah, I think we see the opportunities in embedded finance. We see it in wealth management. We see it in artificial intelligence, which is sweeping across fintech. We're very long on India. There's so much to be excited about. We've made 8 investments now over the last 5 years and have really lent into this market, learned a lot, and we just see tremendous opportunity.
Yeah, well, you interestingly say India has moved from being a market of promises to a market of consequences. Interesting statement there. What really changed for you to say that, and why did it take this long?
Well, we've invested in Jupiter and OneCard and Refine and Upswing. These are companies that I'm meeting now over these next few days, and they're all doing incredibly well. So, 5-6 years ago, there was a lot of promise that was India, but there was a lot of things that were speculative at the same time. And we've seen these companies get product market fit. We've seen them establish business models with unit economics that make sense. And now we're seeing them scale at a very productive rate. So, for us, India has come of age, and we're excited about continuing to lean in.
Well, you've identified 3 specific investable categories: fraud risk, agentic compliance, and voice AI for BFSI. Why these 3 specifically, and which one would you say has the most asymmetric upside?
Well, we're trading them all off against each other. And of course, there's a lot more than just the vertical that goes into making a decision about making an investment. We want to understand the management team. We want to understand the nature of the investment that we're making. But, we just, I think there's so much wealth being amassed amongst the upper echelons of Indian society. We see that. We see so much talent here on the ground with the IITs and the IIMs, and now India really being of consequence in artificial intelligence. And we see just so much opportunity for the people who have not yet really embraced a broad range of financial services to join the party. So I think all of them have great interests for us. We also see embedded finance, where we see how insurance and payments and lending can be bolted on the side of an existing business that is becoming increasingly digitalized.
Well, Nigel, you describe India as a layered opportunity. You say the top 5 to 10% is comparable to a middle-income country. I mean, does that mean the next billion is still uninvestable for QED, or are you finding models that only work at that layer?
Well, I think the big focus has to be where the combination of the size of the market and the potential revenue per customer. And we see that upper echelon being 140 million in population, with income between $10,000 and $20,000. And that's growing all the time. That is the primary focus. But clearly there's a whole cohort behind that's graduating every single day. We just look at how much retail money is coming into the Indian stock market. So I think there's just as India rides this wave of 6% growth, notwithstanding some of the issues we're dealing with over the last month, it's hard not to be long on how big these different segments can be.
All right, Nigel, we were short on time. Thanks for making it almost like a rapid fire. Always a pleasure to have you here, and hope to speak to you again very soon. Thanks very much.
See you again. Bye-bye.
And moving on, India's cybersecurity story is scaling rapidly on the global stage. Tax security has crossed a major milestone, surpassing 10,000 clients across more than 100 countries, putting it among the top vulnerability management players worldwide. Now, this scale is not just about numbers, but also about building a global distribution engine in a sector where trust and access are key. With a strong client base and a wide product suite spanning AppSec, compliance, and Web3 security, the company is now looking to deepen monetization and drive its next phase of growth. Joining us now to discuss this further is Trishneet Arora, the founder and CEO of Tax Security. Trishneet, thank you so much for taking time out and being here with us on Startup Street. From founding Tax Security to crossing 10,000 clients globally, what have sort of been the defining inflection points along the way? If you could take us through this growth story that you've seen.
I always pleasure to be on your show on CNBC. So earlier we started with the enterprise solution here in India, but we really see the real growth in the cybersecurity. Today, cybersecurity is $200 billion global market, and India is just less than $2 billion, right? So we are focusing on the global market, and making cybersecurity affordable was our plan since 2 years. We went public in 2024 in India, being a first cybersecurity company went public. So we made a choice that we will make cybersecurity affordable for everyone, right? So that's what exactly the growth journey here is, and making cybersecurity affordable where other peer companies charge $100,000 for the same activity, we charge less than $1,000, right? So that's what exactly the approach we followed, which Microsoft did in the past in very early age, right? Making PC affordable. So we are making cybersecurity affordable. So that's what the approach is, and that's the growth position we followed.
Yeah, we're running out of time, so if you could quickly tell us your portfolio spans AppSec, vulnerability management, compliance, and Web3 security, right? So which of these segments do you see driving the next phase of growth for you, where you can increase that clientele to from over this 10,000 figure that you have?
Absolutely, that's the next 5 years goal, 2030 bold vision. Increasing this client base, retaining this client base, upselling to this client base. Today, for example, if the revenue per client is $1,000, by 2030, our vision is to make it $10,000 per customer. Will increase the growth of the client the same way, but for the larger, I think the play would happen through the SOC to SOCify solution that we launched 6 months back. That will play the major role in next 2 years growth, and which has a large ticket size and would add a lot of value to us. So we'll remain the both, increasing the customer base in AppSec, which today we have 10,000. We achieved that milestone that we announced in 2024. So we achieved that milestone, the target, and way forward, I think SOCify next 2 years would be hot thing for us.
Sure, and with AI sort of reshaping cybersecurity, right? How are you integrating AI into your platform, and what edge does that give you over competitors?
Absolutely, that's a growth story here. We are using the AI since 2018, not since it's become hot thing last 2 years, but we are using AI automation since 2018. We built a solution. We took 4-5 years. We spent a lot of capital expenditure on it, which we leveraged. And over AI, we are also using the human intelligence, right? We are not cut down the human intelligence, but we made the process very affordable, so that people can use it through our solution by AI automation and along with the human intelligence, right? Yeah. So today, out of 10,000, I would say half of the AI companies are our customer, right? So every second company globally in 100 countries, if they go through a security assessment, which is application security assessment, so out of every second company, it's tax customer today, right? And big names also follows in it, like Apple, Microsoft, Salesforce, SAP, Autodesk, Nissan Motors. All big names also follows along with it.
Absolutely. And you have this $100 million ARR target by 2030, right? Are you on the path to achieve that in 10 seconds, if you can tell us?
100%. We will, I think, make it before even the target. And it's a very, a clear path for us, increasing per customer revenue by launching a new solution or acquisition of new solution or building in-house. We are also not only targeting 100 million ARR by 2030, but we're also targeting capital expenditure on AI and cybersecurity, approximately the same value of $100 million.
All right. So hopefully you're going to achieve that before the targeted time. All right, Trishni, thank you so much for taking time out and being here with us on Startup Street.
Okay, and we'll slip into a short break on that note. But up next, 10-minute food delivery app Swish is back $38 million. We put the founder on the hot seat when we return.
Welcome back. You're still with us on Startup Street. Crypto exchange CoinDCX co-founders are out on bail after they were detained by Thane police over an alleged fraud case involving a Thane-based investor. Rachna Dhanrajani is here with all of the details on the case. Rachna?
Well, CoinDCX is calling it a case of mistaken identity after its co-founders spent nearly 72 hours in custody over a fraud they say they had no link to. Sumit Gupta and Neeraj Khandelwal were detained by Thane police on March 21 and produced before a magistrate court who remanded them to custody till March 23. On March 24, the court granted them bail, observing that no prima facie case was made out, which means no case on the face of it. But the case stems from a 65 lakh rupee fraud complaint filed by a Thane-based investor who alleged he was offered a Maharashtra franchise for a website called CoinDCX.pro, along with promised monthly returns of 10 to 12%. The deal was pitched by individuals claiming to be associated with the company and posing as founders of CoinDCX. Now, CoinDCX's defense has been categorical. The company says the founders were never a part of these meetings and that the fraud was carried out by the impersonator using a fake website and its brand identity. In court, the complainant stated that he did not know the founders and had recovered the money from another accused. But the company has also flagged the scale of this problem, saying it reported over 1,200 fake websites to CERT in between April 2024 and January 2026. In response, the company has now announced a 100 crore rupee digital Suraksha network aimed at fraud detection, user awareness and closer coordination with law enforcement as investigation continues and the key accused remains absconding. This fund is aimed to protect others from such a fraud.
Interesting development there, Rachna. Thanks very much for taking us through that. Now, in our hot seat today, Bengaluru-based food tech company Swish, they've secured $58 million in a Series B funding that was led by Hara Global and Bain Capital Ventures with participation from others. Now, this is their third fundraise in 18 months, and it is going to enable them to strengthen the team, accelerate expansion across cities, and invest in supply chain infrastructure. Let me invite Aniket Shah, the CEO and co-founder of Swish, for more on their growth path. And my colleague Arundhati is also with us. Aniket, 3 fundraisers, 18 months, that's aggressive. Are you raising because the opportunity is outpacing your ability to self-fund growth, or is this a land grab moment?
Thank you so much for having me. First of all, I think it just sort of demonstrates overwhelming demand that we've gotten for our 10-minute fresh food offering. And it's sort of driven by increasing customer affinity to order for meal times like lunch and dinner also, beyond just impulsive use cases like snacks and beverages with which we initially started.
All right, you know, the 10-minute promise, Aniket, is the core of your brand, right? But it's sort of an operational constraint. So as you go multi-city, how do you sort of protect that promise without the unit economics falling apart?
Yeah, I think we essentially have built a fundamentally novel infrastructure, which is like an end-to-end food tech model that we own the kitchen, we make the food, we operate the consumer ordering application, and we deliver only in an average radius of 1 kilometer from every kitchen that we serve. So as there are no third-party commissions or unit economics challenges, we essentially ensure that the economics stay inside the business and are reinvested directly into food quality, customer experience, and innovation.
But Aniket, the very fact that you own all of this, your kitchen, tech, last mile, etc., there are no third parties. What does that do to your cost structure, and where do you stand currently on profitability?
Yeah, I think, as I said, I think food is a category where gross margins are really high, unlike other categories. So we are essentially able to make that full supply chain economics work because of the gross margins that we have. And this is something that we have been able to prove as well. So our oldest set of kitchens are already profitable. And as we sort of get density in the newer micro markets also that we go live in, we are going to turn them profitable as well.
All right, and speaking about that, right, Zomato and Swiggy have distribution, they have brand, they have deep pockets. Zepto and Blinkit are already moving into food. You're essentially taking on the entire quick commerce and food delivery establishment simultaneously. So what's the moat that sort of keeps the incumbents from simply replicating your model?
I think, as I said, I think we're essentially building like a new infrastructure all along. So it is not a copy-paste of what already has been built in the industry. We build an end-to-end food tech model that involves setting up our kitchens, which are highly optimized to reduce prep times across all the kitchens while making fresh food in a very constrained, tight timeline. we ensure that we also operate the consumer ordering application and deliver in a very small radius so that we are able to pass on the benefit of quality, speed, price, everything to the consumer, and essentially able to differentiate massively because of building that fresh food supply chain from grounds up.
Okay, so Aniket, finally, given you started with coffee, snacks, and now you're going on to breakfast, lunch, dinner, festive specials, that's quite the expansion. Is there a risk in that in doing all of this, you risk you dilute your core 10-minute promise?
No, I think this is fundamental to like any sort of commerce. I think consumers will always want more variety, faster speed, better quality, lower prices and all of that. I think we're just figuring out ways to ensure that we are able to offer more variety of food to consumers while ensuring the 10-minute promise. So everything that you just mentioned, I think we're able to sort of prepare and deliver to consumers in a very small time frame, making sure that they get the delight of high quality food in 10 minutes.
So currently, you're clocking this 20,000 daily orders, and it's quite a strong number for Bangalore. But, when it comes to other markets like Chennai, Delhi, and Bombay, they're very different. So what gives you the confidence that this model travels well? And what other markets are you looking at?
Yeah, I think we're going to expand in all of these cities very soon. We're going live with the next city in a week or so. So I think the expansion is quite rapidly planned going forward. I think we just essentially want to ensure that we are able to offer the quality of food and the variety of food that people in every micro market are essentially looking for. So we go and understand what categories of food really work well in every city and ensure that we are able to sort of launch them very quickly. In Bangalore itself, where we started with like about 25 SKUs only when we started the company, now we serve over 200 SKUs. Different SKUs across different micro markets in Bangalore as well. So we are pretty confident on our ability to prepare variety of food in different micro markets and cities and serve them well.
All right, Aniket, and we will be tracking that closely. Thanks very much for your time here today on Startup Street. And on that note, we're going to wrap up this edition of the show, but more news and updates will continue on the other side, so stay tuned.
Hello and welcome to another edition of the CNBC TV 18 Market Town Hall. The amount of headlines and consequently the market moves have truly been head-spinning and dizzying to say the least. To be sure, the Middle East conflict is only the latest in a series of massive disruptions which I'm referring to now. Since January of 2025, when President Trump took charge in the White House as the President of the United States, we've had non-stop run-through of news flow, which dwarfs pretty much anything else we've seen, at least I remember in the past many years or so. So it's truly been historic. Headline roulette, you can call it, or whatever else, but absolutely head-spinning amount of news flow. And of course, it's had an impact on markets as well. From tariffs to AI to now Iran, all this has meant that markets have indeed corrected quite a lot. I mean, some because they need to correct, and of course, I mean, there's been a fair bit of indiscriminate selling, forced selling, etc. as well. And that is what this town hall is really all about.
Well, there is the micro and then there is the macro. So what we've done is we've divided this into three parts. First, we'll focus on the global macros and oil prices. Art Berman, who is an oil market veteran, and Ben Powell, who's here with us in the studio from BlackRock, is there. Second, we'll focus on the opportunities in the market right now. Harish Krishnan of Aditya Birla AMC, Sandeep Tandon of Quant Mutual Fund will be joining us. And then we bring in the macro heavyweights, Neelkant Mishra of Axis Bank and Sajid Chinoy of JP Morgan. So we've got all three bases covered in the next 90 minutes or so.
Well, I also want to extend a warm welcome to our audience. I mean, it's a small gathering, but it's an intelligent one. It's a very informed one right here in the studios, by the way. And you can see, I think, the visuals there. So just want to extend a very warm welcome to all the CNBC TV 18 Access members and, of course, our guests who are going to be joining us in just a bit in the other panels as well. So, Rima and Art, my job is a little easier because we're going to ask a few questions to kick this off, and then we'll hand it over to the audience and take their questions to all our guests and all our panelists. So with that short introduction, with a short preamble, let me dive straight in with the first focus area, which is, of course, the global picture, given the big oil shock that we have. Art, great to have you join us from the US. Thank you very much for being here. And Ben, glad you could make it to our studios. So it's a simple question with not such a simple answer, I guess. Is the war winding down, Ben? What's your sense?
I'm not so sure, actually. So I recognize there's a degree of optimism in the air over the last 24, 48 hours as the US president has made warmer noises, I guess, has spoken about his hope for a deal, a 15-point plan, and so forth. So I recognize that, the market recognizes that, and it's definitely relevant and interesting. However, we have to observe on the ground, I live in Abu Dhabi, the drone strikes have continued, the missiles have continued, and the Marines, the US Marines, I believe, arrive later this week. So I think the situation is, frankly, still very tense. The facts on the ground are mostly unchanged. Indeed, it feels more of an escalation in the last week than a de-escalation. So I recognize President Trump's words. Of course, I'm watching with huge interest, both as a citizen of the UAE and as a markets professional. But I think we need to be careful from being too confident and too optimistic, because sadly, as I say, the facts on the ground continue to be, frankly, quite alarming. And there is the potential for this to continue and worsen as these attacks on the physical infrastructure. Just overnight, we've had an attack on the Kuwaiti airports, one of the fuel depots kind of struck there. So I recognize President Trump's words, very important. He's the most powerful man in the world. But the facts on the ground continue to be unsettling, and that has not changed in the last 24, 48 hours.
Absolutely. If I can get Art, Rima, into the conversation as well. Art, same question to you. Do you believe the war is winding down? Ben, of course, is cautious. I just wanted to get your sense, because things have moved over the last 48 hours or so, and many believe directionally this is the first sign that things are starting to cool down and we are de-escalating rather than escalating. Art?
No, I think Ben has summarized it very well. My view is I see no de-escalation. I see more potential for escalation. I think that the words from President Trump are purely performative. It's very difficult to have your negotiating partner take you seriously when you're moving, combat units into the area. So, I think Trump is managing this like a reality television program. He needs lots of plot twists and, interesting, spicy things to add to keep everyone's interest. But at the end of the proverbial day, I see only escalation in the coming weeks.
So, Art, what is your base case scenario right now? And in that event, where do oil prices end? And the best case is that perhaps the oil conflict ends in the next couple of days. In that scenario, where do you think oil prices will settle? Because even if the conflict ends, there are facilities which are damaged, which are not going to come back on stream immediately. And then even if there is a ceasefire, there's going to be an uncertainty surrounding that. There will be a geopolitical risk premium attached to the passage. So give me your base case for oil prices, a worst case, and a best case. Best case being that actually this is de-escalation.
Sure. So obviously no one knows the answer to that, but this is about informed speculation. I would say, for instance, Ben's boss just came out this morning, I believe, and said, 100 to 150 is BlackRock's base case for, I can't remember if he said for a year or for years, but it was something like that. And I see that as a possibility. But let me make it very clear. There will now be a permanent risk premium on oil, regardless of how this thing ends. And I would say that premium is no less than $10 per barrel. And so if everything ends tomorrow, the very best case we can get back to is maybe $80 Brent. Now, I don't believe that everything's going to end tomorrow or that we're going to get back to $80 anytime soon. So my bottom line is we don't know. It's a probability distribution. I think somewhere in in BlackRock's range is reasonable, certainly for the rest of 2026. And in the longer term, when all this, as you correctly point out, trickles out to the rest of the global economy, then we'll get down to lower prices as the global economy collapses.
And also several nations, considering the energy shock right now, are likely to increase their purchase and storage of petroleum reserves. How much can that push up prices, to your mind, Ben? Sorry, Art.
You want me to? Okay.
Yes.
So, we're talking about a few million barrels a day. If all the storage in the world could be released all at once, okay, it can't be. So we take 3 million barrels, let's just say, maybe it's 2, maybe it's 4, I don't know the right answer, and we weigh that against 17 million barrels, which is the shortfall. It's a rounding error. I'm not saying that we shouldn't do it. We absolutely should. I'm not saying it's insignificant. I'm saying it doesn't make that much difference. In other words, if we think about a man who's lost 20% of his blood supply and he's bleeding out on the ground, and we put a tourniquet on his leg, and now he's only losing 15% of his blood supply, the guy's going to die unless you get him to hospital very quickly. That's a very crude analogy, but I think that's a realistic way to think about this. Yep. In other words, yes, let's do everything we can, but let's recognize this is an urgent situation.
It is an urgent situation. And Ben and Art, both of you, I mean, I just wanted to come in here. Both of you don't believe that this is ending anytime soon. So am I watching the same news that you guys are, or you don't believe what President Trump is saying, or what is it? I mean, we've heard the man say on tape, on camera, of course, he said a lot of things, but he's also said this, and this is the latest, that we've achieved our aims and we're going to end this soon, et cetera, et cetera. So, Ben, you want to go?
Well, a couple of things. I think President Trump is sophisticated. So is it possible he's buying time for the Marines to arrive? I think that's at least possible. Of course, we don't know, but it is at least possible. And secondly, and I think more importantly, of course, America is the US, they are the world's hyperpower, so we all respect and listen to them because of their heft. But they are not the only player here. So you have to think about also the mindset of the Gulf Cooperation countries, the Gulf Cooperation Council, including the UAE and Saudi. And to be somewhat straightforward, they've just had thousands of drones and missiles thrown in their direction, so they may not be in a shake hands kind of mood. And the same, I think, could be applied to Iran. So Iran, again, we don't know how much is posturing.
But countries like Qatar, Oman, etc., seem to be facilitating. I mean, yes. a sit-down of some sort.
You're right. So there's a blend amongst the GCC, the different countries within the GCC. They're not all the same, that's for sure. But I think in particular, the UAE, Qatar, Kuwait, and Saudi have been surprised, would be English understatement, I think, surprised at the centrality of their role in this war. I think they were very much hoping that they could be something like neutral. It's a conflict between the US, maybe Israel, Iran, and the GCC, and this was not, it turned out to not be correct. Furthermore, I think Iran, they have said they want to make it very clear that there's a price to pay. Iran, the IRGC, the leadership of Iran, perhaps want to make it very, very clear to these other countries that if you mess with us, you will pay. And therefore, again, it's not so obvious that they will just shake hands.
That's the point, right? If you mess with us, there'll be price to pay. And here's President Trump saying we're going to stop messing.
So a couple of things. One is, I think even if President Trump stops messing, which again, I'm not so sure, but if that's the case, then Iran can decide, okay, now the punishment can come. Now the punishment can come. So maybe, we don't know, maybe we are only at the beginning of the economic pain. And I think I would say, just briefly, of course, we're all focused on energy. This is totally appropriate. But it's not just energy, by the way. It's fertilizer. It's helium into semiconductor. So in a way, this is something like a 1970s supply shock on the energy side, multiplied by COVID in a way. Not quite, but there's something there making the point that this is going to be really a very serious problem for the global economy.
the betting market, poly market, right? The marketplace, whatever you want to call it. 60% odds that the war will end by mid-May. Now, I don't know what ending the war, the bombs stop falling or a complete peace, the strait opens. I don't know what that question or that statement is, which the war ends, but poly market says 60% by mid-May. That's what they're saying. Art, you want to come in on the question? Are you of the view that this is just buying time before we see this continuing and intensify more?
Well, Prashad, I can say a few things as an American. President Trump lies all the time. I mean, that's not a criticism, that's a fact. He has not said a true thing about the situation in Iran for at least a week. So I discount everything he says as performative. I don't discount its significance. I just don't think it, I don't believe anything he says. The bottom line for me is that Iran is right now the strongest country on earth. It holds the entire global economy hostage to its control of the Strait of Hormuz. Okay, it's never been more powerful. It never dreamed of being this powerful, and it's not going to give that up, as you know, as you said and Ben said, without extracting a huge cost. Now, back to the bettors. Maybe the fighting ends. Maybe there's no more bombs by mid-May. So much damage will be done between now and May that, I mean, a recession would be an optimistic take. I don't want to be pessimistic. I'm just trying to, to objectively assess what's going on. And as long as Hormuz is only partially restored to flow, then all bets are off, and chaos, economic chaos, social chaos.
Yeah. Art, if I can just ask you one thing. You saw the statement from the Iranian Foreign Ministry that they're going to allow non-hostile ships to pass through the strait, right? The problem is the strait and the oil not flowing. And they said, was that different from what we've heard before? Or there's nothing different? I mean, earlier it was we're going to set ships ablaze, and this seems a bit of a pivot, right? I mean, in their own way, they can't seem to be negotiating when they're being attacked, but a bit of an admission that they also want this to wind down? No, you don't read it like that.
No, I think, the Iran lies a lot too. I mean, that's the nature of this dispute. Iran wants to set up a tolling situation where they can get revenue that cements their control. In other words, if they can get other countries to actually agree to pay them for passage, then that essentially gives them diplomatic recognition that they're in charge of the Strait of Hormuz, which strengthens their position and gives them a little money. Bottom line, Prashad, is we're back to the strategic reserves. Maybe 1 million, 2 million barrels eventually gets through Hormuz with some kind of tolling situation. It's still a rounding error compared to what the world needs.
Well, the point is well made, Art. Iran is militarily weaker, economically weaker, but strategically far more important today than it was prior to the conflict. But Ben, the advice in all this for BlackRock is you all have dialed down tactical risk and you all downgraded U.S. equities to a neutral.
That's true. And I think we are in a different investment regime now, reflecting a more complicated world. And as Prashant said in his typically excellent introduction, it isn't just this a very acute and frightening situation. It's tariffs. It's a sense of globalization in decline. You can't trust other people. You have to be more reliant on yourself and your own nation and so forth. And I think that's going to persist. Hopefully this current crisis will pass. But I think those continue to be, as the kids say, the vibes, right? Those are the vibes these days. So what that's leading to from an investment perspective is a much more fractured global market and India market, I think. So we have moved from previously really a kind of everything bull market where you should be risk on, don't touch, and that worked very, very well. I'm not condescending that approach. That was the right approach for an easier time, a more pleasant time. Now, in a fragmented, chaotic world at times, I think we're all going to have to work a little bit harder and be much more selective.
U.S. economy, is there a risk of a stagflation? I mean, the jobs data is weaker, inflation is rising.
There is a certainty of a stagflationary shock to some degree. then now I hedge a bit to some degree, but for sure, we are going to have a price inflation problem, an increase. Inflation is already too high, by the way, and a growth slowdown. This is baked in the pie because last week was very important. We moved from a general concern from a global market perspective to physical damage. So this in particular was the Qatar LNG facility where the Qataris, they will be, I'm sure, roughly giving us a sensible timeline, 3 to 5 years to bring this back online. So this is, I'm afraid, even if we have peace today, the problem persists for some period of time, and therefore for your question.
Okay, so just one quick question then on the valuations of the Indian markets from an FI perspective. When we speak to domestic investors, they find the valuations of India very attractive. But foreign investors have been pulling money out. There's been an exodus. At what point do you think the FIs will be interested in the Indian markets? What will bring them back?
Soon, I think so. Like you say, the valuation is much more attractive. There's a degree of earnings stability and certainty. India continues to grow very well in the very big picture, driven, of course, by its very pleasing combination of great demographics and productivity, an ever more efficient economy, and so forth. All of that is still true. But as they say, capital is a coward. And I think global capital is very nervous to get ahead of the conversation we're having here and the uncertainty specifically around energy. So as and when, and this will happen, as and when we get any more certainty, some of the things that have suffered the most should rebound the most. And I think India will be on that list.
So in terms of emerging market, when we look at the whole world, et cetera, you guys do that, right? EMs, India's attractive.
Yeah, we have
within EMs.
We have a structural overweight to India within emerging markets for the reasons I mentioned. The phenomenal growth that is really at the scale of India is really unique on the planet. That persists. I think the AI story weirdly has been a problem in the sense that it's not so geared into India for now. But over time, can India, with its superb, educated, and very huge workforce, can India leverage AI and become even more efficient? Sure, why not? So I think all of these stories, all of these thoughts for India are still true, but for the next short period of time, I'm afraid they are obscured by the geopolitical and specifically the energy problem.
Yeah. Art, you know, in the last conversation we had, you said, well, this is a world-changing event, right? That's strong language. Were you saying it for effect, or is it really a world-changing effect?
No.
Go on, explain that. Explain that quickly.
Yeah. So, I mean, energy is the economy. Okay, it is the blood supply of the economy, and everything that happens to energy cascades through the rest of the economy. And so we compare this to previous oil shocks or other financial shocks, and those occurred at a time when the world had a lot more options, had a lot less debt. And so we're coming into this in a very stressed economic and fiscal and social background. And the world can't really take much more strain. And this is over the top strain. So the world will not go back to 2025. I don't know what the world will look like in the future, but I promise you that this is not going to be something in the rearview mirror that we're going to look at and say, oh, that was scary, but it's over now. Not going to happen.
Time now for the tougher questions from the audience here. So we have our CNBC TV 18 Access members, but we also have our next set of panelists here. Sandeep Tandon runs one of the largest AMCs in the country. And Sandeep also used to run one of the largest prop books in India. So he knows a thing or two about trading. Sandeep, go on, your question.
One very specific thing on oil only. See, yes, we are all concerned about the narrative or noise which is getting built, and it is quite concerning. But if you really look at the data, okay, when I'm talking about the employed volatility data of crude, it spiked up to 180, it's corrected to half, 90, which means smart people are not factoring this level of pessimism, what we are seeing around us. At least if that was the case, then vol could have been remain elevated for longer term perspective, which is not the case. In the last 7-8 days, it has become half. So that gives us confidence that smart people are not factoring this level of disruption, what people are looking at. And we always see that we all get carried away at that point, and we give up actually, So we are in that sort of capitulative sort of scenario, which is all our bullish thought process has been given up completely. So the Wall's data does not show. Just want to understand your perspective.
Yeah, so I slightly take a point from your question, which is people are not that bearish, actually. So that worries me a bit. So we have this shock is ongoing. And from our perspective at BlackRock, what is priced in the energy market has not really been fully priced yet in other markets. So we've had this uptick in the oil price, most obviously the spot price. But now the price for oil a little bit further out towards the end of the year is now much higher, suggesting the market is somewhat more worried that this situation will persist for some period of time. That should feed through into Rima's question for higher inflation, and this should give central banks a problem, meaning they can't cut, maybe they have to hike, higher yields, and then in turn, higher yields should be a headwind for global equities. So this is a little bit unsettling. Again, I don't want to sound too bearish. Of course, it also presents opportunities, to your point, I think. And will there be certain areas where the baby is thrown out with the bathwater? For sure. And actually, this is the moment over the next, say, 3 months when we can pick the longs that will make our portfolio returns for the next 5 years. So we're very open to this opportunity, but for now, I still a little bit worry that what's priced in the energy market is not yet fully priced in global bond markets and global equity markets. I still think that's got further to run over the next several weeks.
And there's also this thing that oil is a physical, the basic thing, oil is a physical asset, which is so demand and supply, whereas things like equities live in the future in that sense, right? So there is that element of pricing or mispricing, whatever you want to call it, right?
And on the physical point, just quickly, Prashant, like there is a risk of people who can't get it. So you can buy and sell equities. Maybe you don't like the price, but you can.
If you don't have it, you don't have it.
But there's a risk not just of a higher price, but we're seeing talk in certain parts of Asia of shortages, which is also an acute problem building on top of the chronic that we're talking to.
Please, another question.
Right. Hi, good evening. We've heard the saying that, data is the new oil. And as I reflect on that, I'm smirking because it seems that oil is oil and data needs the oil today. Right?
Well put.
So just wanted to ask you, either of the panelists, what's your take on the AI trade in the US? Does that slow down the entire juggernaut? Will the GCC countries withhold their investments that's going into the AI trade and any other second order effects?
Excellent question.
Thank you.
Ben, you want to take it?
I do. So it's been, again, slightly overwhelmed by, of course, the Iran situation. But the AI news flow over the last 4 to 6 weeks has been amazing. Incredibly positive in terms of the demand. No sign of a slowdown in demand. No sign of a slowdown in the CapEx. So people worry, is it a bubble? Will the CapEx slow down? There's no evidence of that so far. So I think the AI hyper mega super bull market is still real and ongoing, but will it suffer as a very crowded position in a general risk? I just sell everything, I don't even care what it is because I just want to hide in money. I think that's quite possible. So again, when I'm thinking about my laundry list of things I want to buy, maybe I'm not quite brave enough today, but I want to be brave at some stage in Korea with the memory play that they have. For energy, as you say, of course, is very thirsty for electricity and we don't have enough. So I'm not so heroic. I want to wait for some more clarity. But the AI trade, for your question, I think is still very, very alive. And the data over the last 4 to 6 weeks actually has been supportive of that. But again, it's been just completely overwhelmed, understandably, by the pictures and the reality of the Iranian situation. So I'm still very positive on AI, but I'm a pragmatist. Can it go down in this general risk-off? Of course it can.
I think wonderful question, and I think fantastic response there as well. We could go on, and such a fascinating topic. It's and so many directions we can take to it, but we're out of time. Ben, I want to thank you for dropping by. A wonderful conversation as always. Great insights. Art, we'll of course keep tracking this with you in terms of where oil goes from here, and I think you've got a close eye as anyone has. Thank you very much for taking out the time and joining us. Hello and welcome to another edition of the CNBC TV 18 Market Town Hall. The amount of headlines and consequently the market moves have truly been head-spinning and dizzying to say the least. To be sure, the Middle East conflict is only the latest in a series of massive disruptions which I'm referring to now. Since January of 2025, when President Trump took charge in the White House as the President of the United States, we've had non-stop run-through of news flow, which dwarfs pretty much anything else we've seen, at least I remember in the past many years or so. So it's truly been historic. Headline roulette, you can call it, or whatever else, but absolutely head-spinning amount of news flow. And of course, it's had an impact on markets as well. From tariffs to AI to now Iran, all this has meant that markets have indeed corrected quite a lot. I mean, some because they need to correct, and of course, I mean, there's been a fair bit of indiscriminate selling, forced selling, etc. as well. And that is what this town hall is really all about.
Well, there is the micro and then there is the macro. So what we've done is we've divided this into three parts. First, we'll focus on the global macros and oil prices. Art Berman, who is an oil market veteran, and Ben Powell, who's here with us in the studio from BlackRock, is there. Second, we'll focus on the opportunities in the market right now. Harish Krishnan of Aditya Birla AMC, Sandeep Tandon of Quant Mutual Fund will be joining us. And then we bring in the macro heavyweights, Neelkant Mishra of Axis Bank and Sajid Chinoy of JP Morgan. So we've got all three bases covered in the next 90 minutes or so.
Well, I also want to extend a warm welcome to our audience. I mean, it's a small gathering, but it's an intelligent one. It's a very informed one, right here in the studios, by the way. And you can see, I think, the visuals there. So just want to extend a very warm welcome to all the CNBC TV 18 Access members and, of course, our guests who are going to be joining us in just a bit in the other panels as well. So, you know, Rima and Art, my job is a little easier because we're going to ask a few questions to kick this off, and then we'll hand it over to the audience and take their questions to all our guests and all our panelists. So that, with that short introduction, with a short preamble, let me dive straight in with you know, the first focus area, which is, of course, the global picture, given the big oil shock that we have. Art, great to have you join us from the US. Thank you very much for being here. And Ben, glad you could make it to our studios. So it's a simple question with not such a simple answer, I guess. Is the war winding down, Ben? What's your sense?
I'm not so sure, actually. So I recognize there's a degree of optimism in the air over the last 24, 48 hours as the US president has made warmer noises, I guess, has spoken about his hope for a deal, a 15-point plan, and so forth. So I recognize that, the market recognizes that, and it's definitely relevant and interesting. However, we have to observe on the ground, I live in Abu Dhabi, the drone strikes have continued, the missiles have continued, and the Marines, the US Marines, I believe, arrive later this week. So I think the situation is, frankly, still very tense. The facts on the ground are mostly unchanged. Indeed, it feels more of an escalation in the last week than a de-escalation. So I recognize President Trump's words. Of course, I'm watching with huge interest, both as a citizen of the UAE and as a markets professional. But I think we need to be careful from being too confident and too optimistic, because sadly, as I say, the facts on the ground continue to be, frankly, quite alarming. And there is the potential for this to continue and worsen as these attacks on the physical infrastructure. Just overnight, we've had an attack on the Kuwaiti airports, one of the fuel depots kind of struck there. So I recognize President Trump's words, very important. He's the most powerful man in the world. But the facts on the ground continue to be unsettling, and that has not changed in the last 24, 48 hours.
Absolutely. If I can get Art, Rima, into the conversation as well. Art, same question to you. Do you believe the war is winding down? Ben, of course, is cautious. I just wanted to get your sense, because things have moved over the last 48 hours or so, and many believe directionally this is the first sign that things are starting to cool down and we are de-escalating rather than escalating. Art?
No, I think Ben has summarized it very well. My view is I see no de-escalation. I see more potential for escalation. I think that the words from President Trump are purely performative. It's very difficult to have your negotiating partner take you seriously when you're moving, combat units into the area. So, I think Trump is managing this like a reality television program. He needs lots of plot twists and, interesting, spicy things to add to keep everyone's interest. But at the end of the proverbial day, I see only escalation in the coming weeks.
So, Art, what is your base case scenario right now? And in that event, where do oil prices end? And the best case is that perhaps the oil conflict ends in the next couple of days. In that scenario, where do you think oil prices will settle? Because even if the conflict ends, there are facilities which are damaged, which are not going to come back on stream immediately. And then even if there is a ceasefire, there's going to be an uncertainty surrounding that. There will be a geopolitical risk premium attached to the passage. So give me your base case for oil prices, a worst case, and a best case. Best case being the
As geopolitical risks intensify, defense spending is set to take center stage globally. How well is India placed, and which companies could emerge as the key beneficiaries? Vikas joins us from ICICI Securities on the show to help us out with his insights. Hello and welcome to Finding Alpha. I'm Nigel D'Souza from the Mumbai News Center, and today we're going to take a closer look at one of the most exciting and important sectors from here on, the defense sector. Well, Vikas, first of all, thanks a lot for coming down. You've spoken quite a few times, across Zoom and various other links, but good to have you in person. And this time we're going to be speaking about an interesting subject, which is top of mind, the defense space.
Thank you, Nigel, for having me on the show.
Okay, all right. Let's get a couple of basics out of the way then, Vikas. What's India's current defense spending, if you could help us out with that? And how significant it is in absolute terms? Give us the broad numbers.
So for FY27, the total defense budget is stated at 7.9 trillion INR.
Okay.
This is roughly about 2% of the total GDP. This is also 15% increase on year basis. However, this includes the pension and army payments as well. So the capital expenditure which we should really focus on is 2.2 lakh crore is what we should look at. That is a good 17-18% increase on year basis.
Okay, all right. So we have two numbers in there. One is the budget, which is close to 7.9 lakh crore. And the number you said with regard to defense capex is around 2.2 lakh crore. Is that the numbers?
Yes, that's correct.
And the number to track from an earnings perspective is the capex spend, defense capex spend, capital spend.
For the company's perspective, yes.
Got it. All right. We have that chart that's come up for our viewers on the screen. Give us a couple of details then. If you could tell us India's spend or India's defense budget. If you compare it with, say, global peers, how does it equate to that? If you want to give it to us as a percentage of GDP or an absolute number?
I'll give you both. So in percentage of GDP, if you look at the global average, it is sitting somewhere around 2.3, 2.4% of the global GDP.
Okay.
Now, out of that, US is the biggest. US has, in absolute terms, a little shy of $1 trillion budget spending. That is the highest. Out of the total 2.6, 2.7 trillion dollar of the total global defense budget.
Okay.
So India, US, China, Russia, and Europe combined have more than 60% of the defense budget globally. In this context, if you look at India last year was roughly about 1.9%, and this year, FY27, we are expecting it to be 2%. So slightly lower than the global average, but we are expecting it to boost up basically. In contrast, if you look at the China, in absolute terms, though in GDP terms, China looks a little bit lower than India, but in absolute terms, their defense budget is 4 times that of India.
All right. So both India as well as China, as a percentage, the defense budget as a percentage of GDP is in that vicinity of around 1.5% to around 2%, because China GDP is so much larger. The absolute budget for China will be 4 times that of India. Is that correct?
That's correct.
And if I look at it in percentage terms, I think Russia is very high. If I look at defense budget as a percentage of GDP, it's higher than normal, I think so.
Yes, both Russia and Ukraine after 2022 went very high. Russia is currently a little over 7.3, 7.4%, and Ukraine is currently giving almost 23-24%.